Tensions in West Asia continue. U.S. Treasury Secretary Scott Bessent says that the U.S. is now entering the end game against Iran. At dawn begins the economic D-Day and the single greatest financial offensive ever, marshaled against an advisory. Meanwhile, Iran responds saying that the country who considers participating in the U.S. economic war will be seen as an act of war against Iran, as not a single drop of oil will be exported. And stocks on Wall Street closed Friday's trading session in the green, but posted weekly losses as investors were rattled by the fluctuating government bond yields and a lack of clarity on progress in West Asia. The Dow gained more than 500 points, while the Nasdaq surged over 100 points. Meanwhile, markets in Asia-Pacific region traded mixed, tracking cues from West Asia as well as the U.S. Treasury Secretary's comments that came in. The GIFT Nifty is indicating a higher start for the Indian markets. Oil slips to near $92 per barrel after a sharp weekly rally as investors book profits ahead of expected U.S. announcement on tougher sanctions against Iran. Meanwhile, gold hovers at its highest level since mid-May as concerns over U.S. debt management and fiscal sustainability continues. Government notifies the second phase of the PLI scheme for mobile phone manufacturing with an outlay of 62,500 crore rupees over 5 years. Minister Ashwini Vaishnav expects 3 companies to emerge as a national champion, says a good Indian mobile brand is likely to emerge by the mid of 2027. Hello, good morning. You're tuned into Power Breakfast on CNBC TV 18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Now, what are the cues that are coming in over the weekend? U.S. markets, we did see them close on the positive side on Friday, but for the week that closed a bit subdued. Now, what is the cue from the Asian market this morning? We're seeing a bit of a mixed opening is what I would say, right? We're seeing Taiwan index is holding on to mild gains of almost 0.1%, but Hang Seng on the flip side is trading with cuts of 1.8%. We have Shanghai that's trading with cuts of around 0.3%. Nikkei very muted, flip-flopping between the red and the green right now as well. So let's watch out for where it's going to be headed. At one point of time, it was in the green. Now it's moved to the red, down 0.4%. Kospi is trading with cuts of 2.6%. ASX 200, that's the Australian index, that's managing to hold on to gains of 0.3%. Nifty implied open. What's the indication coming in for the Indian markets? We're seeing our opening in the green as of now. 70-point uptick approximately is what we could watch out for. So at least as of now, we're watching out for a good opening, a strong opening from the Indian markets. But let's take an update in terms of the West Asia tensions that's impacting crude prices, oil, yields. That is important to watch out for. Now, U.S. Treasury Secretary Scott Bessent has said that the U.S. President Donald Trump has dismantled Iran's military capabilities and has destroyed nearly 100% of its military factories and buried its nuclear program. Now, he adds that the U.S. is now entering the endgame and they have begun an economic D-Day against Iran, the single greatest financial offensive ever marshaled against an adversary. Iran's security chief actually has responded to this as well and to America's threat, saying that any country who considers participating in U.S. economic war will be seen as an act of war against Iran, and asked that not a single drop of oil will be exported to them. Meanwhile, Iran's Persian Gulf Strait Authority says that vessels repeatedly violating the passage rules through the Strait of Hormuz will face strict action in future trips. Commercial traffic through the Strait of Hormuz has remained at reduced levels over the past 48 hours, according to the latest reports by United Kingdom Maritime Trade Operations as well. So that's the update that we have coming in this morning on the West Asia front. But how has all that impacted crude prices? What is the scenario in the commodity space, metal space as well? Let's go across to Manisha to take us through all of that. Good morning, Manisha.
Morning, and thank you for that, Vinny. I'll start with crude, as you said, and we are off the previous week highs of $95 to a barrel. In the Asian markets, it's 2% on a weaker side. The U.S. has continued to say that it will impose toughest of sanctions in history on Iran, and that is what seems to be bothering the markets right now. The geopolitical tensions are adding to inflation concerns. The market's also looking at the U.S. Treasury, which has ramped up buybacks of longer-dated government debt. So the U.S. bond yields and U.S. dollar Both of these are trading slightly on the weaker side at this point in time. It's not just about the crude oil prices. You have some decline coming in for copper as well. Most of the industrial metals are trading on a weaker side. The only area that I see trading positive is the precious metal prices. You have silver trading at 2-month highs. Gold is now taken above $4,600 an ounce. It's trading at a 3-month highs onto this one. Concerns about U.S. debt management, fiscal sustainability, all of that is keeping precious metals on the higher side. What the markets will focus on in this week is going to be the July PCE inflation data. You have the U.S. Fed Chair Warsh's Jackson Hole speech that the markets will cling on to. And then it is about Canada planning retaliatory tariffs after trade talks with Washington have collapsed. So some U.S. goods could be looking at some tariffs as well. So plenty to watch out for in this week.
Okay, thank you so much for that, Manisha. But how is the important cues over the weekend, overnight cues from West Asia, how is that going to be impacting our Indian markets? Let's bring on board a team of research to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. Sudarshan, first up, let's go through the important cues that we're keeping an eye on in terms of markets as well as the FNO cues. Morning.
Good morning, Vinny. So it's a new week and hope Nifty climbs higher and hits the level of around 24,500 because 24,300 has emerged as very congestion zone, and we have been seeing a major action both from put option writers as well as call option writers at the levels around 24,300. One positive part is crude has been holding steady around the level of $93 per barrel, and it's off, as Manisha told, that from the previous week's high of $95 per barrel. But now how the cues are from the global markets. So on Friday, we did see all the three major US indices closing in the green. You talk about Nasdaq, S&P or Dow Jones, but on a weekly basis, all the three major indices had reported losses. But considering all the factors, GIFT Nifty for today is indicating that we might open in the green and we might open above the levels of 24,300. So the key question would be, will we be able to sustain the levels above 24,300, and cues are suggesting that we might do. Now, what about the other cues? Two IPOs that we will open today, and one is Skyways Air and second one is Symbiotic Pharma. There is one major listing, that is Horizon Industrial Parks. What exactly FIs have done in the derivative market? Both in the index futures and in the stock futures, they were the buyers. They have added long positions and there was a minor reduction on the short side. Now, long's exposure remains around 10%. On the short side, exposure is 90%. Now, coming to the options data. On the put side, as I told you, 24,300 and 24,250 have seen maximum change in the open interest, and the call side, 24,300 and 24,350 were the most active. So, first support level, I have taken around 24,180 and resistance to be 24,370. Major buying will return in the market only when we cross 24,350 level very comfortably. One stock remains the band, that is SAIL, and two stocks have come out of the band, Bandhan Bank and Manappuram Finance. Some of the stocks that I'll keep an eye on. First one is Bharat Dynamics. Stock has seen short covering on Friday. KFIN has been seeing fresh longs, and last, Britannia amongst all the FMCG names has been seeing addition on the short side.
Okay, Sudarshan, thank you so much for the cues in the world of FNO as well as important market cues. But let's move on and talk about important stocks to watch out for in today's trading session. First up, Lenskart. That's going to be in focus on the back of a block deal. Now, sources say that SoftBank Vision Fund is likely to sell 2.6% stake, up to 2.6% stake in the company. Floor price of that is around 635 rupees, which is a 4% discount to the last closing price. So that will be important to watch out for. The selling shareholders will have a 45-day lock-in period for the residual stake as well. The next one you should keep an eye out on is Meesho. Again, this is a block deal alert that we have. Sources are saying that Y Combinator is likely to sell around 1.05% stake in the company. Floor price of this is around 197.50 rupees per share. This is also at a discount of approximately 4%. And Y Combinator will also have a 30-day lock-in period for any further stake sale. Let's talk about some of these EMS names. You have Dixon Technologies, Keynes Tech, Sirma SGS. All of these are going to be in focus after the mobile PLI scheme 2.0 has come into place. So we'll see some bit of a positive reaction, maybe one could expect coming in here. Kaplan Point, that's the next one. Red could be expected here after the US FDA has issued a Form 48310 observations for sterilized and ophthalmic plant unit. So this is the 10 observations they've received there. So a bit of a red could be seen here. Aurobindo Pharma, US FDA has issued one observation for its peptides unit in Telangana. Watch out for that one. Natco Pharma, again, US FDA has issued around 4 observations in a Form 483 for its AP unit. So again, some negative reaction could be seen for this pharma company as well. Tega Industries, they will be, making a preferential issue of around 95 crores to AP Jupiter Holdings. Issue prices 1,994 rupees per share. Let's watch out for where this is going to be headed as well. This is coming in after the major acquisition that was made last year as well of Molycorp. So that will be important to watch out for. And lastly, Z Entertainment, they've allotted warrants to promoters. Around 20.94 crore warrants to promoters will be allotted, which will receive they'll receive around 650 crores upfront for this one as well. Also, do not forget the shareholders approved warrant issue to promoters group entity is at 126 rupees per warrant. So we'll be key to watch out for this one as well. But that's all the update in terms of the top stocks to watch out for in the trading session today. On that note, we're going to step into a very short break. After the break, we'll come back, take you through the details from White House in our special segment, Trump Watch. Welcome back to Power Breakfast on CNBC TV 18. And what happened in the US market on Friday? Wall Street closed higher on Friday after a steep Treasury yield-driven sell-off. Now, S&P 500, that managed to close with the gains of around 0.4%. Then we had Dow Jones that closed with gains of almost 1% as well, led by the healthcare stocks like Merck and Johnson & Johnson. What happened to crypto-linked names? That also rallied, with Bitcoin positioning a sharp weekly advance, and shares of Robinhood and Coinbase were also surging. Longer dated Treasury yields kept climbing, with a 10-year now at around 4.73%. So that's the update that we have coming in the US market. But here's some opinion coming in from David Zerwas, Alan Blinder, as well as Ed Yardney on US recent buyback plans as well as future rate hike outlook. Listen in.
A tactical move that we've seen conducted many times in the past. These are basically operation twists, and they've been hugely successful when the Fed has initiated them. They're somewhat more unusual when the Treasury initiates them. But I don't see how you could fight this when the firepower and the cards are all sitting in the Treasury Department. So we'll see. There could be some fights for a little while, but I'm not expecting the traditional bond vigilantes to win any battles here.
We did do the same thing back in 2023. In 2023, we went from 4% to 5% in 3 months, August, September, October. November 1st, it got to 5%, and it got snapped up like a mad. So there's going to be a yield here at which it's going to be compelling to buy. I think it's pretty good right here, but I can't rule out 5%. But you know, 1 divided by 5 is 20. That's a pretty good rule of thumb going back many years. To something called the Fed stock valuation model that suggests that the fair value for the multiple for the S&P 500 is where we are at 20. So I don't think a 5% bond yield is going to bring the multiple down for the stock market.
I don't think Kevin Warsh is eager to push that coin one way or the other verbally. Eventually, he's going to have to decide. We've become accustomed in recent years with Powell and before that Yellen and before that Bernanke to getting some hints often at the Jackson Hole conference. Everything that Kevin Warsh has said about Fed talk since he was confirmed, even before, suggests he's not going to do that. And by the way, that's easier to do when you're not sure yourself. And he may not be sure himself at this stage.
Those are some opinions coming in for the US market. But now let's get you the latest on Trump-related developments in our Trump Watch segment. And starting with the updates coming in between US and Canada. Canada has announced retaliatory tariffs that will match Washington's new tariff dollar for dollar after days of intense negotiations between United States and Canada that actually broke down over the weekend. This was maybe a tit-for-tat response that came in after the US President Donald Trump had imposed 50% levy on the $20 billion of Canadian goods, or around 5.5% of its exports, which is disrupting that long history of stable relationship that both of these nations had. Moving on to the next commentary that came in, President Trump had also claimed that his administration has completely turned around the country in 19 months, stating that jobs are up and inflation is down. Meanwhile, what is the update coming in on AI infrastructure front? US President Donald Trump has doubled down, saying that he is personally, if he personally ran a town, he did want a data center because it brings jobs, and he is telling that there is actually lower electricity costs is what he's highlighting there. But that's the update that we have coming in from President Trump. And as we just mentioned right now, specifically on the tensions between US and Canada that continue to sour as Canada now has slapped tariffs on United States, a dollar for dollar. We had CNBC's Sri Jaggaraja, who has more details on this one. Let's go across to him.
Relations between North American neighbours, United States and Canada, have soured after 3 days of talks broke down at the 11th hour and no deal was reached. United States has now slapped 50% tariffs on Canadian autos, dairy products and alcohol. President Trump raging against Canada on social media, accusing Ottawa of targeting American farmers. But Canadian Prime Minister Mark Carney stating in no uncertain terms that Canada is able to match every American tariff blow for blow.
Canada will match Washington's new tariffs dollar for dollar in order to protect Canadian workers, farmers, families, and businesses. Our response will be concentrated in sectors such as steel, dairy, appliances, agricultural equipment, pulp and paper, and electronics. We'll also include products that are currently subject to unjustified Section 232 and 338 tariffs. This is a focused response to protect and defend our industries and allow them to compete with U.S. products in the Canadian market.
Why does it feel like today Mark Carney is going to war? Trade war. The tone.
Because we're attacked. You're at war when you get attacked. We got attacked. U.S. put 50%. We waited until the United States decided to actually implement these so-called 338 tariffs. That's fine. We've got the reserves. We got the resilience. We've got the plan. We've got the focus. We will respond. We're going to focus on what we can control. We're going to build.
It's another potential headache for American consumers facing possible price hikes and another issue for voters as we approach the midterms in around 10 weeks' time. There is a very strong political will within Canada to resist this renewed US pressure, and standing up to Washington was exactly the platform that got Mark Carney elected as Prime Minister. Back in March 2025, US Transportation Secretary Sean Duffy was doing the Sunday morning talk show circuit in the United States and showing the characteristic rhetoric of this administration, stating that a US victory in this new conflict is only a matter of time.
We're great trading partners, right? But Canada gets the benefit of trading with the U.S. way more than the U.S. gets the benefit of trading with Canada. It's a country that doesn't have a military. We want fairness for the American worker. And some of our best friends are the worst offenders that treat us the worst. And the fact that we provide their security for them and they take advantage of us, I think President Trump was the first one to go, you know what, that's not the kind of relationship that friends should have. And so the president's calling them out. I think you're going to see Mark Carney come to the table very, very quickly because it's going to be devastating for his country.
Okay, on that note, we're going to submit a very short break. We'll get you all the updates from the government's mobile PLI scheme 2.0. Stay tuned. Welcome back to Power Breakfast on CNBC TV 18. Now, in a bid to bolster India's mobile manufacturing ecosystem, the government has notified another tranche of PLI scheme. It has allocated an outlay of around 62,500 crore rupees for the next 5 years. Let's go across to Ashmit, who's here to give us more details on this one. Ashmit?
Well, the government formally announcing the launch of the mobile phone manufacturing scheme. This is a scheme that received cabinet approval last month, now being formally notified, being formally launched by the government. Under this scheme, importantly, it carries over the baton from mobile PLI 1.0, which ended in March of 2026. This scheme, now effective from the 1st of April, will be for a duration of 5 years from FY27 onwards for 5-year period. Now, importantly, as far as the outlay is concerned, we're looking at 62,500 crore rupees. In terms of the targeted goals, the target segments for the government under this mobile phone manufacturing scheme, the first is, of course, to boost mobile phone production here in the country. To that end, there's a graded incentive availability. There's 2.25% to 5% available, subject to the quantum of sales that these companies are able to clock. That's one. But importantly, there are additional benefits available in the form of 1.5% incentive. That is, if local sourcing is done, and benefit of up to 3% if the IP here rests here, if the R&D is done here. That's, of course, the first target segment. The second target segment, importantly, is for the government to have a national champion. Incentives of up to 5%, eligibility of 1,000 crores and above. The government, importantly, says that they're already in conversations with as many as 3 companies to develop a local Indian brand. But the government said that it will be very rigid when it comes to the IP resting here. It will be very rigid in terms of ensuring the R&D is done here, ensuring that there is production that is done here. So that will be something that the government will be very, very firm on. But it clearly wants a national champion coming out of the India mobile manufacturing story.
Thanks so much for that, Ashmit. But also, let's listen into the IT Minister, Ashwini Vaishnaw, what he has to say on this.
Segments which are economy segments, then there are premium segments, then there are super premium, then there is a very high value mobile phone. So there are basically 4 segments normally seen in the smartphone. We are asking the industry which segment you would be comfortable with. Their point is that we would like to play in a segment which has very high volume. Because once we have the volume, then we can really have a sustained play, sustained production and a sustained market going forward. So the industry has to now take the final call.
Okay, with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, a Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Monday morning, fresh new week. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, good morning.
Hi, good morning. So last week was a very quiet week. Markets were largely consolidating through all the trading sessions in a very tight band. But this morning, I think as we wake up, the clock is ticking, right? Besant has spoken about very harsh economic sanctions, the highest ever. And maybe the markets will be in a wait and watch ahead of that.
Well, they've called it the D-Day.
D-Day,
right? So,
economic D-Day.
Let's just take it from the top in terms of the stuff you need to know as we begin this session. So oil is, by the way, exactly where it was, same time when we started on Friday morning, 93. 92.7 to be precise, but 93. Now, the Iranian parliament has backed a draft law to charge ships for Strait of Hormuz passage. The plan's been there. There is the authority which governs the Persian Gulf, which has been set up by Iran. The parliament is saying, well, we are all for it. Later today, remember, we've heard this from Treasury Secretary Scott Bessent and, of course, President Trump, that they're going to unleash economic measures, economic isolation for Iran, which has never been seen before. So there's a press conference which is going to be held by Treasury Secretary Bessent at 11:30 today night, which is our night. What we'll hear out of it, I'm not sure. I'm sure there'll be specifics and technicalities, etc. These are basically what are called secondary sanctions. I mean, Iran is already a heavily regimed country, a sanctioned country, and it has been that way for decades. But this is secondary sanctions, which means that any country which deals with Iran, for example, buys their oil, it's the most straightforward thing in this particular situation. But even, helps in getting their money through banks which deal with, Iran or sanctioned individuals, they also fall under the ambit of the secondary sanctions. So that's essentially what this is aimed at. How much this will do is another question. There are, by the way, already indications that the two main players, which are, of course, at odds with the US in their own sense, which is China and Russia. China buys a lot of oil from Iran. They are essentially not going to be part of it. So these sanctions, 10 years, 20 years back when there were these sanctions which were imposed, they were kind of the Western Bloc coming together and imposing these sanctions. But I think that is splintered as well. Now, if countries like China and Russia stay out of it, are these going to be unilaterally imposed by the US, and how effective will they be? I think it's food for thought in that sense. What markets will also watch out for are comments tonight. In that same press conference, I'm sure it'll come up from Treasury Secretary Bessent on the US Treasury long end buying. That's been the other big problem. Some would say it's related. Oil, inflation, yields rising, that kind of thing. But of course, even without this inflation now, here and now, it's not a technical problem, it's a fiscal problem with the amount of borrowing which the US has done, despite the US Treasury saying that we're going to be buying double the amount of bonds, buying back bonds, double of it what we thought we will do earlier. Yields have continued to move higher. The 30-year, by the way, was up 2 basis points. It's not much, but the point is it's a direction. 2 basis points higher, 5.27. And the 2 by 10 curve flattened, which means that the 2-year is down, the 10-year is rising. The long end is rising. You can look at the 30 over 10, and you've got the same kind of flattening which you're seeing. US equities ended higher on Friday. S&P 500 about 0.5% higher, 0.43 to be precise. Bitcoin was up sharply, about 9% higher to about 79,500. It's the highest that Bitcoin has seen since late May. NVIDIA, just looking forward, right? NVIDIA will be posting their second quarter results on Wednesday. Always something to note. And you'll also have, Fed's Kevin Walsh, the Fed chair, delivering the keynote address at Jackson Hole Summit Symposium, which will kick off on Friday. I think the full schedule will come out between Wednesday and Thursday. I'll just tie in the levels here. It's been incredibly quiet. The market's has quietened down, and I mean, it's not unanticipated, unexpected, at least on an index level, very small change. So the resistance first, 24,300 is the first level. And then, I mean, the projection level of the last move is 24,600. On the downside, in terms of supports, 24,180 is the gap zone. That's the first support. And below that, the trend line comes in at around 24,100 or so. So these are very, very near-term levels that we are working with. So 24,300 on the upside and about 24,180 on the downside, which is the gap area. GIFT Nifty gives you a quick sense of how we're likely to start, and then we pick it up from there. 90 points higher is the indicative open after a pretty sideways last 5 trading sessions. Nigel has booked across to the wall with the F&O positioning and the cues. Nigel.
Well, that's right. GIFT Nifty suggesting a bit of a gap up, and in fact, the bulls will be happy if we can drive home the advantage in today's trading session. Keep in mind that this is 1 day ahead of the monthly expiry that plays out tomorrow, so expect volatility as well to pick up on that front. So it's going to be an interesting trading session to say the least. In terms of flows, the DIs were buyers, the FIs were sellers, the institutional net buy number was around 1,500 crores. But you need to keep in mind that the flow of paper is, going on non-stop, whether it's large institutions, some part promoters as well. So we'll have to keep an eye out, and that's keeping a bit of a lid on the market because the supply is continuously coming in and it's sucking out some liquidity as well. So that's going to be important to track. Even today, we have a couple of large trades. Moving to what the FIs did on index futures, not too much. Added some mild long positions. The short positions continue at around 90% or thereabouts. On stock futures, though, they added more longs in comparison to shorts. So it tells you that stock-specific action will continue even from here on. On index options, they wrote more puts than calls, telling you that maybe at lower levels there will be some kind of buying that will emerge. But the call writers, they are confident that they'll see out this series without the 20 DMA getting taken out. And that's why you saw the 24,300 call, the premium around $70, big open interest spike up out there. 24,250 call as well, big open interest built up over there. So, and the premium on both these two are in that vicinity of around 70 to around 100 rupees approximately. Which brings us to the levels. The bears will want to defend this 24,371, which is the 20 DMA. That's going to be the important mark on the upside. The reference point on the downside is around the 23,950 to around 24,000. Important that, that level is defended. So that's the broad range you're looking at. The bulls will fancy their chances that probably we can get closer to around the 20 DMA for today's trading session. So for the time being, we're in a range with that being the crucial resistance mark. In terms of stocks that we're looking at, gold has seen a good bounce, whether it's with regard to the China buying that we've seen, some softness on the dollar index as well, and gold has surged up. Manappuram is going to be a stock that I'll be focusing on. It's come out of the F&O band, so that's going to be a stock that we'll be tracking. Bandhan Bank in the past, we have seen it's getting good amount of support at around 165, 170. Now you have additional news that's coming in there. That one as well has come out of the F&O band. So both these two stocks I'll be keeping on the radar for today's trading session.
Thank you very much for that. And a quick check on Asia before we proceed. And it's red across the screen. Not deep in the red, but the Korean markets are down more than 2%. Hang Seng has lost also similarly 2% down on the Hang Seng, while the Taiwanese market is down close to about 0.5%. Mark Matthews of Bank Julius Baer is now joining in on the show now. Mark, thank you very much for joining in. So let's begin. What should we expect from the Besant press conference? He's described it as the toughest sanctions in history, an economic D-Day. What's going to be the likely impact, or what's the market expecting?
I don't think very much, because there's really not much the U.S. can do to stop countries like China from engaging with Iran economically or Russia. So I think it's for show. But what's more important is the fact the U.S. is saying it will engage in economic warfare with Iran. Indirectly, what that means is it will no longer be engaging in, real warfare like missiles. And of course, we would prefer the economic over the hard war. I don't think the economic war will be particularly more successful than the hard war has been. On the whole, I don't particularly view this as big news.
Okay. Iran's been pushed, if it's going to be an economic warfare, Mark, Iran's been pushed into the corner already for the last so many decades now. The rial is at historic lows. Inflation is running at 65, 70%. Do you think the only way out for Iran economically is going to be via earning some money from the Strait of Hormuz? For example, the Iranian parliament today approved a draft law which basically is saying that we're going to charge a service fee. So they're not calling it a toll, which basically then will, say that, oh, there is no freedom of passage. So it's not a toll, but it's going to be a service fee. Do you see that going through? What's going to be the legal, the practical, aspect of this?
Well, I think Russia, but you could go back further in history, Iraq, many countries have proven that they can survive in a heavily sanctioned environment. Some cases, they even become stronger because they become more self-sufficient. I think Russia would be the best analogy. There are some things the Iranians do import. They badly need. Medical equipment would be one example. I suspect somehow that kind of thing will still make its way in through Russia. But as for the Strait of Hormuz, I don't know if the Americans will let them charge that fee. It's all very gray what's happening in the Strait of Hormuz now. But to my understanding, to go through the Panama Canal or the Suez Canal costs about $500,000 for a ship. Now, if you figure there's about $100 million to $200 million, depending on the size of the tanker, of oil on a tanker that goes through the Strait of Hormuz, $500,000 service charge is 0.3% of that. It's not really a big deal.
Got that. Mark, morning, seeing you after a while. The other story which pops up occasionally is this entire bond yield story, which of course on the long end is now rising. There's a lot of, debate and discussion around what the Treasury is trying to do, whether it'll work, not work, or this is one more instance where everyone panics for a little bit and then forgets about it for the next few months till it comes up again. What's your sense?
My sense is that Donald Trump probably told Scott Bessent to get the long bond yield down before the midterm election because that is the yield off of which mortgage rates are priced. And Scott Bessent knew that he couldn't really convince Donald Trump, well, the reason why our long bond yields are high is because our debt is high and our deficit to GDP is also high. So he put on his trader's hat and intervened in the market. And doesn't look like it's going to work. I'd be kind of surprised if it did. This is a market that turns over $1 trillion a day. It's the largest market in the world. So that's where we're at. I also have been watching the fund flows into government bond ETFs. And I suppose what is encouraging is they have been very, very strong over the last 2 weeks. And that is an indication to me that, yes, it's true, the U.S. Deficit to GDP is too high, whatever it is now, 6%. The federal government debt just went over, I think, $40 trillion last week. But on the other hand, you're now getting 5.3% for a 30-year Treasury. And now if you just reckon you're a retired couple in the United States with, say, $2 million in liquid assets, that gives you a gross income of over $100,000 a year. And then they would be getting, I don't know, maybe about $40,000 in Social Securities. What I'm trying to say is that 5.3% is a very attractive yield on what is essentially risk-free debt. Now, if you're an overseas investor, you might worry about your currency exposure. But if you're an American couple, and you're not so worried about what the U.S. dollar is doing.
All right. Hi, Mark. Good to see you in. I recall when Mr. Trump said he's going to fight for elections, he was talking about the U.S. economy being in bad shape when the debt was at around $24 trillion. That video had resurfaced, and now he's staring at $40 trillion. So interesting times on that one. Let's focus on the Indian markets then. How do you see things pan out here? Well, we have been thumping the table that earnings has come back. The first quarter wasn't so bad. Valuations are more reasonable than what it was, say, around 18 months or so ago. Your view on the Indian markets and anything in particular you like?
Nigel, just before I talk about India, I wouldn't blame it on Trump because it was the pandemic reaction of the Biden administration that caused the explosion in the debt. India, I think, looks good. The first quarter earnings growth was about 18%, and that puts the forward price earnings of the Nifty at around 18 times. So it's cheaper than the US market, which it hasn't been in a long time. And all the foreign selling that we had from the peak of September 2024, some $48 billion of selling, which was pretty much the same amount as what they'd put in over the previous 10 years, it seems to have come to an end. They are net buyers this month. And when I look at the fact that the mid caps are about 10 to 15% higher than before the war started, and then the Nifty 50 is about 10% lower, obviously the foreigners own the Nifty 50. They don't really participate in the mid caps. That tells me that if the foreign selling has truly abated, which I think it has, then the market should go up, because we have seen in the mid caps that's what local investors have been doing. They've been pushing the market up. They're pumping.
All right. Mark, we'll leave it there. Thank you very much for joining us. Good conversation as always here on CNBC TV 18. Thank you for joining us. Let me just quickly run you through interactions which are lined up here over the next 2.5 hours. So 8:35, we have the management of BLS International to discuss their outlook for the rest of the year. 9 o'clock, Bernstein's Jignanshu Gore will be focused on new age companies and more. 9:20, Shailesh Bhan of Nippon India Mutual Fund will talk markets with us. 9:35, the management of Kim's comes up. We also have, the management of Symbiotic Pharma Lab who will be speaking with us at 9:45 as their issue opens a subscription. The primary market has been hot. And towards the end of the program, we get you a discussion around the financial space and speak about the FCNRB closure, gold loans and more. Stay tuned. All of that coming up.
Well, time to take a short break. You come back, we go full tilt on stocks. We'll be focusing on our top 10 segment, in which the stocks should come up for you on the screen. Dixon, Gaines, Sidma, all of them will be reacting to positive news flow. Add to the list, Tega as well as Z Entertainment, both of them are likely to react positively. Add to the list, we have Smartworks as well. So 6 stocks that will be reacting to positive news flow, while we have Meesho, Lenskart, Capital Point and Paradeep Phosphates that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. Monday morning, it's time to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. More and more block deals every single day. Good morning, everyone. Vivek, tell us on Lenskart and Misho.
Well, that's right. Good morning. Last week we've reported a block or two every single day, and the trend continues this week as well. So Lenskart is in focus. So one of the early investors who continues to hold close to 10% stake, that is SoftBank Vision Fund or SVF, is looking to offload close to 2.6% of the total equity in today's deal. This is going to be via the block window. Most likely, approximate size of this particular block is close to $300 million, and the offer floor price is at 635 rupees a share. There is an offer floor discount of up to 4% to the last close of 661, and there is a lock-up on residual sale of shares of a further 45 days. The other stock on the radar where we are expecting a 3-year block again is Misho. One of the early investors, Y Combinator, is looking to sell a little over 1% stake in the company. Total size of the block is expected to be upwards of 950 crore. The block price or the floor price is at 175 rupees a share, implying again a 4% discount to the last close. In this particular deal, there is a 30-day lockup on further sale of shares. Expect some pressure at both of these stocks, at least at the open.
Got it. All right. Thanks a lot for that, Vivek. Well, let's hop across to Sudarshan. He's here to tell us about the 62,000 crore rupee mobile PLI 2.0 that was announced. Sud, please take it away.
Good morning. So what Cabinet had approved in the month of July now has been notified by government. Government has notified new 5-year mobile manufacturing scheme, and that will run till FY31 and will have a budget outlay of more than rupees 62,000 crore. Government is looking to achieve rupees 39 lakh crore in total production and rupees 15 lakh crore in exports. And this scheme has come in after smartphone has emerged as single largest exported product in the year 2025. So under this PLI 2.0 that we call it, now, manufacturers will receive incentives ranging from 2.25 to 5%, and this incentive will be on eligible sales of mobile phones that are made and manufactured in India. Additional incentives up to 1.5% for securing specified components and sub-assemblies domestically. And this framework also provides an additional 3% incentive on sales for design, R&D for building Indian brands. So what's the difference between PLI 1.0 and PLI 2.0? So under PLI 1.0, it was aimed at building scale in large-scale electronics manufacturing and mobile phone production, and production had reached rupees 11.61 lakh crore versus government's target of rupees 8.12 lakh crore. Now under PLI 2.0, emphasis is on increasing share of components and sub-assemblies that are produced domestically, and additional incentive is intended to encourage manufacturers to deepen domestic supply chains. So that's the basic difference between PLI 1.0 and PLI 2.0. But I'm going with green for all the EMS names you talk about: Dixon Technologies, Sirma SGS, or Keynes Technologies.
All right. Well, thanks very much for that. So Kaplan Point is the next one we're going to focus on. Ekta is here with details on Kaplan. Ekta, morning.
Morning. Well, Kaplan Point is in focus because the US FTA has issued 10 observations to their sterile as well as ophthalmic manufacturing facilities. So it manufactures sterile products as well as the ophthalmology goods in this particular plant. It was an unannounced inspection which took place from the 13th of August onwards, and the company says that the observations are procedural in nature at this point in time. They will address the observations comprehensively and respond. So this is something to look out for. Remember, sterile and ophthalmology products are definitely much more in terms of US FDA scrutiny. So the 10 observations will probably see the stock go into the red.
Okay. All right. Ekta, thank you very much for that. More stocks with news flow. Vinny is here with that list. Vinny, morning.
Hi, morning. First up, we have Tega Industries that's going to be in focus. We'll see some green here. They are going to be making around a 95 crore preferential issue to AP Jupiter Holding. This is at a price of around 1,994 rupees. So let's watch out for this one. The next one is Z Entertainment. Green expected here as well. The company has allotted around 20.9 crore warrants to promoters. They'll be receiving upfront of around 660 crores. Do not forget that obviously the shareholders had approved an issue of around 25 crore warrants, which was going to be worth around 3 3,140 crore odd, and that was going to be at a price of around 126 rupees per warrant. Next one is Paradeep Phosphate. We could see some red here. They've actually, there's a penalty that is levied on them, fine and penalty of around 95 crores. This is from the Goa Customs that they've been levied these penalty. This is for some mismatch in terms of importing the 7-prilled urea consignment that was declared as some other grain, and that is why this penalty has come in. So these are the stocks that we're keeping an eye out on as well.
Thanks a lot for that, Vinny. Well, going back to Sudarshan, he's here to tell us about SmartWorks. Sud?
So today, early in the morning, company has announced that it has added rupees 235 crore of incremental contracted rental revenue. And this is via expansion mandates from existing clients. And this revenue builds on the company's already announced 5,400 crore revenue via contracted rental that was as of June 30th. And this expansion mandates include Fortune 500, Forbes 2000 companies, and also large Indian conglomerates. So I'm going with green.
Got it. All right. Thanks a lot for that, sir. Well, here's a quick recap of all the top stocks we just discussed. The ones with positive news flow: Dixon, Kane, Sidma, Tega Industries, Z Entertainment, as well as SmartWorks. While the ones with negative news flow include the likes of Meesho, Lenskart, Kaplan Point, and Paradeep Phosphates. That's about all the equity market action for the time being. Let's go across to Manisha. She's joining in to tell us about all the action from the commodity markets overnight. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we're looking at prices coming off from those $95 a barrel kind of a level that we saw on Friday. It's 2% down in Asia right now. The U.S. has said that they will impose the toughest sanctions in history on Iran. Is something that the markets are looking at. And the reason that you have seen the prices come off its highs is, one, the demand destruction that we're looking at in this year is one part of it. And second, the market believes that it's going to be more financial and less of on-ground retaliatory war strikes, and the disruptions may not be more than what we already have right now, is what has taken some premium off the prices. But the strength has continued for precious metals. So you have gold prices trading at a 3-month highs. Silver is trading at a 2-month highs right now. The U.S. Treasury ramp up buybacks of longer dated government debt. Well, that has led to bond yields and U.S. dollar declining, and that money seems to be rotating in case of gold and silver. The street, of course, will watch out for the July PCE inflation data that's in this week. You also have the Fed Chair Washer's Jackson Hole speech. Markets will be clinging to that one as well.
Thank you very much for that. We will get into a break. On the other side, we'll connect with Harmesh Kant of Chola Securities for some fundamental stock talk. We'll also connect with the management of BLS International to talk about their FY27 outlook and the road ahead. Welcome back. Let's invite the first management on the show, BLS International. The company reported a steady set of Q1 numbers. Shikhar Agarwal, joint MD of the company, is now joining in. Shikhar, morning. Thanks for joining in. Rima here. Good quarter. Revenue growth of 25% in your core visa and consular services. You've reported a 21-22% increase in revenue and EBITDA. But there was a lot of geopolitical disruption seen in Q1. Airlines got delayed. Some of them were operating at reduced capacity. People were not flying because of the increase in airfare cost. Was growth impacted or suppressed on account of the geopolitical tensions in Q1? Would growth have actually been higher than the visa service growth of 21% in Q1?
See, definitely, Rima, if you see, we've achieved a revenue of around 890 crores and a net profit of 202 crores, which is around a 25% growth compared to similar quarter last year. We've been giving guidance of 15 to 20% growth, but we have still definitely surpassed those numbers. If you see on the visa volume, we are almost almost similar to the same quarter last year. Definitely, if there was no disruption, our revenue could have been increased much higher. Volume could have been higher. Our offices were temporarily closed in this quarter in different parts of Middle East. Still, we've achieved those numbers because of revenue coming in from other parts of the world.
Yeah. So particularly about the disruption, is it possible for you to quantify, as you said, some of your offices were even shut. How many days were it shut? And in which of the geographies or where you provide visa services did we see that impact?
Mostly it was Middle East. Some of the offices in UAE and a couple of neighboring countries were shut, depending on the advisory given by the local governments. Everyone has to comply with that. So it was a couple of days or maybe a week in some countries, but the operation resumed pretty fast. And as you have seen, we have delivered good set of numbers in the first quarter itself.
So growth was impacted, but can you tell us a number? 1%, 2%?
We have not, we don't know exactly the number that has happened, but it was minimal impact that happened on the company.
Right. Sorry, just one question. Can we annualize this number for the full year? I mean, will you do 800 crores for the full year in profits?
Yeah. Yes. See, what we did last year, we've been telling that next 5 years from the numbers, we are targeting 15 to 20% of growth in our net profits. So definitely, that is where, if you see our first quarter, we've achieved 25% growth, which was more than our anticipated. So we are remaining steady and our trajectory of growth is the same as we have said.
So you did 724 crores in profits last year. You're saying you will be between 15 and 20% growth this year as well, FY27?
That is what, as of now, it seems.
Okay.
All right. Shikhar, hi, good morning. Been a long while since we chatted up, Shikhar, so good to see you in. The digital services business, that's growing at a faster clip, right, in comparison to the visa business. But those margins are relatively lower. What is the ideal mix you're looking at between visa as well as digital services? And in that sense, directionally, would it mean that margins come down a little bit, since digital services has relatively lower margins?
See, as you know, the margins in our visa business are around 40% EBITDA margin that we've achieved. And in the digital business, if you see this quarter, the margins have actually grown by a couple of percentages. So it's, I think, around 8% now margin that we are doing with the digital business. And combined, our margin is around 25% of the company. So definitely, as we have said, we have seen a growth in the margin in the digital business also. There was a temporary dip last year because of the acquisition of RD Phillips, which was on increased revenue and lesser EBITDA. But now going forward, as we introduce more allied services, our target is to have cost efficiencies and increase revenue per application in digital business. So definitely our target is to increase the margin in our digital business also.
So digital goes to double digits?
I don't know exactly what is the exact percentage, but our objective is to increase the margin also in digital business. As you have seen in the visa business, our margin was 24-25%. Then now it's at 40%. So definitely our target is to increase the margin in the digital business also. But the profile of the business is a little lesser, is a little different. We get money in INR. In our visa business, we get mostly money in foreign currencies.
Got it. All right. Let's focus on this Aadhaar project that you've taken up as well. What is the total revenue potential? I understand it could be quite large in the next 5 to 6 years. So cumulative, what kind of a revenue number are you looking at?
So the project is itself of around 2,500 crores. Okay. The revenue that we are supposed to generate in 5 years from the full operation of the contract. So right now, as we speak, we have deployed a majority of the offices. There are still some phases, depending on the signed contract that we have, that are left. So a couple of offices still need to be rolled out. That will be done, I feel, in the next few months. 100% of the project would be operational. So total revenue potential of that project is around 2,500 crores that we will generate over the next 5 years. And we are targeting around 15 to 18% of EBITDA margin from that project.
All right. So this is an annual run rate of close to around 500 crores then?
Correct. So it's a pretty sizable project. We are very excited about that. We've already deployed in many parts of the country, and we've started seeing good numbers coming in. The demand for Aadhaar is increasing as we speak, and we are doing good penetration across India.
Okay. All right. Final question from my end then. You're sitting on a good amount of cash, and you've not shied away from any inorganic growth. Something we should hear about. And this 15-20% revenue growth that you're talking about is X of the inorganic growth, right?
Correct. So basically, as you have seen that over the last few years, we've acquired multiple companies worth around 2,000 crores that we have done mostly from internal accruals. Now, again, we've generated around this good amount of cash, 15 to 1,600 crore on the books. So we are again looking at different targets. You know, we have a good M&A team. We are looking at synergies that can lead to cost efficiencies and increase in margin from on our company.
All right. We'll leave it there. Thank you very much for joining us. Good speaking with you, and it's a pleasure. Tracking that 15-20% kind of growth for the bottom line, I mean, they should be 800 crores plus. I mean, actually 830, 840 odd crores. Market cap is about 11,000 odd crores or so. So it's about 12, 13 times this year earnings. It's a... I mean, I've not looked at this in detail, but I mean, we've had the company over a fair number of times. We'll look at it and ask our market experts in terms of what they make of this. Actually, we have Dharmesh Kant with us, Head of Research at Chola Securities. Dharmesh, good to have you with us here. Thanks for joining in. By the way, have you ever looked at BLS as an idea, investment idea?
Yeah, good morning, Prashant. I mean, way back, it was 7, 8 years back when we have looked at it, and even we have an IC on that company, but in a different organization that was in Motilal Oswal. Post that, recently, I have not looked at it.
Okay, all right. Fair enough. So what are you focused on this new week? Primary market, secondary market, mix of both? Any names pop into the head this morning?
Yeah, Prashant, I mean, it has to be secondary market. Primary market is a bit, dicey, though a lot of companies which are coming with their IPO notes on the primary market are below $1 billion of market cap. So small size issue with the valuation shooting up, listing gains are, 30-40%, makes it a bit of a tricky situation to step into. However, secondary market, I think it's time, maybe 1 week more or so of this stagnation, and then things should start flowing in. For the secondary market. Numbers we all have seen, it was an excellent set of numbers. I mean, 500 companies outside Nifty 50 reported 31% kind of a PAT growth. And then we have, initiated a couple of ideas. I mean, one was Raymond Realty, which we have been waiting for a price correction, which happened because of Q1 numbers being a bit of a disappointment. But the real estate companies have to be looked from a longer term perspective on the discounted DCF basis of the net operating profit after tax, and we have done the valuation out there. There's a 20% kind of a gap from the current market price. So 676 is the first target price we are discounting in. 24,000 crores of GDPs withdrawing in the years to come by. That is there in the price. What is not there in the price is the management guidance of 6,000 to 10,000 crores of additional JDAs, which they would be doing a run rate every year. And that upside is not there. The guidance of margin 17 to 20% is likely to be there with a ROCE of 21%. So stock-specific ideas are flowing in. And our earlier company, Welspun Corp, we did an IC way back at 914. That is phenomenally well. The orders flown in. The next two big triggers which can be out there, one is for the natural gas supply for the data center flow in the US itself. So they are doubling the capacity out there, and overall, they are functioning at 60 to 65% of the capacity utilization, be it India, LIDI pipes, or in the US or in the Middle East region. And then the next trigger will come from the Middle East area. So we are waiting for that for any upside target price revision at 23, 2400, 25% peg. Everything seems to be discounted. So the recommendation is hold and carry. But overall, Prashant, to just sum it up, we are very constructive on the market. I mean, it's taking its own time, but eventually the direction is likely to be way up going forward.
And Welspun Corp, you're saying everything is in the price now at 2,300. I think you were bullish at sub 1,000 rupees as well. You all had an IC, right?
Yeah. Good morning. We did an IC at 914. I mean, 6 months back, and then this Middle East thing happened. The price eventually took a dip. It was down around 15% from the IC levels, but it is right now. But at 2,300, 2,400 price level, even if you discount the future earnings at 25% kind of a growth year on year, that's the CAGR I'm talking about. It's available at a PEG ratio of 1. So with this order coming into flow, which I mean, execution won't be a problem. The good part is they were executing at 17 to 20% kind of a CAGR, which is likely to go up to 25, 26%.
Got it.
So that's, I mean, at this price is largely built in. 4-5% here and there can still happen. But we are awaiting the next two big triggers. I think this opens up a bigger platform for Western Corp to get larger orders, both from the Middle East for laying the pipelines and in the US for the gas flow.
Okay, all right. Dharmesh, I wanted to ask you about the gold financiers. They'll be in focus yet again. I was looking at a couple of articles and China's got back to buying gold in a big way. Gold prices as well have perked up. Now they're close to around $4,600 from sub $4,000. And these gold financing companies clearly have moved up. Manappuram, the additional news flow is it's coming out of the F&O ban. What's your pecking order? Muthoot, Manappuram, IFL Finance, what else?
Yeah, I mean, now there are plenty of banks also which are offering gold finance, as well as many NBFCs are also coming to the foray. A couple of new announcements like Aditya Birla and all also pouring into the segment. So this opportunity will be there. And as long as Mr. Trump is in the seat, gold prices won't come down. There will be minor corrections out there, but eventually it's likely to go up. So various estimates are there, like $5,500 to $6,000 an ounce for the gold price in next 1.5 to 2 years. So that augurs well for all these gold prices companies that LTVs goes up. So it's become a commodity. You have to buy on declines. Though the performance of most of the gold financing companies has been very solid, and the run rate of 25 to 30% kind of a CAGR is easily gettable. That's the type of business which is coming into gold financing companies across the board. So be it the new entrant or the old ones, there's no problem of business out there. So pretty bullish on the entire space, and we'll go by the leaders of the pack. I mean, Muthoot and Manappuram, you can place a pack, and there are others in the business who have been doing very well.
Stay on. We need to slip into a very short break. We'll come back, chat with Sudarshan Sukhani and Mitesh Thakkar, get in a few technical trading ideas. Stay tuned. Welcome back in conversation with Dharmesh. Dharmesh, in the IT pack, Orion Pro was a stock that you've liked, but numbers were sort of disappointing. So have you tried to analyze what went wrong in the current quarter, and are you still as bullish? Is it just work in progress?
Yeah, Reema, I mean, we are holding on to the Orion Pro, and the other has been the Tata Technologies. These are only two stocks which we have a high recommendation in the IT pack. We have a recent, a discussion with the management, and as per the outcome of that interaction, the things are like from Q2 onwards, things are likely to improve. I mean, Q4 and Q1 of last year, this year was not as good, but going by the order book at hand and the type of data center order wins they have got recently, also they have got one, and there are many in the pipeline where negotiations are going on. So we think those will materialize in favor of the company. And Q2 onwards, things are likely to improve both on the cash flow and the profitability basis. So FY27, by the time we end up, the trajectory of 20% plus kind of a growth on the revenue, which is lower than the 30% initial guidance which the management has given in the INR terms, is likely to come back, and 28 should be a better year. So constructive on Orion Pro at current stock. Stock price also corrected, so valuations are comfortable, and we'll see post Q2 if again the disappointment is there, then a reverse call can be taken out here.
Okay, thank you. We'll come back to you. For now, let's go across to Sudarshan for the brokerage call of the day. Sudarshan.
So first one is Apollo Tyres. UBS has upgraded the stock to buy and target price is increased to rupees 590 per share. It says valuations remains at a discount to peers and stock has underperformed the sector for last 4 years. And both for India and Europe, business outlook has improved while it believes the investors are overlooking earnings recovery that company might see after Q2 FY27. And FY28 EBITDA is projected growing at 21% YY and also robust demand plus strategic initiatives support mid-term recovery for Apollo Tyres. Next one, Dixon Technologies. JP Morgan maintains overhead call and target price here is 16,400 rupees per share. It says rupees 10,000 crore FY26 turnover eligibility may limit benefits to Dixon's larger customers and also rupees 5,000 crore FY26 sales threshold suggests focus on exports, requiring them to scale up exports and should be eligible for 0.6% incentives as it is scaling up camera modules and display modules manufacturing. It believes the earnings upgrades are likely, but quantum remains uncertain as of now. Nomura maintains buy call on Hyundai Motors and target price here is 2,498 rupees per share. It believes that new launch are expected to improve volumes in H2 of FY27 and EBITDA margin could recover in the range of 11 to 14%. And it's targeting 15% plus market share by FY30. And as far as discount is concerned, it believes that discounts are likely to remain controlled and new launches likely to have no discounts in FY27. And Nomura is largely positive on the stock and target price is almost 2,500.
Thank you very much for that. Dharmesh, on Dixon Tech or the other tranche of the PLI scheme, which was announced over the weekend, it's going to be 62,500 crore for the next 5 years. Who would you bet on? Is it material?
Yeah, definitely. This is a must needed boost to the sector which has come through. We were positive on Dixon Tech for the first week of July, where we have included this into our high conviction model portfolios. And from there, the stock prices have rallied quite a bit. We were initially targeting 14,500 as a target price. And that assumption, the thesis was that Vivo deal will happen, which has actually materialized. And management themselves have guided that H2 of this financial year, with Vivo deal coming into play, can see a better traction. Revenue growth from 15%, the earlier guidance can jump to 25 to 30%. And this will be a margin accretive, this incentive play will be there. So almost of the top 5 mobile manufacturers, 4 are in the kitty of Dixon Tech. So that's the top of the packing order. As far as revision of the target price is concerned, we are waiting for Q2 numbers and the guidance thereon. Based on that, we will do a further revision. But the likely target price, as the back of the envelope suggests, is 16,500. So plenty of upside still left in Dixon Technology, and even new people who have not invested can come in at current market price, and our recommendation for on that. Apart from that, others will also benefit, but I think with Vivo JV on the backside, Dixon stands to gain the maximum from it.
By the way, have you looked at Jana Small Finance Bank, Dharmesh?
Not very closely, Prashant. I mean, most of these small finance banks which are into microfinance segment, the primary source of lending, it has come out of the trouble zone, and the book is also expanding. So we are having a close eye, but sensing the way the inflation and everything is picking up and monsoon's still been erratic, I think it will be a bit premature to jump into this small finance bank as of now. So because they are better placed on the larger cap side.
No, there, I think Nimish put it out in his chatter that perhaps there is some corporate announcement or a deal brewing. I think this was, something to watch out for. We'll see. That is the Jana story. Any other ideas? I mean, have you looked at this Coal India subsidiary called CMPDI? I mean, a fairly recent listing, did quite well, has come off the highs.
Yeah, I mean, it's an interesting story, and it all depends on the order coming in through. I mean, for exploration and for the mining reserves, and rare earth is the new addition to the kitty. For me, the first primary, it comes from the Coal India itself, and balance from the rest of India of the state government. So I think the kind of asset-light model they are sitting on, and the company belongs to my hometown. I'm from Dhanbad, and its head office is in Dhanbad itself. So, I mean, correction should be bought into, and but only one thing has to be, bear in mind is that it's end of the day, it's more of exploration kind of a project deals which will come through, and eventually hand-holding into the further which they are trying to do of the entire project layout and how the mining will happen. That has still not taken up in a big shape. So with that caveat in place, a trading bet can always be played out here.
Do you have a view on Sudarshan Chemicals?
Not particularly on Sudarshan Chemicals, but chemical as a space is looking very exciting. Last 2 quarters, the results were very good for all the chemical companies. And one has to go through company by company because it's all about molecules which they are developing. So the business has picked up. Business from Europe is coming in a big way for them, despite all this Middle East transit disruption which is there, which we have been liking in the space, as one has been your Lakshmi Organics and the other has been Jubilant Ingredient and Acuitas Chemicals. So these 3 as a block looks pretty interesting to us.
We'll leave the conversation here. Dharmesh, thank you very much for joining in. We will slip into a very short break. We'll come back and get the pre-opening rates. We'll also connect with Bernstein's Jiganshu Gore to talk about the new age companies and more.
Welcome back. Well, Sudarshan Sukhani is with us, and so is Mitesh Thakur for what they'd want you to do as far as trades are concerned. 3 minutes to the pre-open session, 17 to go for the market open. Gentlemen, good morning. Good to have both of you here as always. Thanks very much. Sudarshan, you go first. What's the trade? What's the setup? And what would you do?
Yeah, good morning. See, last week the Nifty went and found significant support around the 24,000 zone. That's the area we had identified, and the suggestion was that we go long if that support holds. On Friday, it held. Today, the same theme continues. If you are not long in the Nifty, look to buy the index, not necessarily on the gap up, but it's a very small gap up. On a very minor dip or a consolidation, keep a stop at 24,100 and just wait patiently to see how high it can go. But currently, today's trade setup is very simple. Buy the Nifty.
Okay, buy the Nifty. Mitesh, what about you?
Good morning. So I think 24,300 for me was the first target. The Nifty last week kind of made a high of around 24,284. But today with the gap up, I think we might be getting past 24,300. If that happens, then I would be a buyer with a stop below 24,280. And hoping that the gap kind of gives you a reversal, which can see the Nifty head towards 24,550, 600 zone. So in the short term, the immediate bias is slightly on the upside.
Okay, got that. Mitesh, why don't you run us through your trades?
I have 3 buys to a sell. On the buying side is AU Bank, which made a fresh swing high. Keep the stop at 1,088 here. Look for targets of 1,150. Then a buy on BEL with a stop at 407.9 for targets of 428. And after a long time, HDFC Life gave some signs of reversals on Friday. So this could see a pullback to about levels of 580, 577 thereabouts to begin with. And that's a buy with a stop at 543. And one sell call Maruti after, a long time has come on the sell list. It's stopped below all the key averages. The indicators are negative. So sell with a stop at 13,830 for targets of around 13,200.
AU, BEL, HDFC Life are the 3 buys, and Maruti is a sell for Mitesh this morning. Sudarshan, what about you? Your trades?
Well, HDFC Bank is a buy, and that comes after a long time. It's also an investment buy apart from the swing trade that we talk about here. So keep a stop at 715. Lodha is a buy with a stop under 1215. And United Spirits, which is just coming out of a very decent trading range, is a buying opportunity with a stop under 1525. So I have 3 buys: HDFC Bank, Lodha, and United Spirits. CG Power is the only short sell. It's more an exhaustion. So look for a small correction rather than anything else, but it's a short.
Okay, all right. Well, thanks very much, both of you, Sudarshan and Mitesh, for those ideas. Actually, it's 3 longs for Mitesh and Sudarshan each, and 1 short for both of them as well. So the sell for Mitesh is Maruti, and the sell for Sudarshan is CG Power. Let's put the spotlight on some new age companies. Bernstein is bullish on a bunch of them. Eternal, Swiggy, of course, Titan as well. Which is not a new age company, but it's got lots of new age businesses which are being incubated within it. Jignanshu Gaur is director and senior research analyst at Bernstein. He's with us on the program. Jignanshu, great to have you with us here. Thanks for joining us. Let's just start with the quick commerce space in light of the delay as far as the Zepto fundraise is concerned, Jignanshu, because that's been the big talking point. How do you see it?
Yeah.
And what is Swiggy, for example, has perhaps done, has got a lease of life in that sense. In a manner of speaking, Eternal has done well. What is your view now?
Yeah. Thank you, Prashant, for having me. Always a pleasure. I think mid-year, a couple of months ago, we called that the quick commerce intensity will go down towards the end of the year. And that is simply because the first leg of competitive intensity on store addition has already happened. The second leg, which is customer addition, is also happening. And this is not just for Zepto, but also including Flipkart, Amazon, and all the other players which exist in the market. and hence towards the end of this year, we feel the focus for most of these players will shift towards more sustainable economics. Even with whatever happens on the fundraising for all the players, that focus itself means good growth traction for companies which are existing market leaders. So in that situation, Eternal benefits from any slowdown or any rationalization of competitive intensity. That was our call. That is what we are seeing in the market. The discounts have reduced in the last couple of months for both Zepto as well as Flipkart as the challenger companies who are trying to gain market share. It has also, the minimum order values have also gone up across the players. So we expect the dark store addition rate to slow and the competitive intensity to reduce as we go towards the end of the year.
To what extent, Jignanshu, have discounts come down, say, in the last 6 months? And particularly for Zepto, because that was considered to be the most, offering the most value versus peers. Now that they have a lower war chest, they're looking at only a pre-IPO funding of 1,000 crore rupees. Post the delay in the IPO from Zepto, have we further seen them cut down on their discounting?
So our proprietary grocery tracker shows that the discounts have come off by around 400 to 500 basis points for most of the players who are very aggressively discounting. The discount drop has been highest in grocery, whereas the non-grocery item discounts have sustained at a higher level, yes. So in the recent last 1 to 2 months, we've seen 400 to 500 bips of discounts coming off.
That you would attribute to the delay in the Zepto IPO. Also, what about the fact that Amazon, Flipkart minutes are scaling up very aggressively? You yourself have called it like a chaotic phase for quick commerce.
Yeah, so I think the dark store addition chaotic phase is slowing down now because all players have reached a certain minimum threshold of dark stores required to physically cover the consumers that they want to target in the large cities. And that sort of threshold is, let's say, around 1,000 dark stores. And many of the players are above that or reaching that stage. So incremental dark stores will not add volumes to get to a better profit margin. The current dark stores need to be sweated more. So that's where I think the focus will be, is to sweat the current dark stores rather than adding them. And hence, part of the chaos is behind us. The discounting part of the chaos, I think, will still remain. And we do think it will be more tactical now. The focus will shift towards retention rather than acquisition of customers. And which means that the discounting approach will also be a little bit more tactical, which is give more discounts if you build larger carts or discounts if you come back to the platform again, rather than consumer acquisition discounts. So that's where the chaos is we expect it to reduce. And frankly, the reduction is faster than what we had earlier anticipated.
One space where we don't often talk about the impact of quick commerce is on beauty and personal care products. Because now a lot of the replenishment products, like your daily moisturizer, shampoos, etc., can be ordered in 10 minutes rather than going to a platform like Nykaa. But Nykaa has been reporting very resilient numbers. In fact, the stock itself is at a 4.5-year high. So do you really see an impact on the BPC space, which Nykaa is dominating, on account of quick commerce?
So we don't have formal coverage on Nykaa, and hence we'll avoid commenting on what it means for Nykaa. What we look at Blinkit, Swiggy, yes, there is increasing interest on their side to capture the BPC demand as well. In addition to other non-grocery, they do offer close to 5,000 to 7,000 SKUs on BPC. And I think their intent is, yes, to capture part of the replenishment demand, especially for basic skincare and possibly body care products. That seems to be the objective. Would not be able to comment on how it impacts Nykaa as of now.
Jignanshu, just request you to stay with us. We just got some news at the bottom of your screen. The Indian hotel stock will be in focus, as well as Oriental Hotels, because they have approved, a merger. So Indian Hotels will be in focus, as would be Oriental Hotels as well. That's a listed company, actually. And Indian Hotels has 28.5% stake in that particular company. We'll wait by for the share swap. But Oriental Hotels is listed. I recall Mangalam and myself, we pushed Puneet a little bit to about this itself. Will there be a potential merger between the two? And that's precisely what's happened. The street has been speculating this for a while. There you have the ratio. Indian Hotels will issue 25 shares of the company for 117 shares of Oriental Hotel. As I said earlier, as does Indian Hotels had 28.5% stake in the company. So Mangalam will join us to give us further analysis. But that long-awaited merger has finally taken place. To give you a number, the market capitalization of Oriental Hotels is around 2,500 crores or thereabouts. So we'll wait by for further details. Jigyanshu, I'm not sure. Do you track Indian Hotels?
No, we don't. Hospitality is not something we track. Yeah.
Nigel, I think I'm just looking at the website. I mean, this is, as you said, this has been in the market for a while, that perhaps it's a matter of time. I mean, the Oriental Hotels website says they've got about, at least it lists 7 properties, 7 hotels. It includes the Taj, Coromandel, Chennai as well, apart from a bunch of other sort of names. So Vivanta, Coimbatore, I mean, and so on and so forth. So this is, of course, a consolidation, perhaps, which was being anticipated, which has come in as well. As Nigel said, we'll have Mangalam come up in a bit to talk more about this in some detail. But let's continue the conversation. Jignanshu, I mean, in your report, in a recent report, you are talking about how the first quarter across your coverage universe, while it's been strong, it's kind of lagged the showing in the fourth quarter. I mean, it's been weaker compared. The momentum has been weaker compared to Q4. You're also saying that based on some trackers, etc., the month of July has been pretty weak, right? So, I mean, how should we read this? Are you saying, well, there is a slowdown coming, or what?
So, see, we think that the macro data for consumer is showing far more weakness than the results of consumer companies in first quarter. And hence our expectations for the first quarter across most companies were softer than what they ended up reporting. What has happened so far, and from a more macro perspective, is the government balance sheet and possibly some of the OMC balance sheets have taken a lot of the macro pain, primarily the fuel price and inflationary pain. So that has not been translated to consumers now. And hence consumers are not feeling the pinch as much as we expected. However, when we look at July data and we track UPI data, which shows merchant category classification-wise spends, they are indicating that July was pretty soft compared to June and compared to May and compared to April earlier. So there has been a declining growth rate on a YOY basis, which shows July data. July consumption patterns were soft.
All right.
Does that mean some of the pain is finally translating? Possibly. Given that crude is again back up to $90 or thereabouts, does that mean eventually more pain might come to the Indian consumer wallets? Possibly. So in this state, what we think is at least discretionary consumption will have some challenges both from demand but also from cost inflation. So that's where we are a little bit more cautious. And hence we support companies which are more doing channel shift rather than assuming that consumers need to spend more. So companies which are driving channel shift are the easier growth companies in the next 2 quarters or so.
Which ones particularly, Jignanshu?
So Eternal and Titan are the 2 big ones. So Eternal, Swiggy, Titan. So most digital players who are driving offline to online shift. Titan specifically because it is driving something which we believe the government wants, which is more formalization of the gold sales in India. And as the market leader, it remains to benefit well. And gold price volatility is actually much better for Titan than it is for many of its competitors.
No view on Kalyan? No view.
We don't cover it formally.
We don't cover. All right. Okay. Thanks a lot, Jigyanshu. Always good to have you on the show. Wishing you a good day ahead. And we look forward to catching up with you rather soon. Well, let's get Sudarshan back on the show to get his 9:10 call out of the way. Sudarshan, go ahead.
United Spirits, buy United Spirits with a stop under 1525.
Got it. Mitesh, yours?
I'll go with a buy or HDFC Life for targets of around 577.
Okay, thank you, gentlemen. One stock we'll be watching today is Hexaware. The company held its AI Investor Day earlier this weekend in Chennai. And this was basically the company was talking about AI. For the first time, the CEO has spoken about the extent of AI contribution. So they're saying more than 50% of the company's revenues are already AI infused. So that's one big number. Secondly, a lot of reports are talking about the company has stated an ambition of achieving, hitting $3 billion of revenue by FY29, but that was not said by the company in the conference call or in the investor day. So just clarifying on that. What the company is talking about, the new TAM, that's the total addressable opportunity, which is opening up on account of AI. Not putting a number, but broadly saying $300 billion plus, which is similar to what Infosys Nandan Nilekani has spoken about. So two numbers, there is a large TAM, $300 billion plus, and more than 50% of the work that the AI company does, the revenues it gets is AI infused. Not directly new AI revenues, but it's benefiting from some sort of AI. Some opportunities they are talking about. One, of course, is they're saying that there is an opportunity to replace existing SaaS models. So SaaS is a very large model. They go into detail on how this works out, but they're saying that potentially the SaaS market can get displaced. So that is an opportunity. Secondly, they spoke about data being ready because 60% of the AI proof of concepts, pilot projects fail because their data is not ready. So data readiness is an opportunity. And the third one is managing, governing the AI agents. As AI increasingly does the work, we need someone to manage it and figure out the security around it. The brokerage view on that is a bit mixed. You've got an underperform from Jefferies going up to an outperform from CLSE as well.
Okay, well, keep an eye out on that name as we open up this morning. Well, the FTSE semi-annual review will be in focus, and Vivek has got details on this one. Vivek, take it away.
Well, that's right. Post-market hours on Friday, this particular index changes were announced. The announcement date was on August 21st. The adjustment date is on 18th of September. So a whole host of stocks from the Indian, basket have been added to the FTSE all-cap index, and most of the flows that we are indicating are as per analyst estimates. So some of the stocks that have made the cut this time around and that will have meaningful inflow include names like Acme Solar, Anthem Bio. Cube would expect to see inflows of close to $50 million over there. Also expect to see large inflows of $37 million on Urban Company and a whole host of other names that are there on the screen. Along with that, there will also be weight increases seen across 5 main stocks, Meesho as well as Lenskart and Grow. A whole host of the stocks that have recently seen quite a few large block deals have increased headroom, on the back of which there will be weight increases taking place over there. And Infosys as well as Airtel too will see weight increases. All of this will happen on the 18th of September 2026.
Got that. And 18th of September, right?
That's
Vivek?
right. That's right.
18th of September. Okay. We've got a minute to go for the market open to come up, and we'll just sort of look at the rates as they start to appear. The large cap indices, and then of course the 50 stocks, and then we look at broader markets as well. The Nifty settled 30 points higher in the pre-open. 24,280 on the Nifty. It's about 0.1% higher. The Nifty Bank is up 0.1 actually. Yeah, 0.12, 0.13. The mid cap index is up 0.14, and the small cap index also should be somewhere around that. A bit stronger, about 0.25% higher in the small cap index. The Sensex is up 0.25% at about 77,720. So those are the big sort of indices and the rates which are coming up. The Nifty 50 heat map will give you a sense of what the 50 stocks are opening up like, and I think we can move on from there. So Hindalco is the top gainer. It's followed by HDFC Bank. You have Mahindra & Mahindra, Coal India, Kotak Bank, etc., which are starting higher. It's a mixed kind of a picture. Apollo Hospitals is down. Bajaj Finance is lower. Bajaj Finserv is down. Adani Ports and Sun Pharma are some of the other names which are in the red at this point in time. 50 points, which is basically just under 0.25% on the Nifty. 24,300. Prima.
Well, it's another quiet opening, but with a positive bias. The advanced decline ratio is 5:2 to begin trade with. The Vishal Mega Mart is popping up in terms of very large volumes straight away at pre-open, at open 8.5% higher on that. Volumes have already crossed nearly 80 lakh shares in the first few minutes. So that's a stock. All cargo logistics, again, large volume stock is up, pop nearly 12%. Apollo Tyres, where UBS gave an upgrade to a buy rating, so that's a bit excited in trade. Orient Hotels should come up on the screen on the back of the news with Indian Hotels. Orient Hotels has opened up in the green, and some of the sugar names rallied on Thursday, declined on Friday, saw profit booking, and today also up and about in trade. And Shanti Gears is getting bid up. On the way down, you've got softness coming through into transmission. Very good listing last week, but the stock is correcting a bit. Ship Rocket, another one, big move last week. Stock has opened up lower. Bank of Baroda is subdued in trade. Edelweiss Financial and Dixon Tech too, despite the official notification coming through for the mobile PLI of 62,500. Dixon Tech has opened with a cut of 1%.
Well, that's right, Rima. A few stocks that are flying away actually. Vishal Mega Mart, that's the big stock actually of the morning, because Guninder Kapoor has been reappointed as the MD and CEO for a period of 5 years till 2031. His term was expiring in June 2027. The market was fearing that maybe he wouldn't be reappointed. So this is good news. That overhang is off. Remember, he was brought in by TPG. And, the street would have liked him to continue at the helm, which has precisely been the case. So explains why that stock is flying away. A few more notable movers actually from the broader markets. Finserv Chemicals stock has been on fire. This month it's up closer on 30%. It's a 50 rupee stock right now. Volumes are very, very large for the initial part of trade. So that one is up and about in today's trading session. Another one that's catching the radar is actually, Balu Forge. That stock is up closer on 10% as we speak. So big move out there. Tube Investments, you had the promoter entity going ahead and increasing stake. And that's why, in fact, that one saw a big run in Friday's trading session. It's seeing some follow-through buying even in today's trade. So good move out there. Happy Forgings has come in for some profit taking, but volumes not too large out there, as is the case with Sanghi Movers. Both of them have been big movers. They have come in for some profit taking early this morning, guys.
Okay, well, lots of stuff moving around, but quieter, of course, as compared to how things looked during the earnings, season, which wrapped up about 10 days back now. So 55 odd points. But here and there, you got these shooting stars. Vishal Mega Mart, of course, is hogging the limelight with that 9% move, which has come through today. So that's the one. Well, we have Sailesh Rajbhan, CIO, Equity Investments at Nippon India Mutual Fund, with us on the program. Sailesh, good morning. Great to have you with us here. Thank you for joining us. It's been a while, so it's good to see you. Just run us through, your views, your sort of, broad setup, because a lot has happened. Q1, I think, has been stronger than what many expected. Just now we were talking with a consumer analyst who was saying that compared to the macro weakness, it didn't show up in Q1 earnings. That's been good. And hopefully Q2 will be more of the same. But where are you at, Sailesh? As an investment house, your views from here?
Good morning, Prashant. Thank you for having me. Prashant, like you rightly said, many things have changed, and I think they are changing for the better after a long, long time. Let us take the results themselves, right? There is this first time we have seen broad-based results improvement across categories. And this is coming, of course, on a low base, but we think because the base still remains low for some period of time and the GST benefits are already flowing through in the system, the visibility of earning improvement seems to be much, much more than it has ever been in the last 2 or 3 years. So the fundamentals, which are the earnings which drive markets, I think they are falling into place after 2 or 3 years, which I think is a very, very positive sign. Second, in this period, you have seen, especially in the last 6 months, substantial foreign investor selling also in India, right? And this foreign investor selling for various genuine reasons of global markets offering better opportunities, our markets being expensive, I think has created very good, sensible prices and valuations for very high quality, world-class businesses. And I think that also means that when you have a starting point of valuations in your favor, when you have earnings on your side, then I think the probability of better outcomes over the next 3-4 years remains or increases dramatically. And I think that is where we are in. In spite of all the bad news in the context of the Middle Eastern war, the energy crisis, the challenges which came around that, and the currency depreciation, we have still seen companies report very strong numbers in this period, right? And ideally, if one would have looked back and said that these would be the conditions, would earnings improve in this period, people would have said no. So I think the recovery in earnings seems to be resilient and should actually feed into the further growth in the system, growth in the earnings further as well from here on, which means that we can look at earnings trending maybe about 12 to 15% over a 3-year period from here. Obviously, we are all open to global disruptions and challenges, but leaving that aside, because every risk cannot be factored in while investing, right? So I think we are getting world-class businesses, sensible prices because of certain reasons, a lot of them external. And our underlying fundamentals actually improving over the last 2 or 3 years, or the last 2 or 3 quarters versus what they were about 2 or 3 years back. So this is where we stand today.
You know, this next question is not so much about, like, it's not a clean answer, right? I mean, for a large equity house like Nippon, it can't be large caps, only large caps, or only small caps, or only mid caps, right? I mean, it's always a balanced thing. But because you said that foreign selling has created attractive price points for some high quality businesses, you know, it used to be foreigners, I mean, at least the large global houses were in sort of, you know, large caps, and of course, I mean, some of the large mid caps, etc. as well. You know, if you were to plot it in terms of on a market cap curve, are you finding more attractive opportunities in the larger businesses now, Sailesh?
Yeah. So if you look at the curve, right, from a point of view of valuation versus the earnings, which reflects the attractiveness, you would find that 2 years back, there was only selective attractiveness in large caps, while mid and small caps were extremely expensive. Today, as we see the curve, right, we have seen that valuations have corrected broadly across the board. I mean, you know, if indices are rating all-time highs, they are still broadly plus or minus 5% from their all-time highs, right? So I think from 2 years of consolidation, 2.5 years of consolidation across capitalizations has created sensible prices. Today, even in small caps and mid caps, you can find businesses with available at 18-20 multiples with 15% growth rate, which was not the case before, right? And growth rates themselves were lower and multiples were higher. So I think the construct is changing across the markets, and hence valuations are getting have seen deep cuts over the last 2 years across market caps. The additional layer in large caps has been significant foreign investor selling, which is generally concentrated in select financials and those spaces. And there, the valuations have become even more attractive than they were in the past. So I think the overall market cap curve in terms of valuations across has been getting far more sensible, and more so, even more sensible in large caps because of the sell-off which has happened, which is specific to that category.
Hi, Sailesh. Good morning. Good to see you. And Sailesh, do you think then the headline index as well will move up from here on? Because, you know, as you said, we haven't seen any kind of move in the last 2 years or so, and it continues to remain a stock-specific market? Or do you believe the index itself as well is ripe for a bit of a move? Because if I look at it in the last few months, the mid and the small caps have done very well, but the headline index is still flat or maybe marginally lower.
Yeah. Interestingly, I think it's been nearly 2 flat years, right? Virtually no return in the larger indices as well, right? And you know all the factors which have been there. So let us look at how things might change in the next, say, 6 to 12 months for this to have outcomes which are different. First, the starting point itself has compressed valuations by close to 25% in large caps, about 15-20% in mid caps, and close to 20% in small cap companies, right? And this compression of multiple, because earnings have been rising in a period of flattish markets, right? So that has compressed multiples fairly reasonably. Second is we are seeing now earning recovery, which after 2.5 years is getting stronger because the benefits of earlier tax cuts, which is the GSTs and the income tax cuts, have started to reflect in it, right? In fact, we are seeing sectors like, you know, consumer staples and all that, where volume growths have been very, very poor for the last 2.5 years, starting to improve with a lot of internal actions companies are taking and also some improvement on the rural side of it. So underlying indices after this consolidation at least have limited scope for derating unless some large global event happens. And I think an earning-led recovery in indices is certainly a very high probability case in the next few quarters.
Okay, all right. Let's get to themes then that you like, Sailesh. You know, in the past, you had told us that I think pharma consumption themes were something that you liked. You know, that's played out quite well. You know, discretionary spend, discretionary consumption has done pretty well. And pharma actually has been one of the outperforming sectors of this year itself. What's the view right now? If you were to give us 2 themes, you know, at current reckoning, what would it be?
Let us start off with the most hated sector today, which is private sector banks, from a multiple construct, from a business construct point of view. Very rarely you've been finding these entities at this kind of valuations, I think. So that creates a very sensible space to be in. And hence, private sector banks, large, high quality private sector banks, because of whatever reasons are available at these multiples, which are maybe 1.5 times and all that, and somewhat closer to a PSU bank multiple. So I think there is an opportunity which is there. Second space is consumer discretionary. See, this is one space which has suffered materially in the last 2.5 years. One, because of high starting valuations earlier, and also growth being very patchy. Rural was suffering, urban was suffering, and then there was a lot of challenges there. I think now with general growth recovery across, and valuations there for that space having corrected materially, there seems to be reasonable value available. Today, you're finding businesses in that category available at, say, 15 times, 20 times operating profit, which though not very cheap by traditional parameters, but very sensible for the under-penetration of a lot of those categories. So consumer discretionary.
Shailesh, you're talking about the auto companies, etc., right? Not the FMCG ones.
Yeah, I'll come to, So this is the consumer discretionary, more referring to consumer durable spaces, other discretionary facts where, in this you would find hotels have also corrected, other services have been getting fairly sensibly valued today. On the consumer staples, which is where the big question is, right? I think valuations have become fairly sensible there also. So you've seen volume improvements coming across categories now for the first time in many years, right? And second, I think their valuation compression has been massive with 7-8 years of zero return for a lot of companies. Today, these consumer businesses today, though the growth rates appear sub 10% on a revenue basis, but I think starting to inch up, I think you would find some of these businesses at 20 times operating profit extremely sensibly priced. And these are businesses with a longevity beyond we can imagine. Other challenges there in terms of competition, I think competition is real and will remain forever. But these multiples make them very interesting place to participate in.
Okay. Okay, got that. So we've gone through the private sector space where you think valuations are quite attractive now, especially because there's been so much foreign selling. Consumer discretionary is another area, and you're saying that the consumer staple names have also had a long period of consolidation now, right? And valuations, I mean, they're no longer at 70, 80 times. They are coming off. But they maybe 40 times still expensive, but compared to their own history, not that expensive anymore.
Interestingly, while the multiples would appear at, say, 30 times for consumer staple names and all that, the growth expectations when people are penciling in are absolutely low, right? I mean, people are talking about single-digit growth recovery is not being imputed. And we have seen when earnings rebound, the cycles surprise on the upside as they surprise on the downside. So I think that seems to be the possibility in some of those businesses is what we see.
So it's unreasonably low in that sense. I mean, there's nothing being built in. So these valuations will look more palatable when there are surprises on the upside. Okay, let me. You said you started by saying private sector banks is the most hated. There's one more candidate up there. Maybe not most hated, a strong term, but IT services. What's the view, Shailesh?
So another space where, correction has happened dramatically in the last 2 years, 2.5 years, and possibly one of the worst performing sectors in that period. When you look at the construct today's valuations are not even imputing anything. There is no growth recovery expected. There is no, everything is AI, and nobody's talking about any recovery or growth on the services side of it, right? So expectations here are fairly limited. But what is interesting to note is somebody has to make the economics out of this AI work, right? And I think AI services will actually be a big play, or AI solutions, you might call it today, will be an important play where some of these companies will certainly participate in. So I think growth expectations are fairly low. And I think till the numbers start reporting, obviously, you may still have valuation being capped for these businesses. But I think the valuations just not capture even a single-digit revenue growth for these businesses for the next 3 to 5 years. So I think it's assuming that this is a declining business for and markets have decided that these are declining businesses forever. But I think some of the AI companies which transition themselves, the services they are able to bring about around the AI infrastructure which is being built, I think would mean a lot of new business for the incumbents. So I think there is an opportunity there. and valuations are totally undemanding, as you all know.
Okay. What about this entire power transmission capital goals? I mean, I think you've got a fund catering to that as well, that entire segment as well, right? Again, here, I don't think you can make the case that valuations are undemanding. Go on, Sailesh.
So here it's the reverse case, like you rightly said, Prashant. So here the challenge is markets are pricing in fantastic growth or for these businesses, especially in power equipment and transmission businesses. Yes, the outlook, and when you speak to managements, they do talk about a longer cycle than ever before, 10-year cycle, 7-year cycle and all that. But I think at 60 multiples, 65 multiples, a lot of these businesses are virtually priced to perfection. Only space where there is sensible value within this category is the power utility space, where I think there is a significant growth in power demand. And I think you would have these businesses at very reasonable valuations today. Post the correction in the last 12 months, that space appears to be sensibly priced. On the overall industrial side of it, we are seeing businesses getting overvalued fairly quickly. Fantastic re-rating has happened in some of these spaces. And I think we are finding valuations actually factoring in a lot of the good news for the next 2 or 3 years in this particular space. So this is space is where one has to be very careful as investors.
Just one last, and this is not, this is, I mean, you know, these gold and silver, the precious metal ETFs, right? Any view there? I mean, there's more asset allocation and, you know, that kind of thing. But a year and a half back, they were all the rage. They're not anymore. But again, any thoughts?
I think there were excesses last year. I mean, all of us know, at least in the first part of this year as well. And a lot of those excesses got corrected. And we are now in a normal zone where, you know, allocation roles can be played by these precious metals within portfolios. The way the complexity globally is in terms of the variety of factors which keep moving and the kind of volatility which we have seen in global markets, as well as I think all this means that the role of gold and silver as asset allocators remains to be very, very high, or as asset allocation partners within the portfolios remain very, very high. Whether is there a case for substantial rallies in this? I think at this point of time, we don't have a view on that construct in the sense that very aggressive view in terms of returns from these categories. But I think as role from an asset allocation point of view, they remain as relevant or even more relevant than they have been in the last 6 months post the correction which happened in these categories.
Okay, we leave the conversation here. Thank you very much for joining in. Let's talk about the big merger taking place in the hotel space, Indian Hotels and Orient Hotels. Mangalam joins in to tell us everything we need to know. Mangalam.
Well, this was long coming, you know. It was Oriental Hotels and Indian Hotels, both parts of the same group company. Oriental Hotel obviously has a few marquee assets in the southern part of the country, which include the likes of Taj Coromandel and many others. And now it has finally been announced where Indian Hotels will merge Oriental Hotels with the company. The swap ratio, 25 shares of IHCL for about 117 shares of Oriental Hotels. Just basis the previous close, this ratio values Oriental Hotels at about 8.5% premium to the previous close prices, which is why we're seeing a slightly bigger move on Oriental Hotels. But the street was anticipating that. What this basically does immediately is adds about 8 to 10% sort of revenue to Indian Hotels. Their last year revenue was 5640 crores. This year Oriental Hotels was about 500 crores. And the net worth is an addition of almost 500 crores versus Indian Hotels at around 12,800 crores. The company says amalgamation will create synergies among these businesses. Importantly, it paves the way for Indian Hotels to go ahead and make more investments in the assets of Oriental Hotels as well, some of which are crown properties as well. The additional part is that their margins could improve because Oriental Hotels close to around 21% margins as against Indian Hotels, which is at around that 30%. So 900 bips of synergies is something that the street will be looking at as well. Because the street was anticipating this, we had spoken about this to Puneet Chhatwal after their first quarter numbers, and he said whenever an opportunity comes to simplify, we will look at it seriously because this creates greater agility in decision making, helps improve performance, and it also becomes easier to invest behind a brand when it's within the same entity. So the rationale was explained earlier. Now the merger has been announced.
Thank you very much for that. HCLTech, a stock we were talking about earlier on the back of that AI Investor Day, That's, by the way, trading quite strong. It's a 5.5% up move on the company right now. HCLTech, let's get that up. Moving on now, Mangalam, thank you very much for that. Moving on, Bhaskar Rao, Chairman, Managing Director at Kim's Hospital, is now joining in. What we'd like to discuss with him is the Parliamentary Committee recommendations, occupancy, RBOB outlook going ahead, and the CAPEX outlook. Morning, thank you for joining in. How about we begin with the big pressing issue? The Parliamentary Standing Committee, they recently tabled a sweeping report covering from pricing, insurance, diagnostics, foreign investment in hospitals. What's your own assessment? It's, you've had 2 weeks to digest it. We did a large hospital town hall on CNBC TV 18 on this issue. But give us your nuanced takeaways.
The entire thing that what we need is whatever is the parliamentary has been decisions made, we need to be able to look into few angles. One, healthcare is always capex oriented. The second important thing is it is a human resources oriented. In these two aspects, that means we are creating a lot of employment, and the employment when we created more dependent on the so much of employment. And year on year, the minimum wages and all those things, we need to be able to look into that. And the capex cycle is also keep on increasing. Not only in the civil constructions, there is a latent technology that is coming to create a precision surgical procedures or medical thing. And with those things, we need to be able to invest a lot of money on technology. And both operationals and capex is very high. Even though whether we are always looking at a loss, that is the average length of stay, how we can able to cut down by using this technology. And at the same time, unless we keep on catching up the requirements towards the globe, we may not able to service the better quality care to the patients.
Got it.
With that, definitely the prices will go up.
Yeah. Apologies, sir, Mr. Rao. Good morning, Prashant here. May I request you to just wait, sir, for 5 minutes with us, if I may. So there's news this morning with regards to a sort of corporate announcement. So we just want to cover it since it's just come about 30 minutes, 40 minutes back. So thank you very much, sir, for that. Mr. Puneet Chhatwal is now with us. And he's MD CEO, Indian Hotels. Mr. Chhatwal, good morning. Great to have you with us here. Thanks very much for joining us. The merger of Orient Hotels with Indian Hotels, Mr. Chhatwal, could talk to us a little bit about this. What prompted this action? And, tell us what synergies will you be able to extract out of this merger?
Good morning, Prashant. For 5 decades almost, we have had a great partnership with Oriental, and some of these companies, when they were made at that point of time, is how business was done. And with 7 hotels in the portfolio, a company which has done well entered into the 3rd generation, and I think they were looking for opportunities to encash. We were looking for opportunities to consolidate, simplify our business model. There is a lot of corporate effort that goes into having listed entities. So merger was a good option. Using stock as a currency was a good option. And also, what we have done quite interestingly for the sector in the last 5-7 years is using asset management initiatives, especially the 3 of the 7 assets in Oriental are freehold assets that we could reposition, take them a notch higher, spend monies that we have, which Oriental does not have so much money in the company, to reposition, to kind of sweat them more in the interest of our customers as well as in our ownership. So all in all, we are very pleased to simplify. And this is a series of efforts we've done, divesting a stake in GVK, consolidating and making Roots Corporation, which has Ginger as a wholly owned subsidiary. This is the 3rd significant one to follow.
Okay, and we'll ask you what's next after this, but let's just get this out of the way, Mr. Chhatwal. So, again, synergies, Mr. Chhatwal, what can we expect? I mean, you're an operations person out and out. I mean, there's capital allocation, and then, of course, there is operations to kind of sweat it as best as possible. So what should we expect?
One of those important things is the opportunity cost of time of the management. The bandwidth that it takes in 7 hotels in a listed entity is far too big, and I think we can use the time much better. Number 2 is obviously the cost of running a listed entity are much higher, so any kind of 7 to 8 to 10 crores of savings in there. Number 3 is growth opportunities, as I mentioned, from asset management, especially on Taj Coromandel in Chennai, which has been a market leader for several decades, followed by Fish Cove in Mamallapuram, which is a phenomenal resort asset, as well as the Gateway in Kunur. We recently renovated the Malabar, so that's still ramping up after a complete refurbishment. And same was done with Vivanta Mangalore. So all in all, I think we have a good opportunity to enhance the top line by 10 to 20% over the next 3-4 years, and obviously have a significant improvement to the bottom line, because we will not need so much of management and so much of governance related costs going forward. And all these assets are a natural fit, and brings in 3 more freehold assets into our portfolio, some with significant amount of land, and another one which has been sitting there and doing nothing in Tamil Nadu, where we think we could build a Gateway or a Ginger.
So needless to say, sir, this will be EPS accretive from year 1?
Yes, it is EPS accretive from year 1.
And have you all done the math? To what extent? Because there will be some dilution also.
Yes, there is a dilution of 1.6%, but the maths has to be done as good government companies. Both OHL and IHCL have gone through that process, in internal maths as well as through the advisory appointees for both companies.
Okay, and what's the timeline, sir, for the completion? Step by step.
Completion may take anything between 9 to 12 months. So all the filings will be done, and we'll follow the process, and appointed date, what we feel we would aim to get to is 1st April. So we start the financial year with the full benefit of consolidation.
All right. Hi, Puneet. Congratulations. Next time, Mangalam and me will wonder what to push you at. Because Taj GVK is done. Now, Oriental as well is done. What's next? Any more simplification in store?
Simplification is an ongoing journey. We are a 123-year-old company with 125 AGMs. So I don't think simplification will ever come to yes, it's all done now. There will always be something left to be done. But I do believe that with the kind of cash we are accumulating, with the kind of CapEx investments that we are making into new projects, if any other inorganic opportunity comes up, it would really be a meaningful deployment of the cash that we have.
Do you have your eyes set on something? Should we be hearing about inorganic growth, say, in the next?
Yeah, always eyes are set on anything which is good. As JRD Tata used to say, anything good for India and anything good for the company is what we should go for. That principle is followed.
Oh, this is interesting. For the first time, you're giving us a bit of a hint that inorganic could be, something that could be brewing, actually. It's a strong hint coming in from you.
Yes, Nigel, there is always a first time. So
what could the size be?
Anything which is affordable. The size could be, we have 4,500 crores of cash.
Yes.
So we want to keep a watch list for any kind of bad times, unforeseen bad times that may come. And that could be 50% of that money. Another 50% goes into routine capex as well as new projects. But we keep accumulating cash in the quarter by quarter and years by years. So I think anything up to 2,000 crores is for us today not a big amount to think about. And also I must say that the going has been very good. What we discussed the last time I was on your channel, I think there was some misunderstanding in terms of our top line guidance. I think Mangalam was able to pin me down on that. And I think what I said at that time, 14 is minimum, but with a bit of luck, we could get to 15. So I think we're still very much in line with that of 15% plus top line growth.
All right. And this inorganic opportunity of around 2,000 crores, should it get closed out in this fiscal itself?
So I try to dodge the question.
Yeah, but I need to bowl back, right? 6 balls I get. So, you've dodged a couple of them, but you'd have to bat a few as well.
You are getting me on to see these opportunities have to make sense. We don't have to just go in for any opportunity. Whenever anything comes up which makes sense, we will look for those, those kind of positioning scenarios in terms of various brands that we have and the kind of backing they may need, which Indian Hotels has the ability to provide today.
One more hint. Is it a listed company?
No, there's nothing, Nigel, but if there would be something, you'll be the first ones to know.
We'll have to work the phones after this, to find out what's on the block. But just one more question. Margins of this, Oriental Hotels is around 21%. And the aspiration would be to take it closer to what Indian Hotels is doing, right?
The expectation this year, Nigel, is 27, and we are very much in line or ahead. But going forward, sorry I interrupted you, but I think I would just answer it. Anything which is closer to Indian Hotels, 35% or 30% plus. So a bandwidth of 30 to 35 is what we'll aim for.
Got it. Puneet, there is Banaras Hotels, right, which is also listed entity owned by IHCL. Will we see something similar here?
It's a holy town of Kashi, and with the blessings, we could see at anything. But at this point of time, there is no such consideration. We have been busy with this one, so we have finished this, and we'll talk about other opportunities, whether it's Banaras or other outside the company, outside our system, in the next 6 months or so.
Yeah. So this will be, whenever you do it, it'll be like a fold-in, right? Of Banaras. I think that operates one property, right?
No, it has 3. It has Taj Natsar Palace, Taj Ganges, which has recently seen an expansion, and the Ginger in Gondia. So it's a small, very small company, but it has always done well, and it has always been a very lucky company for us. And you see that in the way, the share price as well as the market cap of that company has grown.
You are, and so this will happen whenever it happens, but what you are strongly suggesting is something outside. And you said you'd be comfortable spending up to 2,000 odd crores, right, on an acquisition.
That's correct.
Okay.
We have the means, and by doing that, we still don't come to even 40% of our cash reserve, right? So that's the logical way of us looking at it. And the second is, if you see, last year we did a series of external ones, small ones, Ank, Pride, Atmantan, followed by Bridge. And now we have done from within the system with OHL. So there will be a good, healthy mix of things outside our ecosystem too.
Got it. I'm looking at companies, lots of companies, listed companies, hotel companies, up to 2,000 crores in market cap. I mean, I could go one by one and tick it off one way or the other. Should we do it?
Yeah, no, I think a cup of coffee. You don't want me to occupy all your airing time.
No. I mean, it's our pleasure, Puneet, as always. Thank you very much. We will chat more, and really appreciate you coming on this morning with, the action on Oriental Hotels. Third simplification, as you put it. We'll watch the space for more. Thank you.
Thank you. Thank you for having me.
Okay, well, that is Puneet Chhatwal of Indian Hotels with perspective on the rationale behind the folding in Oriental Hotels, where the group already held a significant minority stake. I think listings are coming through, so it's 950 almost. Horizon Industrial Parks is listing pretty much at the issue price of 60 rupees. It's settling, by the way. 10 o'clock it'll start trading. This is the pre-open. And Lalita Jewelry, look at that, 265 compared to 201, which was the IPO price for that one. So interesting, two listings, which we will talk more about in a bit from now. We'll, I guess, take a quick commercial break here. We'll connect with the management of Symbiotic Pharma Lab as their issue opens for subscription today. Stay tuned, coming up.
Welcome back. Well, the IPO market is heating up, and we have another, company that's coming to the market, Symbiotic Pharma Lab. The IPO is around 1,757 crores. It opens today. The fresh issue is around 150 crores. The remainder is then OFS. The proceeds will be used for debt repayment and also general corporate needs. So, well, we have with us Mr. Anil Satwani, the chairman and managing director of the company, and joining him as well as Mr. Raghavinder Ramachandran, the CFO of the company. Hi, gentlemen. Good morning, and all the best with regard to this issue. Well, our viewers will be interested to know a couple of details. Now, 150 crores is the money that comes into the company since it's a fresh issue. Part of that is going to be used for debt repayment. So how much of that will be used for debt repayment? Post this debt repayment, what's the pending debt in books?
Yeah, let me take that. Hi, good morning, everyone. We've invested more than 850 crores over the last several years, just to give you a context. And all of this investments have gone towards new business segments, which will start delivering growth from the next financial year onwards. And large part of this investments, about 800 odd crores, while it has been funded by internal accruals, a certain part of this has been funded by debt. So as we speak, the debt as of 31st March 2026 is roughly about 380 crores. And through this 150 crores of primary from the IPO, we expect to reduce it further.
So it comes down to around 230 crores odd.
Yes, yes.
All right. Since you mentioned, sir, that you've already done a capex of around 800 crores over the last few years, which is via internal accruals and partly debt as well. At optimal levels, what could your revenue scale up to? Because we want some kind of a roadmap with regard to growth. And we're not asking you for a fixed guidance, but what is the revenue potential that you can go to, given that you're already doing close to around 1,000 crores of revenue? And you've already done 800 crores of capex. So there'll be an asset turnover there as well, right? So optimal revenue potential for the company is what?
Yeah. So just to give you a context, while of course I cannot talk numbers and give a guidance, but on our API business, steroids and hormones business, where we already have roughly about 900 odd crores, this comes at an asset turn of roughly 1.5 to the assets. So that gives you a sense on a business like API, where we already have 1.5 times the asset turn. We have put in 870 crores in very niche business segments. One is the complex injectable, the other is the CDMO fermentation, which from our standpoint is more accretive to the existing business. So you could do the math, roughly about 800.
Mathematically, sir, you could potentially double your revenues from here. Revenue potential, we're not asking about a guidance, but mathematically going by what you're saying, at that sort of an asset turn, you could potentially double your revenues without incurring much capex. Fair to assume, right?
Yes, we could potentially, right.
Okay.
Yeah, absolutely. And on this note, just please be assured that our operating surplus cash flow that we have year on year, we continue to remain committed to do further capex year on year. So all this will eventually lead into the revenue growth forecast in the coming years.
Mr. Satwani, today 96% of your revenues comes from APIs, but you all spoke about how CDMO and complex injectables is opening up as a growth opportunity. How are you looking at the mix of the company's revenues going ahead?
So look, historically, we have been an API company focused on the steroid and hormones, where we have the global leadership in this niche segment. And this is where our primary revenues are coming from. However, having said that, and since last year, as my CFO Raghav just mentioned, that we have made a significant capex in two different growth engines. One, the complex injectable as part of our specialty pharma, part of our forward integration that we have taken up. The second, of course, is because we believe that the fermentation science is going to move mountains in the coming years as a synthetic biology, as a cutting edge tool that has evolved over a period of time. So we have invested heavily onto the fermentation CDMO businesses as well. So both these engines are likely to fuel growth in the coming years. And these are where the capex is actually behind us. The proof of concept is behind us. We are just waiting for these two big opportunities to get monetized in the coming years. So going forward, you would see all three engines blazing growth. Of course, the base business will continue to deliver a certain amount of growth. The two new growth engines, the complex injectable and fermentation, will become as big as the steroid API business in the coming years, certainly for sure.
Got that. Just a quick word, Mr. Satwani. Good morning, Prashant here, to both of you. This question though for Mr. Satwani, we got some numbers here. So it says you are leaders in. I think this is cortisol, right? I mean, essentially drugs which are.
Corticosteroids and steroidal hormones as a segment.
Yeah. Which is one is cortisol, the other is hormone related sort of APIs, etc. And these are almost 40% in cortisol and about 24%. This is global market share by volume.
So look, somehow to get these draw these numbers from the EQA as a large data publishing company, it may be misleading, but definitely this is close to $1 billion addressable market, and we already have achieved over $100 million in sales revenue. To that extent, we have a niche global leadership, but these numbers cannot be relied upon 100%. Why? Because you have to do an extrapolation using the formulation numbers where what would be the API size. Slightly complex, but you can be assured that in certain products within steroid and hormones, we have a significant global leadership.
So you said these two segments for APIs is about $1 billion a year.
Yes. Extrapolated. This could be plus minus something.
Okay, and you were at about $100 million.
$100 million as the revenue currently. Of course, it's still growing. Yes.
Yeah. And in terms of do you import any key starting material, etc., or this is all done ground up?
So look, let me just give you a context. Symbiotic is one of the few companies which has achieved fully vertical integration, so-called backward integration with respect to steroid hormone, where we start all of our production from a key farm vegetative source called phytosterol, which is derived from soybean. So starting from a farm product, go through the series of fermentation and series of demanding chemistry steps to reach to therapeutically active APIs, right? And this is where we are, one of the few companies in drugs and chemicals in certain segment which are fully integrated. Absolutely no dependency whatsoever on any other country, including China. However, what it has also led us this integration position where we have created a very sweet spot for ourselves called make versus buy. So we can make while everything on our own, absolutely without any dependency whatsoever. However, in certain cases, for the economic reason, for the regulatory reasons, for a variety of other reasons, we can continue to buy, and we do continue to buy from China. But in terms of dependency, zero.
Okay. Dependency is zero. Rima?
Yeah, just one more question. US revenue scaled up quite significantly, Raghav, in FY26 versus FY25. What led to that? I think 4% became close to double digit, 13% plus. What led to that, and is it sustainable?
Yeah, just to give you a context, what numbers are reported are direct exports. We also have a lot of indirect deemed exports where we supply to large Indian generic companies who formulate it and export it eventually to the US or Europe market. So in that sense, our US or Europe or international share of revenue is much larger than what is getting reported. Having said that, our focus over the last several years has been to penetrate higher in the regulated markets where we have a pricing advantage as well as a better market share. So Europe and US, gradually we've been increasing our share, and you'll continue to see that as we move forward.
And ROE and ROCE both declined over the last 3 years. I get that you all did the heavy lifting of the capex and now that's behind you. What would be the target ROE, ROCE by the end of FY27, FY28?
Yeah, so we have reported our ROCE for our base business, and that's reported as adjusted ROCE. And that number is roughly moved from 25% in the last few years to 30% today on the API business. So very clearly, it's a very high ROE, ROC business, which you see. Now, you are right that, of course, we've spent more than 850 crores of capex for the new businesses, for which we have not yet started generating revenue. So until we don't start generating those revenue, the consolidated ROC and ROE would appear suppressed. But once we start getting into this growth journey, you will see much significant ROEs and ROCs going ahead.
Okay. All right, we'll leave it there. Thank you very much. Good luck, and appreciate you joining us here, both of you gentlemen. And we'll speak again on listing day, and perhaps then we can probe you and push you a little bit more for numbers as you see them. But I think you've given us a good picture of where you stand. Two listings, by the way, this morning. One is Horizon Industrial Parks. That's basically listed at the issue price, 60 rupees. And the other is Lalita Jewelry Mart, which is listed with a pop of 30% plus, 267, 270 nearly, compared to, I think, about 200, 201 or so, which was the IPO price on that one. So both are interesting companies. And, we will, I think, Rima, you want to take us through the Horizon issue and what was
Yeah, because it's slightly bigger. So Lalita at the IPO price was about 11,000 crore in terms of market capitalization. Horizon was about 17,000 crore. Blackstone promoted. So we just quickly talk about that. Very flat opening, but even the subscription was about 1.45 times. The IPO price was 60 rupees and the stock is open flat. They did a fresh issue of 2,600 crore, no offer for sale, and the company is owned by Blackstone. Blackstone's stake got diluted on the back of the fresh issue. The question is, how does the company earn money? Well, the company has nearly 60 million square feet of assets. Of that, only half of it is developed. About 28 million square feet is developed. Now, they get their money from two key sources. One is fulfillment centers. So basically, they provide the land and the assets for warehousing for e-commerce companies, FMCG companies. And the balance 40% comes from manufacturing facilities. They call it industrial parks. So the company earns money by renting out these spaces and these clients. So whether it's I'm not naming the clients of the companies, but whether it's a Schneider Electric or a Amazon Flipkart, these will lease out the space for several years and pay the company rent. In FY26, the company had a top line of about 700 crore rupees, margins of 87%, but the company is loss-making. The reason it's loss-making is on account of two reasons. One, very high depreciation. The book depreciation on the company is high because they own the land and they've only developed half of it. So the depreciation is high. And secondly, up until now, the company's development was financed by debt. So the finance cost is also high. Now, IPO will in some way change the math because the debt on the company's books is about 6,900 crore rupees. Part of the IPO proceeds and plus the pre-IPO placement that they did will go in paring down their debt. So the debt component of it will come down. The opportunity, according to the company, is that we've only developed 50% of the assets that we own right now. The land is fully paid for. So that balance 50% is going to come on stream over the next 4 or 5 years, and that will aid the operating cash flow for the company. Well, one thing to bear in mind is the valuations, which perhaps is why the stock is trading flat. Now, we don't have a direct listed comparable, but going by price to EBITDA, while the EBITDA margins are very high, and some analysts are saying that by FY28, and this is analyst projection, the EBITDA of the company could hit about 1,100 crore rupees, which means at the current price, it's trading at about 15 times price to EBITDA. So maybe the valuations are capping the upside for now, but that's the business model. But the one which is doing very well is Lalita Jewelry. The market capitalization was 11,250 crore at IPO. It's with a 30% pop in terms of listing. The market capitalization is almost at 1,500 crore rupees. So stock also saw some very good subscription in excess of about 65 times. So that's the more exciting one. The company last year reported a revenue growth of 48% with a top line of about 25,000 crore rupees, driven by expansion and escalating gold demand. So that's the two listings. Nagraj Shetty is now joining in to talk about the market technical. Nagraj, another quiet session. The Nifty Bank has dipped into the red, but again, the moves are limited. What's the trade?
Good morning, Rima. Yes, thank you for having me. Market is consolidating. Recently, it has bounced back very well from the lows of around 24,000. I think 24,000 is going to be a strong support for the Nifty as per smaller and larger time frame charts. And the reversal it has came from the lower levels is indicating after 1 or 2 days of consolidation, we could see Nifty bouncing back towards 24,500, 600 level in a short period of time. I have 2 stocks from the long side. First is one Siemens. Siemens has been in a consolidation phase over the last couple of weeks, bounced back very well in today's session. The overall chart pattern is indicating higher tops and bottoms, the strength of an uptrend, and I'm expecting more upside from here onwards. Currently trading around 4045. One can look to buy at current market. The immediate target would be around 4250 levels. One can place a stop loss at 3900. And second one is Indus Tower. Indus Tower has been in a downtrend over the last many months, and recently around 365 levels seems to have formed an important bottom reversal. Today, yesterday bounced back, on Friday bounced back, and today is showing some consolidation pattern. I'm expecting a breakout in the short term, currently trading around 376. One can look to buy at current market. The immediate target would be around 395. One can place a stop loss at 365.
Okay. Thank you very much for that. Get into a break. On the other side, Manisha Gupta will talk commodities. Stay tuned. Welcome back. Let's talk commodities now. Manisha is joining in and she's eyeing crude prices. Manisha, crude has been flat compared to Friday's levels. So what's the news here?
Well, absolutely. You know, we were trading at $95, $96 a barrel on Friday. But in the Asian markets right now, we've seen 2% of a decline in the opening trades itself. So when you look at the overall price movement, well, we are up 6% for the month of August. And for 2026 till time, we are up by nearly 52% for the Brent crude oil prices. So it continues to be quite strong there. But what has led to this recent profit taking in prices in Asia especially? Well, a few things really. To begin with, it is about IEA and OPEC both talking about lower demand expectations for the rest of 2026. IEA actually has cut the current year forecast in sense of demand, in sense of a contraction of 1.6 million barrels per day. OPEC, in the meanwhile, says that there could be a growth of 0.6 million barrels per day. But OPEC also has cut demand from the kind of highs that it was seeing earlier because of the outlook on structural slowdown, weak Chinese demand. The Chinese buying for the last 8 months now has been on the weaker side, hasn't picked up at all, and that continues to weigh onto the markets as well. There also is a surprise U.S. inventory buildup in last couple of weeks in the U.S. markets there. It also has to do with no planned strikes right now between U.S. and Iran, and that tells market that perhaps the worst on ground is over. The other thing really is about the global shortfalls. Markets believe that they are not really going to be permanent, and in 2027, various Wall Street banks and agencies believe that you could be looking at a surplus in case of crude in 2027 in sense of availability, and that is keeping the prices in check as well. And then there have been statements from Iraq as well suggesting that it could be seeking higher OPEC quota to scale production to nearly 10 million barrels per day. So the markets are looking at higher supplies as we move forward, keeping prices in check. In the meanwhile, there are some factors which also have been ensuring that crude prices trade around these $90 a barrel mark. One, of course, is the unresolved US-Iran conflict and the kind of statements that we continue to hear from both the countries there. Strait of Hormuz, well, normal was 135 to 140 vessels in a day. That has trickled down to 30 to 5 to 10 on a day-to-day basis, and that continues to support. The global refinery runs down also have come down sharply, 8% year-on-year there. It has come down by nearly 8 million barrels per day, and that has led to margins at all-time highs, especially in diesel. That can be supportive. Natural gas prices, keep an eye on that, because as we head towards winters now, the demand will continue to increase, not just from the Western world, but from Europe as well. And that's exactly where we have seen the prices continue to run up. Venezuela output also has been hit by port delays, and we're looking at infrastructure blackouts there. That in turn also seems to be supportive. Going forward from here, it really is going to be about the US PCE inflation data that the street will watch out for. You also have the Jackson Hole Symposium and the US Fed speech there. And then it's also going to be about Canada, because Canada has now said that they are planning retaliatory tariffs after the conversation with US almost has seen a collapse. So a few things in this week that the street will keep an eye on.
Okay, all right. Manager, thank you very much for that. So that's commodities in focus. We'll take a break. We'll come back in just a bit from now, and we'll get you a discussion from the financial space. So, what, $70+ billion with regards to the FCNRB scheme already, with some time to go for closure, gold loans in focus, and a lot more. So we've got Virat Devanji of Federal Bank and Sachin Sachdeva of ICRA join us on the other side. Stay tuned. Welcome back. There's markets which, of course, are, I don't think, very much different from when we started. About 22 odd points is what you have, 24,300, just under 24,300. We started at about 24,300 in the morning. Virat Devanji is with us, National Head Consumer Banking at Federal Bank, and Sachin Sachdeva is Vice President and Co-Group Head Financial Sector Ratings at ICRA. Gentlemen, great to have both of you here. Thank you very much for joining us. You know, a bunch of things as far as the, the financial services space is concerned, but let's just start with this entire FCNRB number. And Mr. Devanji, if I can start by asking you, what is as the last number that you have in terms of what Federal Bank has taken in? Can you share that with us?
Look, as we have always said, we would maintain our fair share of our FCNR deposit business that we are in. So I think still 5 more days to go. A lot of hectic activities happening, but we are reasonably confident to maintain our existing market share when it comes to FCNRB's business is concerned.
No, you wouldn't have the number?
Look, it is moving. Okay,
what's the last number?
No, which was closer to a billion.
Okay, that number we had. I think we spoke after the first quarter numbers. And I think but that number would have moved on since then, I thought.
No, look, it is, I means unless and until the deal is done, you can't really quote, it's not the bird in the bag. Okay, so the closeout and certainly this date moving forward from 30th September to 31st, some of those calculations we had to really rework and get the money moving and so on and so forth. So from that point of view, I think the last 5 days are going to be pretty hectic for us at Federal Bank.
Sachin, do you think we hit $100 billion cumulatively for the industry by the end of 31st August?
Yeah. So that's a pertinent question, that what actual number we will end by August 31. Now everybody is talking about the same. Now initially when this scheme was launched, this scheme got opened, even our estimates stood at say around 60, 70 odd billion kind of a number for say FCNRB part only. But looking at the current trend and still almost a week or say 5 days more to go, I think the number is going to touch very high. Although whether that reaches 100 billion or not remains to be seen. But definitely it will be a much closer number to that. Even if it doesn't touch 100, but it could reach very close to that.
Okay, so that's on FCNRB. What's the overall assessment, Sachin, of the banking industry? Because we have seen a seminal pickup in the credit growth. That's a positive. But generally for the industry, profit growth has not picked up. So the street is waiting to see when that credit growth translates into higher profitability. Many banks reported NIM contraction. What is your own assessment of profitability increasing from here for banks?
So from a profitability perspective, I would put it in two different perspectives. One perspective is whether we are looking at operating aspects or the net one. The net one definitely got impacted because of the very significant yield movement during the last few months, which we have seen. A significant spike in the March, following continuing high towards April and May, then coming down slightly in June. So apart from that MTM impact on the net profitability, if I look at my operating profitability, the impact is little bit less because NIM contraction remains there, but other income is rising. And OPEX, almost all the banks are controlling to that extent. So variation in operating profitability is not that high as we are seeing at the net level. However, having said that, even at these numbers, I would say as a credit analyst, when I look at these numbers for the banking industry's profitability as a whole, these looks fairly comfortable per se because you are comfortably reaching double-digit ROE and the kind of growth we are estimating 13 to 15% kind of range. So effectively, that remains sufficient there to meet the growth requirements. The only challenge which in ICRA's view we feel is the deposit growth. Now, this quarter we will have the FCNRB deposits, but what after that? The domestic deposit raising, that still remains challenge because you have to probably raise rates to attract more deposits to your portfolio. So that is the key area which we need to watch out, apart from what everybody is talking about, the West Asia impact on MSMEs and all that. That obviously there has been comforting factor like ECLGS and all that. So asset quality has not played out that much. So those areas remain monitorable. But the key thing which as an analyst I would be looking at would be what happens to my domestic deposit growth after this FCNR window closes.
Got that. Just talk to us a little bit about, Mr. Devanji, on your experience. I mean, how is Q2 panning out so far? Which segments are doing well? This is, of course, also in many parts of the country, you're entering that festive period. So give us a sense on the consumer side.
Look, if you really ask me, if I have to sum it up, the first quarter of in the banking, I can only say that the banking system is healthy enough to absorb low margin. Okay, so I think the margins will be in, and as Sachin said, deposit mobilization will be key. At least maybe this quarter, the banks will sail through because of FCNR. But the other thing which banks will have to keep in mind that the profits have to come beyond the NIM contributing things, which are, say, a fee income, cross-sell, operating efficiency, and all those things. So from that point of view, I think those are the things which the banks will focus in the second quarter in order to maintain their NIM growths. If you're talking about the specific sectors that you're looking at, I think gold is shining like crazy at this stage. And I think that's where the demand is. And with this festive season just beginning now, I think the demand, means the utilization on the credit cards and the personal loans also you will find growing. As far as the SME is concerned, I think there is a demand. There are people approaching for the loan. They get the loan sanctioned, but their withdrawal is slightly on the lower side. So that's the way I could sum it up on the retail as far as the demand on the various sectors is concerned.
Got that. Mr. Devanji, you mentioned gold, right? It's probably the brightest star across all segments, across all banks, all and NBFCs actually. So it's a point which keeps coming up as whether, I mean, when you look at that segment, are we at the cusp of a kind of a secular kind of run which we've seen for the last 3, 4, 5 years, or is the best behind as everyone with the lending book now is in it? I mean, every second week we hear a new player coming in, which eventually should compress yields. So could you give us a sense what's happening there?
Yeah, look, I think the bigger thing is that the gold loan business is doing well, not because of the gold rates are going up. The way in which I look at it is something bigger that is happening across the country, which is the formalization of credit against India's largest underutilized financial asset. So that's the way I look at it. I think the demand for gold loan will continue because the sectors which were initially reluctant, they are willing to take the gold loan. And another thing that you might see is gold loan is actually replacing the unsecured PL. So the financial sector banks and NBFCs are actually happy that now you're giving something which is more secured. The ease of getting the loan sanctioned is also quite easy. And from all that point of view, the availability, now NBFCs make the gold loan available in every nook and corner in the upcountry market. So from that perspective, I think it's a win-win for the customer and for banks and NBFCs. So I personally
is it helping? I mean, you said it's replacing unsecured personal unsecured credit in that sense, right?
Yeah.
Is it also possible that because it is, as you said, so widely available and it's the ease of getting these loans, right?
Yeah.
If there is stress in the unsecured segment, is it kind of helping paper over some of that? I mean, at the end of the day, I mean, repayment is coming up and you have household gold and you kind of sort of, put that and then you repay this off. I'm not saying it's right or wrong, but do you think that kind of thing is also happening?
Unlikely, because at this stage, the stress within the PL portfolio is not there. What I was referring to is the growth in the PL book, okay, is subsided. So from that point of view, I don't think what you are hinting at is currently happening. But we as bankers will have to remain a little vigilant to ensure that it is not actually happening to take a gold loan to pay off the personal loan. At this stage, I don't think that is happening. Yeah.
Okay. Got that. We'll leave it there. Thank you very much, both of you, for joining us. It's a pleasure. Appreciate your time here on CNBC TV 18, and thank you very much for joining us. Okay, we'll sort of wrap things up here. It's a pretty flat day. The Nifty is up about 20, 30 points. The last we looked at it, 30 points basically. We started with Vishal Megamart being up 10%. I think it's holding up with that 10% pop even now. But there are a few more names which are looking up as well. It's a wrap on this edition of Bazaar. Thank you very much for staying with us. Chartbusters will pick up the action in just a bit from now.
UBS upgrades Apollo Tyres to buy it rating with a target of 590 rupees a share. The brokerage says the company's valuation is at a discount to peers and the outlook for the India and Europe business is improving. The stock at one point was up 4%, holding with a gain of 2%.
Vishal Megamart's board reappoints Gurinder Kapoor as the MD and CEO for 5 years and also redesignates him as founder. The stock rallies close around 10%.
Indian Hotels will merge Oriental Hotels with itself with a swap ratio of 25 shares of IHCL for 117 shares of Oriental Hotels. The management tells CNBC TV18 they remain on the lookout for new acquisitions for up to 2,000 crore rupees.
Gold prices hit a 3-month high above $4,800 an ounce. Gold financiers trade higher, led by Muthoot Finance.
Shares of Hexaware rally after the company says its AI day saw more than 50% of their revenue already linked to AI, and that it has identified a total addressable market opportunity of over $300 billion.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. Hey Mangalam, welcome back.
Well, Nigel, it's good to be back. Market up 25 points for the Nifty. The Nifty Bank not doing particularly bad. The broader market's actually doing a lot better, with a lot of these new listings doing extremely well too. Case in point, something like Lalita Jewelry. We have Mahanagar Gas, which is buzzing. A bunch of other stocks which are higher as well. So by and large, not particularly bad.
Well, that's right. I think we could go across and get an idea for profit. Actually, that could be something that we could squeeze in right now. For the time being, markets holding with a gain of close to around, I think, 30 points or thereabouts. Siemens is up close to 4.5%. So good traction being seen out there. You have SAIL as well, that's up close to 3.5%. Well, let's talk about one of the listings today. We have with us Urvish Rambia, the whole-time director and chief executive officer at Horizon Industrial Parks, who joins us on the show. Hi, Urvish. Good morning. Good to see you in, and congratulations on the listing. Well, tell us, give us some guidance now. How does business scale up from here on? How much of the amount of land that you'll have under your umbrella do you all plan on developing, say, in the next 2 to around 3 years?
Sure. No, it's a pleasure, Nigel, to be on CNBC. And firstly, a big thank you to all our investors. This is pretty much now entry into our Horizon 2.0, as we call it. Last 5 years have been a journey. We grew from 10 to 60 million. And Nigel, we will just do what we did the best, put our heads down. Today, we are nearly half built, about 30 million square feet. We have the raw material, the land in place to grow this to 60 million over the next 3.5-4 years. And we continue the journey and the saga going ahead and see how we can grow this. As our tailwinds in the sector, the mega trends, only continue to deepen.
Right, we take that point. But, of the numbers that we have, congratulations, Urvish, this is Mangalam here. About 58 million of your square feet assets, 28 million is developed. That leaves you with about 30 million left, right? So what's the revenue, headway that you have from here? And at the same time, if you could give us a sense on the kind of rental yields that we should be looking at, say, 3-5 years from now, as we see more and more of these assets getting developed and deployed?
Sure, Mangalam. So as you said, in terms of your total development area, operational area kind of like doubles over the next 3.5-4 years. But what's the beauty about this business is as we step ahead, as we've diversified, from warehousing to doing, industrial facilities, and now doing in-city centers, means the product mix going ahead, continues to get even more sharper. So it will not be just a latent drive up from here, but I'll see more an exponential build up in the revenue going ahead. In terms of rental yields, even if you look at our numbers in the past, we've done lower double digits, and as the quality of the product mix goes up, you'll see improvements in our yield on cost also going ahead.
All right, the rough estimate is that your EBITDA number goes to around 1,100 crores in the next 2 years. Possible?
So we did 605 crores for financial year 26.
Yes.
We're almost tracking a number which is significantly higher than that, for our March 27 exit run rate. As you know, Nigel, we've been developing close to 5 to 6 million square feet of area and leasing that in these platforms. That's almost adding 25% to our operational throughput. So, you can do the math and you'll know that, FY28 has, a lot of upside in store.
Yeah, that's right. So 1,100 crores is an aspiration, would be fair?
Yeah, in the ballpark.
All right. And also your debt in books, it's going to come down substantially post this fresh issue, which is good. So, you turn into the black, right? Because so much of interest saving would be there.
That's right, Nigel. Not only the 2,600 crores that we raised as a part of the IPO, but if you add the 1,650 crores that we had raised just prior to filing the prospectus, which was also 100% primary, both of that put together, kind of like delevers us 2/3, and that takes away as much interest expense, which was the biggest expenditure on our books. That, and along with the fact that a lot of our depreciation on the book is effectively book depreciation. Trust me, if you do pro forma for this, we've been in black even in the past as well. But yes, going forward, you'll start seeing that on the face of the P&L as well.
What would the annual savings in the interest costs be, roughly, if you could give us an absolute number there? Back of envelope calculations do suggest about 450 to 500 crores.
About average, yeah, right. Average cost is about 8, just north of 8. So 4,000 crores gets paid down at 8%. So that's roughly north of 300 crores.
All right, north of 300 crores get saved in interest costs. You are expecting utilization to increase, development to increase over the next 3 years. Your overall revenue potential is more than double, and you have confirmed that close to around 1,100 crores, which analysts expect could be in the ballpark for FY28 when it comes to EBITDA as well. Good luck. Wish you and your team members a great day of celebration. As you said, it's a red letter day for you, but New Horizon is something that we'll be tracking on. Horizon 2.0, as you call it. All right, thank you, Urvish. With that, we'll take a short break, come back on the other side. We do have the management of Tega Industries joining in on the back of them having launched a preferential issue worth about 95 crore rupees. Welcome back. Holding well for the markets. No real problems out there. Let's get chatting with another corporate conversation that we've lined up for you today is Tega Industries. Now about a 95 crore rupee preferential issue. Mehul Mohinka, who is the MD and CEO of the group, joins us now to discuss the rationale, the amount, and the growth plans of the company going forward. Thanks a lot, Mehul, for joining in as we speak. The 3 talking points that we want to take our viewers through with you up for you on the screen itself. Let's start with the rationale. You have debt of over 11,000 crore rupees on your books. The preferential issue of about 95 crore pales in comparison, right? A very small one. I'm sure you could have gone with a slightly higher number. So why just a 95 crore rupee pref issue? This is something that you could have easily raised from other sources as well. What explains this?
Good morning. Thank you for having me on the show. So the preferential issue is more a conviction from Apollo Global, which is our financial partner in the Molycorp acquisition, to reinforce their conviction in the entire transaction, which is the Tega-Molycorp combination. So this is something that we had discussed about early on, and unfortunately they couldn't come in at the first preferential allotment, which happened late last year. So this was just a completion of that commitment from their end post the closing of the transaction. So while it may pale in comparison to our overall net debt of 1.1 billion, but it was just more a signal to the shareholders that Apollo stands behind the conviction.
All right. Hi, Mehul. Good morning. Good to see you. A couple of questions. The promoter stake is around 67.5%. What level does it come down to? And at what level would you be satisfied holding a stake in the company?
I think post this preferential allotment, it comes down to roughly, I think, 67.1 or 67.2%. It's a very small dilution, and it's going to stay at these levels. We're very comfortable holding promoter holding it at these levels, and we don't see any further dilution happening.
Right. There's about $1 million that is coming from the AP group, right?
$10 million.
$10 million, right. What about the debt repayment? Now that you have strong financial backers, there is commitment coming in, but the overall debt of a little over $1 billion as well. What's the repayment plan here, and by when should we expect some sort of support coming in the form of lower finance costs?
Sure. Just before I take that question, I just want to reinforce the fact that Apollo's come in at 1994 rupees, which is at a premium to the current market price. And they've matched the original preferential allotment price. So this is, like I said, just their way of proving their conviction at coming in at a premium. So as far as the debt payment is concerned, it's going to be a 3 to 4 year journey. We hope to be able to pay down the debt to about 3 turns of EBITDA in about 4 to 5 years. And that's going to come through a combination of margin accretive businesses, new product lines, growth in margins and volumes in the business, coupled with as well as identifying non-core assets which we will monetize over the next 2 to 3 years.
Well, what would the value of that non-core asset be, Mehul?
Roughly around $80 million.
$80 million. Okay, so there could be some scope to reduce it. So from around 11,000 crores, you're saying that on a forward basis, you're looking at bringing the net debt to EBITDA down to around 3 times odd. That would mean in the next 3 to 4 years, the EBITDA number you're working with is around 3,000 crores next 3 years?
Roughly. Slightly more than that, but yeah, that's a good ballpark.
Yeah, because if I take your net debt comes down from 11,000 crores to around 9,000 crores, a little less than that. EBITDA number is a little more than 3,000 crores. That would mean around 3x. Fair to assume, right? That could be the aspiration?
Yes.
Okay, let's focus a little bit more on the operational performance then. This past quarter was hit by a one-off because, obviously you're integrating the acquired unit, and that's a transition cost as well. But should we expect more one-offs in quarter 2, or are we done and dusted now?
We're pretty much done and dusted. There's just going to be one-off. We have a stamp duty to be paid in Australia for transfer of land.
Okay.
We at this present time don't know what that exact number is going to be, but estimated at about $6 to $7 million. That's the only thing we think would come through over the next quarter or 2. Nothing beyond that.
Okay, and one more thing, Molycorp acquisition, you had told us last year that it will be EPS accretive from this fiscal onwards. That's FY27. Sticking to that, right?
Absolutely. If you were to take the one-offs, out of the Q1 results, it's already margin EPS accretive.
And what proportion of synergies have come about so far? You had given us about, what, $20 million worth synergies over the next 2.5 years. If you could give us a sense of the glide path there?
Yeah, so we did mention in our earnings calls as well that 20 million is about what we estimate over the next 2 to 2.5 years. I think by the end of FY27, we would roughly deliver about $3 to $4 million on an LTM basis.
Right, and if we were to look at FY27 numbers on a full year basis with the acquisition coming in, with all the one-offs coming by and all of that and stuff, what should the overall top line and the bottom line look like as per what you guys are looking at from here on?
So if I was to break up the parts of the business, I mean, Tega Consumables, a legacy business, is growing at about 15% CAGR. That's what we've guided the market. The equipment business is tracking well, double-digit growth as well. Molycop, we expect it to deliver about close to 5% volume growth and about 4% growth in EBITDA.
Okay, all right. Tell us a little bit about the competitive intensity then. Because as you said, when you go to a customer, now with Molycop coming in there, you have more to offer. As is you were giving them the consumables, and now, in fact, you have another vertical as well that you can offer. So when you're going to a client now, how much of their requirement do you satisfy? Say, ballpark earlier, you were doing, say, 5-10% odd. And now, how much of their entire need can you service?
So if you look at typically a grinding mill where most of the recovery of metal happens, size reduction, their major spend is power, grinding media, and liners. So with grinding media and liners being offered by the Tega Molycop combination, we would be probably sharing close to 60 to 70% of the customer spend on consumables in the grinding circuit.
Interesting, 60 to 70%. So that's a big jump then. Final question with regard to competitive intensity. There's always that fear, right, that a Chinese producer or from producers from other parts of the world, they come in there, they distort pricing, and they could put a company like Molycop in a bit of an issue. What's your comment on that? How is competitive intensity globally?
I think competition is always going to be around in every business, in every sphere, right? So it's all about how do we position ourselves better in terms of product quality, consistency, and services that we offer. So Molycop has, and Tega put together, we do have a certain amount of expertise in mineral processing, for example, and our value add to the customer is always going to be about how do we help you improve your recovery of metals in a more superior fashion than competition. And that's how we're going to position our product. So it's about making competition irrelevant in the overall offering of our product lines to customers.
Right. No, since you spoke about competition, just wanted to ask a bit of a follow-up here. And this is before this acquisition, you had high single-digit market share. You were targeting about double-digit by FY28 as well. Now that this acquisition has come about and that increases your scope of offerings as well, where does your updated market share stand at and your updated target?
So again, we have different product lines, right? So Tega's consumables business, roughly, we're about 17% roughly in terms of market share. I mean, there are no published data, but this is just our estimate. Molycop is at about 52% market share in gold and copper, so clearly number one leader in the marketplace. For our equipment business, still early days. It's a domestic business. We're trying to grow that now into the export market as well. So while the TAM is very large for the equipment business, close to about $38 billion, we hope to continue to claw some of that market share, not only domestically, but in the export market as well.
Okay, all right. We appreciate you joining in, Mehul, and giving us all of those details. As you said, a small fund infusion, but at a premium to current prices. And you're guiding for better times ahead with the net debt to EBITDA falling to around 3 times and the EBITDA number surging to around 3,000 crores odd. We'll wait by and we'll hold you to all of these numbers. For the time being, it appears that the street likes what you had to say. The stock has come off the lows, currently moving towards the high point of the day. Well, we will slip into a short break. Come back. We'll continue our focus on markets and stocks that are moving around. Stay tuned. Welcome back. You're watching Chartbusters. You're on CNBC TV 18. Well, as promised, let's get to our special segment on the show where we get you a few ideas for profit from Money Control Pro. Varsha Bang of moneycontrol.com joins us to talk about a stock that she's tracking rather closely. Varsha, over to you.
My stock pick is Saregama, which is moving beyond its legacy catalog and building a broader entertainment IP platform across music, content, and live entertainment. In Q1 FY27, music revenue grew 39% year-on-year, with margin expanding to 62%. Around 60% of FY26 music revenue came from songs released after 2000, while nearly 45% came from content released after 2020. The bigger opportunity is rising paid music subscription in India, which can gradually expand the royalty pool for premium music owners like Saregama. The company is also diversifying monetization through public performance rights, artist management, live events, and brand partnership. Saregama plans to invest rupees 300 to 350 crore in new content this year, with investment typically paying back over 5 years and generating returns for decades. The video business remains a near-term drag, with revenue declining 52% to rupees 17 crore following the migration of film investment to Bansali production. However, improving music monetization and operating leverage should support earnings growth. At around 35 times FY28 earnings, we see a positive medium-term outlook for the stock.
All right, with that, we're out of time on this edition of Chartbusters, but you don't go anywhere. We will have the team of Trading Hour come up and take all the market action forward. For now, doing okay for the frontline indices, a lot better for the broader markets, and a lot of individual stocks, like the ones which are at the bottom of your screen, doing even better. Thank you for watching. Good morning. It's the start of a new week and we're, well, in a bit of a range for the frontline indices. The Nifty flitting between the red and green around that 24,250 mark. We have the Sensex as well, which is down about 10 points. Nothing really to worry about. The Nifty Bank, which was an outperformer all of last week, has started the day a wee bit on the back foot with a cut of 200 points. The mid-cap doing a lot better. I'm Manglam Malu. With me, Ritu Singh. We come to you live from the CNBC TV 18 Motilal Oswal studio. Ritu, good morning.
Good morning, Manglam. As you say, nothing to worry about. We're starting the week, so we'll see how it plays out. But the broader markets, like you said, very much holding up. The mid-cap index is trading with gains of 0.3%, and the small-cap index as well seeing similar gains. The advanced decline ratio shows you the market breadth still very much on the positive. You have close to 2,000 stocks that are advancing compared to about 1,200 stocks that are declining. So you'll see those lines on your screen looking good for portfolios. And rupee is also looking a tad, stronger than how we closed, 95.67 to the dollar, but not much of an improvement. It's been a very narrow, tight range in which the rupee has been moving. The bank Nifty is seeing steep cuts. That's trading with cuts of about 200 points as we speak. In terms of other sectors, what's dragging the markets lower is some of the PSU banking names, FMCG in the green as well. But on the flip side, the IT, the metal and energy pack, that's doing relatively better. But let's get you the list of specific stocks that are making news or are buzzing around in trade today. And Manglam joins in with that list today.
Well, yeah, that's right, Ritu. A bunch of stocks which are buzzing around. If you look at something like a Vishal Megamart, the reappointment of Guninder Kapoor has the street fairly excited. That stock is up nearly 11% right now. We are seeing some traction in Muthoot Finance as well. Higher gold prices doing well for these gold financiers. We have Urban Company, the Kent RO case, the company winning that against Kent has done them well too. Brokerage is fairly positive on Urban Company, up 6% as well. If you look at some of the other names as well, Balu Forge up around in double digits, TVS Supply Chain getting an order from another company as well. Action coming in for a bunch of these sugar stocks as well. So be it something like a Dwarikesh Sugar, Bajaj Hindustan, Sri Renuka, all of them up in double digits, if not high single digits as well. And then we have, to end all of this, the rice players, KT Foods, LT Foods and KRBL, both of them up between 7 to 12%. So a bunch of these stocks are buzzing, even though the frontline indices are off highs. But one of the stocks on our radar right now is Travel Food Services, posted a revenue growth of nearly 20.6%, even as margins for the first quarter of the company eased. They expect passenger traffic to bounce back in the second half of this year. Varun Kapoor, who is the MD out there, joins in right now in our studio. Thanks a lot, Varun, for joining in. And understandably, the first quarter was impacted by traffic challenges because there was so much that was happening. And there were key locations where there were a bunch of, one-offs, so to say. Despite all of this, your system-wide sales growth was close to around 18%. What's your sense with the second half, with traffic expected to resume and like-for-like coming back as well? How do you end this year when it comes to revenue? And what's the kind of operating leverage that one should expect kicking in the second half of this year?
Right. No, thanks for having me over, Manglam. So very rightly, I think you put the context right. I think travel has been... India has been very resilient of travel over the last decade, undoubtedly. But if you see, I think the last 1 year has been a year of disruptions in travel. We had obviously the war last year. We had one of the largest airlines in the month of December. And all of that capped off with the February, the conflict in the West Asia that's seen travel had an extended impact. I think what's very evident through that, however, is the strength of the bounce back on travel. So I think if you look at even the month of February, March, and then April, you saw the traffic drop off. There was a bit of easing on tensions and you saw this bounce back in the month of May. So our numbers as well is kind of reflective of that. Obviously, this downturn of traffic, I think in spite of that, we've seen a 20% growth on revenue. Our belief, very much so, therefore, I think is what the sector has assumed is about 5 to 7% growth is what will come out of the next year and a half. So I think this year, about 5% is more a prudent estimate. We're used to about 8 to 9% growth in traffic. Way that will play in our numbers is, I think, we're a combination of our existing outlets, but a key thing is the new outlets coming in. Yeah. So a lot of new airports have come in, new traffic. I think that's been the story. We're going to see probably coming back in the second half of this year is the expectation to kind of the growth rates we're seeing historically of north of 20%, 25, 30% levels is what we expect that to be the case.
So 25 to 30% growth is what you expect to come by as passenger traffic returns. Since you spoke about the new airports that came in at the same time, some of your new QSRs that you've launched as well, 50 in the pipeline for this year too. About 8 to 10% of your costs are fixed, which implies that as operating leverage kicks in, margins come back as well. First quarter, because of all these things that you spoke about, margins were around 35%. When do you expect that to go back to your historical 39 to 40% sort of band?
Right. I think our estimate is from a safe band point of view. I think while EBITDA, we think that range of somewhere in the level of say 34 to 36, 37% is a safe band, because you go through phases of mobilization of units. You go through phases where as you mobilize more units, you have incremental, say, labor cost that comes in because you hire in advance, you train the employees. You also incur additional costs in terms of setting up the increments that happened this year. For example, this quarter, you did see some effect of that. So I think that is a period. I think every quarter you may have some, but I think that range is quite limited there. Even the PAT margins, you see, we've been quite in the range of between 25 to kind of 28%. We've seen that range. I think that's going to be where our performance lies. So I think the advantage where we sit today is we've had a very strong net gain. So last year, we opened about more than 80 outlets. We already have 50 in the pipeline. So what's happened is even though traffic is down, you've seen our sales, we've had a lot of growth, even though traffic has been there. I think the second traffic comes back, that's a lot of firepower available. That, these outlets will come back to very strong levels, and that's why we expect the near future to be extremely strong for the business as those units are able to actually get the passengers in and spend.
All right, we'll go across to Ritu now.
Well, Varun, hi, good morning. Thanks for being here. Just a quick question on that itself. 580 outlets already across these 21 airports. But when do you reach a saturation point? I mean, if you're not expanding into these new airports, how much more could you saturate there, before that starts to turn around? And secondly, in terms of your Delhi Terminal 3 contract, that runs out by end of September. Is there any update you could provide us if there is a contract renewal or what's happening there?
Hi, Ritu. Great to see you. So, it has, I think, looking at both your pieces, I think the first part, if you see the way airports are, I think, India, in terms of where we are in terms of penetration of traffic. I mean, we're the fastest growing large traffic market in the world for aviation traffic. But you see, even us in terms of penetration for our population, the amount of people flying is about 0.3 in terms of our population. So we're about 400 million flyers versus a population about 1.4 billion. You look at a market like China, which was here exactly 10 years ago at the same level as us. Today is, north of even they're about one time in terms of their traffic versus population. So there's a significant headroom available in terms of us per capita to grow. That's almost 3x. And assuming that grows over the next 10 years, you're talking about significant growth available for passenger traffic. So I think that itself, there's so much availability, and that's why you see airlines placing orders for aircrafts. You see the massive terminals coming up across Navi Mumbai this year, Bhogapuram, Noida. So you see all that coming in, plus other airports happening across. So I think there's a lot of available demand. Plus the beauty of our model is you set up a restaurant, if you think about it, an airport. As an airport expands, people fly more in different hours. So that same restaurant or unit can actually cater to more day parts. So that's the beauty of the model here. As we set up, we have a runway for the next decade for a store we set up today. Coming, for example, to the second part of your question about Delhi Terminal 3, we've been in that airport for now, it's almost 15 years. And part of the normal renewal exercise, we go through contracts. So that is one that is expanding out. We have, bid through, we have a joint venture with GMR. We have bid through that. And we are hopeful, we have strengths in the business. We've been able to be here for long term. And we bid for that. And we are hopefully, humbly confident about our opportunity and hopefully continue there, build new units, new brands, and make it exciting for passengers.
So no update on whether that contract renews or not, Varun?
Yes, that will probably come in the next, as that contract expires, sometimes you get short-term extensions as we have got there. So, the airport will just make sure at their point in time, they are going also through the upgrade exercises in that airport you'd have seen. So I think that would play out and we'd get the intimation at the right time, which we'd be able to share with everyone. But like I said, we've been in that airport for more than 15 years, so it's something.
But the new joint venture is about 30% your share, right? This compares with earlier, which was a lot higher. So the consolidated business comes off. Right. How does that impact the reported performance?
So I think that's already happened about in terms of a lot of the business which is in the joint venture. The new business, I think we've called out as well. The beauty is the opportunity tremendously is increased for us across the airports. So actually the flow through that comes to us and the profit is actually significantly more. And that's the way we see these joint ventures play out for us. It's actually played out over the last 2 or 3 years. And we expect it to continue playing in that manner as our footprint grows larger and the profit flows through.
Two growth drivers I wanted to speak to you about, and they were interesting because on the one side, while you are growing in your core business, you also expanded in the non-QSR business, which is Elite Assist, passenger services, porter services, etc. Very small right now. How much can this be going forward, say, in the next 3 to 5 years? What's the headroom for growth here, the ancillary services? And outside of airports, you have when you came out of the IPO as well, it was a very small portion of your business in highways.
Right.
How big does that be over the next 3 to 5 years?
A great question, Mangalam. I think the opportunity on technology, one is technology is no doubt an enabler. I think what we've done here is also use it not only to enable the current business, but actually open up additional opportunities. So I think the way EATS, the technology platform, has played out for us is we see that being one where it's seamless interaction and integration for the passenger, as well as for the banks on the back end when you're using a lounge service. So today you come to a lounge, you can actually sign in through a web browser in advance before you even reach there. You get a QR code at the lounge itself, or you do a traditional EDC. So that's the technology platform, for example, there. We'll also be integrating meet and greet services into that. We'll be doing other porter services. So there's a whole range of services that passengers are looking for in an airport that we see to enable there. And it's already contributing about 8 to 10% additional business for us. So it's already started very strong for us. We spent a lot of time in developing it. And that's the way we see that whole opportunity playing out for us on the tech side as well. And coming to another opportunity for us, highways. You spoke about that. I think India, in general, travel, people are going around business travel, no doubt, but leisure travel, more and more important domestically. As our Honorable Prime Minister said, there's so much to explore in our own country. And that's the opportunity. We see that happening on the ground. Domestic travel has been resilient, even during this crisis. Highways are going to be surely the next 10, 15 years of boom, and we want to be ready for that. So I think it's something not immediate in our numbers. It's a small portion of our business today, single digits, very low. But I think over the next decade, it's where air travel was a decade ago. So I think the opportunity is immense for us, and it'll become a meaningful part of our business, we believe, over the next 7 to 10 years, surely.
Right. Any ballpark on how much that would be from, say, single digit in contribution right now, highways?
Right. So currently, by single digits, actually lower than 1%. So, by air business, from where we're doing revenue, I think from a point of view, if I had to give a number, I think this could be somewhere in the higher single digits, potentially after 5 to 7 years. Because right now, the expansion of the highways, like the whole Delhi-Mumbai Expressway, the Bharatmala, those things are happening right now. So as that happens, we see then kind of our space into larger portfolio assets.
The non-QSR ancillary business, which is about 8 to 10% right now, how much will that be?
So the ancillary business, I think that will grow side by side with our business, probably slightly increase its margin. But I think we believe our core business to grow at the levels, we've seen historically about 25, 30% levels. We're confident that will be there as traffic, comes back. We think this will grow at the same, if not better than that. So slightly go ahead at that.
Take that point. Thank you so much. Always a pleasure speaking to you and, listening to the great opportunity that there lies in the travel and tourism space in India, particularly via the airports. Thank you, Varun, for coming by to our studios right now. We'll take a short break, come back. On the other side, we'll be joined by the management of SmartWorks. Harsh Binani joins in to talk about their FY27 outlook, the recent deal that they signed, which assures them of over 200 crores of revenue this year.
Welcome back. You're watching Trading Hour. Now we have SmartWorks co-working spaces, which has added 235 crore rupees of incremental contracted rental revenue through expansion mandates from existing clients, and that includes Fortune 500 and Forbes 2000 companies, and this is across multiple cities. To get a bit of a outlook on this, we're joined by the co-founder of the company, Harsh Banani. So the 3 points that we're going to be discussing today, one, of course, is the timeline for this incremental revenue growth. The second is going to be the breakup of this incremental revenue that is coming in, and of course, the outlook for FY27. So with that, Harsh, thanks very much for joining us here. Let's start with that first question, and good to finally have you here and speak to you. How much of this revenue kicks in immediately, or is it going to be spread over a period, FY27, FY28? Start with that.
Good morning, Ritu. Thank you for having me this morning. It's a monumental feat for us to continue on this spree where we've been signing up a lot of these large mega deals. But before I get into the specifics of the deal, it's very important to bring the context in front of us that what we are seeing play out is a structural shift in how the world's largest companies, Fortune 500 companies, Forbes 2000 companies, and India's largest corporations are deeply embracing the concept of flex space, and it's leading to a habit shift. So SmartWorks, of course, being the largest player in this segment with our AUM, continues to enjoy the consolidation in this space, and we have been, over the last few months, rapidly gaining market share. So this habit shift that you're seeing in front of you is not because flex is an overflowing option. It has now become mainstream, and largest companies of the world and India are now making this part of their core enterprise workplace infrastructure. And the fact that if you see our platform, it's actually seeing a demand and supply multiplication happening. On the supply side, you're having India's largest developers, whether it's DLF, Panchsheel, Raheja, Hiranandani, all on our platform validating how they also see this rapid shift evolving. And on the other end, you have all of these large companies also coming on the platform. Now, specifically coming to this deal, so 235 crore is in addition to our 5,400 crores of already contracted revenue, which we had announced during our last earnings result. This 235 crores will be spread over the next 4 to 5 years. And it typically comes from over 10 deals, which are in the range of 4 to 5 years.
So 235 crores will convert into your billed or recognized revenue over a longer time period of 4 to 5 years. That's right, Harsh. And secondly, if you could break up for us, how much of this is actually coming in from brand new seats and how much is really from expansion in existing centers?
Look, the strongest validation of our platform is not winning the customer once. It's that same customer coming back and asking for more. So this 235 crores is not from any new customers. It's from our existing clients, and they have been expanding and scaling up with us. So it's a big customer confidence announcement. That's how I would look at it. And in fact, that's the network effect that the company has been able to bring to fore. In last quarter, 35% of our revenue, Ritu, was coming from these multi-city clients who are not only expanding with us across the 14 cities that we are present in, but also across multiple cities. Once we get them on our platform, they continue to expand and grow with us and consolidate their entire office portfolio with us. So you should see this 235 crore announcement purely from that lens.
Right, take that point, Harsh. Always a pleasure speaking with you. What's the weighted average remaining lease/contract tenure on this 5,400 crore book that you had announced at the end of the previous quarter? And how much of that is already reflected in your secured through FY28 and partially FY29 pipeline that you've disclosed earlier too?
Thanks, Mangalam. So very specifically, the 5,400 crores that we're speaking about is spread over a period of more than 3.5 years. And what you're seeing playing out in front of you is a clear advantage that our business model is able to bring to the fore. One of the biggest strengths of our model is the campus. Today, we have the world's 6 largest campuses with us, over 800,000, 900,000 square foot with Panchsheel and Hiranandani Group respectively. What this campus strategy, Mangalam, is allowing us to do is to bring it to 2 distinct advantages of our model, scale and cost. And today, if you combine the strength of both of these at roughly 8,500 rupees per seat, you're talking about less than 280 rupees, right? Which is practically the cost of less than a premium coffee. In that, you're getting the world's largest companies to come and occupy your space every day with grade A workplace, highly fitted out interiors, and all the services that you can expect in a hotel. That all is in the format of an office, gym, crash, food court. So that's the power of how SmartWorks has been able to take advantage of our scale and cost. We continue to expand our margins, yet we pass on these benefits to our customers. That's why our model continues to be very sustainable, and we continue to see all of these large companies coming and embracing SmartWorks. And more specifically to your FY28 question, I'm happy to share with you that this 235 crore revenue that we've signed up continues to give us more visibility and guidance, not only for FY27, but also for FY28. During our last earnings call, we had mentioned that about 88% of our contracted revenue for the guidance of 28 to 30% growth in 27 is already contracted. So this additional revenue expands that guidance and also increases the visibility into our FY28 contracted revenue. So we are seeing a very strong growth outlook ahead of us, where not only are we expanding, but you will also continue to see strong visibility and margin expansion as a result of that.
So does this mean you will increase your guidance as well? By how much? Because I remember pushing Nitish after the first quarter numbers as well. You grew a lot faster than your 28 to 30% guided growth in this year in the first quarter. Now with this additional revenue growth coming in and 87% of your revenues already being contracted, do we expect that number to be more between 35 to 40%? Or for now you'll hold on to 28 to 30% with an upside chance of beating that? Formally revise it. Come on, Harsh. You can do it.
Mangalam, we sign deals every day. This is a culmination of more than 10 deals, but we don't change our guidance every day. The power play is off to a very strong start. We also have the slog overs and the middle overs now, which we're just pacing, and we are seeing a very, very strong outlook ahead of us.
Point, always cricket lover, Harsh. Thank you so much for that. Power play is off to a good start. Slog overs remaining. You have wickets in hand and contracts in hand as well. With that, we'll take a short break, come back, focus on some more of the market movers right now. We will obviously have Saumil Mehta joining in to discuss the market technicals as well, give us his trading picks.
Welcome back. You're watching Trading Hour. Let's get in some check on the market technicals with Somil Mehta, Mirae Asset Share Khan, and also get his top trading bets. Somil, thanks very much for being here. You know, for the markets, Nifty continuing to hover around the key 50 and 100-day moving average now. What are the near-term levels you look out for and your top stock calls for the day?
Good morning. Good morning to everyone. See, the markets are trading around very crucial levels at this point of time. However, last week, Nifty took support around 24,000 and started bouncing back. We are trading around 24,200, which were 24,200, 24,300, which was previously a very crucial level as support. And now it has become a resistance around 24,300. We are trading below 200 daily exponential moving average, which is 24,370. Again, that is a very crucial hurdle for the Nifty. Overall, I think I'm still positive on the markets, and I'll be expecting markets to break this short range on the upside, trading, closing about 200 daily exponential moving average. And that is only because we're making higher lows since April from 2,200 levels to 23,000 to 23,600. So these are higher lows we are building. So overall, I'll be positive, and my strategy would be to buy on declines. Now, we should definitely be very cautious because this is the third time we are, trading, taking resistance around 24,300, 24,200. And again, today we have taken resistance around 24,300 and slipping down. So be a little cautious and definitely, stay in large caps within the top 100 stocks, so that it is a little, risky to stay in mid caps and small caps. The two stocks which I've chosen for today one is Siemens. Siemens has broken a small flag pattern on the daily charts, taking support at 2040 daily moving average. The stop loss should be 3,900 and the target is 4,400 in the medium term outlook. The second stock which I've chosen is from the defense pack, which is Cochin Shipyard. Cochin Shipyard has been making high tops, high bottom trading about 20 and 40 daily moving average. Overall, the defense pack is looking good as well. So my stop loss would be 1430 and my target is 1650.
All right, take that point, Somil. Thank you so much for joining in and giving us your views on the market. Expecting a bit of an upside breakout despite the choppiness right now. If you look at the cues coming in from the F&O space as well, the market is fairly choppy. We have the Nifty Bank, which is actually taking the overall index lower. The mid-cap index, however, even though off highs, is marginally in the green right now with a gain of almost 60, 65 points. The Nifty Bank is a bigger culprit, down about 400 points. The India VIX has moved to the high point of trade, so let's see how that comes about. This is also the month, or rather week, where the monthly expiry for both the Nifty as well as the Sensex play out tomorrow as well as day after, on Thursday. The outperforming indices are the metals and the IT pack. So those are a couple of sectors that we'll be tracking as we move along this week as well. In terms of option writers, they're active on the 24,300 level and the 24,250 level, the call writers. 24,300 call, premium of 30 rupees, 24,250 call, premium of 50 rupees. Upwards of 24,300 to between 24,350 is where there is a resistance expected, but support is around the 24,200 mark because the 24,200 put writers fairly active, premium of 50 rupees, telling you around 24,150 to 24,200, we will see some support coming in. And that ties in well with the setup on the Nifty technicals as well. 20-day moving average of 24,370 is where there is resistance, and at lower levels, at 50-day moving average of 24,182 is where you are expecting some sort of support to come by. The only thing we'll be tracking as the market closes today towards the end is the Nifty Bank is below both the 50 and the 20-day moving average, positioned between 57,500 and 57,600. Can we conquer that and close above that? If that were to happen, bulls would be feeling a lot better. With that, we'll take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us. Welcome back. You're watching us here on Trading Hour on CNBC TV 18. The Nifty currently lower by almost 75 points. At the low point of trade, in fact, from the highs of today, we've lost about 150 points. And this is exactly where the level is. The technical support comes in the form of 50-day moving average. So let's see how we go about from here on. The mid-cap index also on the verge of breaking below the red line right now, currently sitting the gain of just about 10 points. And that too has corrected about 250 points from the highs. Good time to get in George Joseph from Ask Investment Managers for a quick fundamental check on the market. George, so far the earnings season has been fairly good. Despite the volatility that we're seeing in the international markets, we still have Brent holding at around 93. Not a big problem when it comes to all the factors, but what suggests the market's inability to go higher? Because even the FII selling has come down, if not turned into buying. I mean, July was okay. This month so far also not particularly bad.
Yeah, so well, it is a very interesting time. Markets have been dilly-dallying for the last 2 years in this range. Small caps and mid caps have been doing reasonably well because of the mutual fund flows have been very strong in the last couple of years, and huge amount of money has been collected in that space. FI selling was the biggest, as you rightly mentioned, was the biggest selling point, and because of which the large cap segment was underperforming massively. Now that has tamed down, and there is an expectation that the valuation or the emerging markets within emerging markets, India positioning is much better compared to 2 years back. So some flows can come back, and also currency being reasonably stable. I think we are in a good situation where the large caps can come back strongly. So that's the way I think about the markets at this point in time.
Okay, you think the large caps can come back strongly. But George, good morning. Let me quickly ask you about this whole bunch of new listings we've had in the last couple of months, and they've mostly done very, very well. I mean, from Shiprocket, Milky Mist, Dhoot Transmission, there's a whole bunch of them. Anything in this particular space that you like?
We generally think from a little bit longer perspective, next 3 years, what can actually work. And if you look at from a quality, growth, value, and proven quality, growth, and value, or valuation where it is very, very attractive, that intersecting point is the most interesting one for us. And what we look at this point in time from next 3 years, where we want to make money for our investors, the private banks, IT, pharma, and to a selectively the manufacturing and capital goods segment becomes the most better hunting ground for us. Whereas the IPOs in general, because the listed history is very poor, we need to have some clarity on how the minority shareholders will be taken care over a period of time. All these things checks happens over a period of time, and then we take a more constructive view on these names. So new listing, not much of our interest at this point in time. And, we have listed companies with a proven history available at ridiculously cheap at this point in time, especially in the large cap basket from private banks and IT and pharma. So that is our most attractive bet at this point in time.
Oh, that's interesting. Private banks, IT and pharma. Private banks, one understands. Pharma also reasonably, understandable. IT, tell us more. I mean, what makes you so constructive?
Yeah, so if you look at all the answers are not there with us. Uncertainties looming still. What AI can do for these companies, and whether these companies death knell is on cards or not. People are all talking about it, but when we look at after a long underperformance and the valuations have become much more dearer, the new leg of growth in terms of AI-led transformation for many big corporations are kicking in, and that's where the new leg of growth for these companies can be visible. And that's what we could gauge from the commentaries of Infosys founders or TCS annual report also suggests the same thing. So we are more constructive from that perspective because these are very high quality businesses with good cash generation and also long vintage of growth displayed over a long period of time across the globe. And therefore, there is a good case for these companies to be looked at more constructively at this point in time compared to 2 years back. So 2021, these companies were obscenely overvalued. Now it has become very cheap. So because it's a B2B business, it goes through these ups and downs very frequently. And, that gives you an opportunity to invest with a little bit long-term mindset.
Okay, George, so what is not obscenely overvalued? I mean, apart from pharma that you've discussed, IT that you speak about, and large private banks, where would you put your incremental money?
So, we are looking at selectively some of the micro caps, where actually the interest of most of the market participants is poor, where we see a lot of good value picks. But again, it comes with illiquidity and it comes with a lot of thinking and understanding about the businesses from a long-term perspective. When it comes to mid caps and small caps, that is a pocket where we find the valuation is very, very frothy. Many companies, be it in defense space or others, are trading at 100 times, 140 times, 150 times EV/EBITDA, and people are still buying it, thinking that they will turn out to be good investments. But we believe that that is a very, very difficult argument to make. And when you look at some of the earnings growth stories, obviously some of the paint companies, they have reported good numbers in the last couple of quarters, and I think the worst more or less is over for these companies. Probably 5 years of underperformance has already hit in. Maybe that can be interesting ones to look at. So we are incrementally warming up on some of the massive underperformers, which has been the case for the last 4 or 5 years, and looking at what is it priced in, and how the expectations are, at this point in time. So we can see some of the good opportunities in that regard, be it in the banking, auto, engineering, capital goods, and we have to be very, very selective.
Well, very interesting comments coming there, George. Thank you so much. We appreciate your time here on CNBC TV 18. Well, up next, let's focus on the bond market with Manisha Gupta in just a bit, so you stay tuned.
Welcome back. It's that time of the day where we track the bond markets. And as promised, let's shift focus there. Manisha Gupta joins in with all the updates. This is Bond Street. Manisha.
Well, the markets, of course, taking cues in from the US Treasury yields, where we have seen a bit of a decline coming in. Indian markets trading slightly in a narrow range right now. It is going to be about the 7 states raising 201 billion via bond sales on Tuesday, and the markets will keep an eye on that. In the meanwhile, you have the Brent crude oil prices still holding above $90 to a barrel. It's going to be about the foreign inflows that the traders will keep an eye on as well. In the meanwhile, on Friday, we had SEBI floating 2 consultation papers. This is being done to change the application norms for online bond trading platforms therein, providers that is. One, of course, is about proposal of a fixed income channel partner. This is to do a framework to facilitate distribution of fixed income securities. The second paper that has been floated in sense of consultation is about a plan to tighten the advertising code as well. So something that the street will, of course, continue to debate about. If you look at the private bond placements, well, there's a long list for today and tomorrow as well. Let's talk about today first. And you have Power Finance Corporate, which is looking to raise nearly 50 billion, and they are doing it via 2 bonds. Bids for this are being taken in today. The second one on my screen is TVS Credit Services, which is looking to raise nearly 5 billion. They are doing it via 6-yearly bonds, again in the markets today itself. And then today you have Crazy Bee Services, which is looking to raise 1.5 billion, and they are doing it via maturity of 2-year bonds therein. Rupee Capital is looking to raise 750 million. They are in market. They are doing it via bonds which are maturing in Feb 2028. And finally, there's one more company today, Orange Retail Finance India, which is looking to raise 500 million, and they are launching it with 2-year bonds. And there are a couple of companies that I'm looking at on tomorrow as well. You have Vision Infra Equipment Solutions, which is going to raise 250 million, and they're doing it via 2 bonds. There also is ITI Gold Loans, which is planning to raise 1 billion, and they're doing it via 2-year maturity bonds in the street today.
Make that point, Manisha. Thanks a lot for that. There has been some stability for the Nifty now from lows of around 24,170 thereabouts. The Nifty is recovered about 20 points, clawing in on that 24,200 mark right now. A bunch of broader market stocks are actually doing a lot better. So we have Nippon Life, which has moved to the high point of trade. We are seeing some traction on MCX as well, which is higher by about 3% at the high point so far. And even a pickup from the lows on something like a Tata Consumer. From lows, it's up by 0.8%. Yes, up by just about ₹1.50 on an absolute basis, but has moved to the high point of trade. The intraday chart tells you the volume of recovery that we've seen. And then incremental gains on stocks that we've been tracking from the start of the trade. We have LT Foods, which is up 14% right now. Parag Milk too, high by about 6%. And some increased traction in names like PVR, which is higher by about 1.7, 1.8 odd % on that counter too. We take a short break, come back, focus on the market macros with the macro stocks that, or the macro theme that Ritu spots every day.
All right, that's the market looking for you. The Nifty heat map shows you more stocks on the decline than the ones that are advancing. But let's get you the macro signal for the day as promised. And we have the total inflows under RBI's special forex swap facility that touched almost $73 billion as of the 21st of August. And that was led by the FCNRB deposits, which was a total of $65.4 billion, accounting for nearly 90% of all of the inflows, another $4.86 billion through overseas foreign currency borrowings, and about $2.5 billion through external commercial borrowings. Now, at this pace, the mobilization has already surpassed the scale that we saw in 2013, and the pace is picking up quite a bit as well. So for instance, on your screen, the first $20 billion took 38 days to mobilize, the next $20 billion took 14 days, and that last $16 billion has come in just 8 days, especially with the FCNRB deposit scheme in its final week now. So how much more money can still come in? Well, we polled a bunch of economists, and the expectation is about $65 to $80 billion in FCNR flows by the end of August, and a total of anywhere between $80 to $100 billion under the scheme. Now, interestingly, despite this record inflow, the question everybody's been asking is, the rupee has barely moved. I mean, it was at 95.71 to the dollar on the 8th of June when the scheme was announced, and look at it now. 95.69 on 21st of August, which is when nearly $73 billion have flown in, and not much of a change since then. So the question is why the rupee has not rallied, and the key to understand that is what is happening to the dollars. Now, under RBI swap facility, banks mobilize this money, they give the dollars to the RBI, and they receive rupees in turn, and the RBI then holds on to those dollars, and that boosts India's foreign exchange reserves rather than simply flooding the spot market with dollars. So since this $73 billion is not in the spot market, there is no direct impact on the rupee, and at the same time, you have higher crude prices that is increasingly increasing the dollar demand here, and importers and corporates continue to buy these dollars. So in simple terms, we have a huge amount of dollars that is coming into the system, yes, but we also have strong dollar demand that is causing the outflow, and RBI, which is managing the currency and not directly putting this in the spot market. And the result is these inflows have strengthened the forex buffer, but they have not translated into a sharp rupee rally. So that is a macro signal for you to take home. Manglam.
Indeed, we take home that macro signal right now, Ritu. But on that note, we'll also thank everyone for watching the show. We wrap up on this edition of Trading Hour. Stay tuned. In just a moment, we have the team of Halftime Report taking all the market action forward. From Ritu, me, thank you for watching.
Stocks swing between gains and losses ahead of the U.S. Treasury Secretary Scott Bessent's Iran-sanctioned presser, metals and IT gain, while financials and FMCG drag.
Taj Hotels owner Indian Hotels scripts a merger with subsidiary Oriental Hotels to enhance growth, even as it is on the prowl for an acquisition of near 2,000 crore rupees in size. CEO Puneet Chhatwal remains tight-lipped on any likely deal.
The 62,500 crore mobile PLI 2.0 kicks off in offering incentives till FY31, targeting production of 39 lakh crore and exports of 15 lakh crore. Minister Ashwini Vaishnav bats for a homegrown mobile brand and an export push.
Lenskart sees a block deal of near 2.6% of its equity worth a little under 3,000 crore rupees, with a SoftBank fund leading the likely seller, while Meesho sees a tad over 1% being sold, mostly by Y Combinator, for near rupees 970 crores.
Hello and welcome to a halftime report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Patra, with me Sonal Bhutra and Vinny Motiwala. Well, it is turning out to be a day where we've started a little bit of on the back foot for the markets. So we have the Nifty, which is just about lower by around 66 odd points, below 24,200, and the mid caps, which are absolutely flat at this point in time. The advance decline ratio a little bit on the advancing side, you'd have to say. So let's see how that trends for the rest of the trading session. So we have around 2,100 stocks advancing to around 2,000 stocks declining at this point in time. The Bank Nifty is one of the key reasons for the pressure today. So the Bank Nifty itself is down around 0.7%. Hi, girls.
Hey girls, good afternoon. We started on the front foot, but a sharp fall from the highs in last couple of trading minutes. And if we talk about the banking index, that is the one which is leading to that. It's a cut. If we talk about some stocks in the banking space which are leading to the fall from the highs, we do have HDFC Bank, Axis Bank, ICICI Bank, Big Boy, Reliance Industries is at the day's low. We do have some of these FMCG names which are also putting pressure on the Nifty as we speak. So a lot of moving parts on the Nifty, and the advance decline ratio, which was in the favor of advances, continues to be so, but those lines are getting closer and they might just merge. So we'll do one thing before we talk about the other big things. Let's talk about what we do have on the show today. We'll connect with the top management of SIS and also speak with Gulf Oil Lubricants to discuss their Q1 numbers and the road ahead. We'll focus on a whole host of buzzing stocks and big movers in trade today. Stay tuned for that. We'll also be joined by Harshal Barot of Metals Focus to decode the rally in precious metals, with gold surging to a 3-month high. Okay, with that, let's go across to Vivek now. He's here to take us through the stocks that are moving around in trade. Vivek.
Well, thank you so much for that. Again, a volatile trading session, quite a sharp fall, especially the last half hour or so. And in terms of individual stocks that we're tracking today, have a look at Oriental Hotels. After the much awaited merger that the company has announced with Indian Hotels, that particular stock doing quite well. HCLTech Technologies, after a while, the company hosted an AI day, post which the street came back quite enthused, almost 4.5% higher. Vishal Megawatt, a significant overhang on the stock in terms of leadership, has now been addressed, with the MD and CEO being reappointed for a period of 5 years. That stock higher by almost 8.5%. Weaker dollar index is something that sparked a bit of a rally as far as the metals are concerned. So most of the ferrous names are doing quite well. So names like SAIL, JSW Steel, Tata Steel, all of them higher anywhere between 1% to 2%. And the sugar stocks, that has seen quite a bit of volatility today, seeing a bit of relief rally. So names like Sri Renuka, EID Parry, both of these stocks up anywhere between 6 to 10%. On the other hand, quite a few drags as well. Baroda back, quite a few news reports indicating stress as far as the company is concerned or the bank is concerned. That stock, one of the top banking laggards today. Dixon, there was positive news, especially in terms of the PLA 2.0 scheme. But despite that, that particular stock seeing quite a bit of profit booking. And Vedanta, while the rest of the metal pack is doing quite well, this one is underperforming quite significantly. And lastly, both of the pharma names, Biocon as well as Syngene, seeing a bout of profit booking emerging or some selling pressure on both of these names today.
Okay, Vivek, thank you so much for, breaking down for us what is doing well and what's not doing well in the markets. There's a lot of individual names that are moving around and metal seeing the rally. But on that note, let's bring on board the first management for today on the show. We're talking about SIS Limited. They reported a strong Q1 of FY21 set of numbers, around a 31% odd growth on a year-on-year basis, which the company has managed to see. It's a broad-based growth that managed to report during this period as well. Now, three highlights or three focal points that we have, and we want to talk about whether this 30% growth is going to continue through the year as well, or was this a one-off sort of a case? Secondly, in terms of margin, how is the improvement in margins expected from here on as well? And in terms of Security Solutions International business, what is the outlook there? We'll discuss all of that as well as the road ahead with Dheeraj Singh, CEO at SIS, joining us on the show now. Mr. Singh, hi, good afternoon. Thank you so much for joining us on the show. So surely a good performance that's coming from the company, good growth, broad-based growth, mostly across both and all three of your segments as well. So let's break it down now. You know, you had AP Securities acquisition that came in as well. So how much is overall the organic growth versus the growth mainly because of the acquisition? And what is the outlook that one would have in terms of growth for the company for FY27?
Good afternoon. So with AP Securitas, our total combined revenue growth, as you mentioned, is upwards of 30% on a quarter-on-quarter basis. But even without AP Securitas numbers, the growth has been about 20% on the similar quarter-on-quarter basis. So the organic growth has been very strong also. Similarly, on the margin side, while the overall EBITDA grew by 36%, including AP Securitas numbers, but even without that, it's been 28% growth. All our three segments have done well on the revenue side. Facility management a little less than expected, but security, both India and international, has been very strong, and there have been some great order wins in the first quarter.
Okay, sure, point taken there. So for FY27, then what sort of a growth rate should we expect? Because, you know, even the organic growth is strong, right? 20% plus is also a very good growth for the company. Last 2 quarters, you've managed to see this 30% growth. So for FY27, could you end the year with a 30% growth?
The organic growth trend has been around 20%. We've been given, always been giving a long-term guidance of about 15-20% growth. And we hope to stick to that for this year also, overall.
Okay. Well, Mr. Singh, thanks for joining in and speaking with us. Just wanted to get more details with regards to your security solutions, your international segment, which did very well. It was up around 31%. And you're saying that majority of your new wins have come in from the defense and the aviation sector. Just give us a sense in terms of what the order book is looking like right now for you, and what can you guide on in terms of incremental revenue growth coming into this particular segment?
So the international business has grown about 36% quarter-on-quarter basis, but a lot of that growth has also come from the currency rate appreciation for the dollar, Australian dollar. Having said that, the growth in the defense, the railway sector, the airport sectors have been very, very strong. We've been getting orders for long term. There has been 10-year contracts with very good margins that our team there has secured. So we expect the revenue growth to continue for the future. Our issue out there is to fix the margin, and we are working on that in the next few quarters.
So what are you doing to fix that? And while we talk about margins, one of the triggers for margins would be repricing, right? How often do you do that? Are you doing that for newer or older clients? And is there a pushback because of this repricing that you might be undertaking?
You hit the point right. There have been growth in the wages also in Australia and even in Singapore in our international business. And there is always a lag in the contract repricing with the clients. Typically, those lag periods are between 1 to 2 quarters. So we hope to catch that in the next few quarters.
So next few quarters, you'll be able to fix this. And also, just in terms of overall working capital is what I want to understand as well. You mentioned that how these labor codes are reducing working capital days as well. So what is the current DSO and where can it go from here on as well?
We ended Q1 at about 66 days DSO, which is actually 3 days more than what we had ended in March. But typically Q1 does see a few days of increase after the March ending. But with the labor codes, as you're pointing, where it is now a joint liability of both the clients and us to pay by the 7th of the month, we expect to see a reasonable improvement in the DSO, but that improvement we'll expect to see more in probably Q3 to Q4. And that might be about 5-6 days.
Okay, and sir, just in terms of your margins also for security solutions, India side of the business, right? While we have seen good growth over there, we're seeing a bit of a contraction, just slight bit, 30 basis point, nothing much. But because of AP Securities, the acquisition coming in, do we expect more dilution, or we will continue to remain in this 5% range?
Security as well as FM in India, we are moving towards the 6% EBITDA margin, which is our guidance and as per the pre-COVID levels. In facility management, we are quite close to that. And by the Q4, on a run rate basis, we should be hitting the 6% EBITDA margin. On the security side, we are at about 5.4, 5.5%. Yes, the Cisco, AP Securitas and our other Cisco platform is a little margin dilutive as of now. But in the future years, with the scale as well as the synergies between these three entities, that will bring it at par with the rest of the security business margin, which will be about 6%. What is also happening in security, we are investing a lot for the future technology in-house as well as for the clients. We are investing a lot even in our security B2C business. So those investments will yield results in the future. But to give you an answer, we hope to equilibrium point of about 5.5-6% in the coming quarters.
So, Mr. Singh, quickly, if you can talk about the pricing, just to follow up on what I had asked you earlier, how much repricing did you take?
For the international business or Indian business, you mean?
Both businesses.
So Indian businesses, for the labor codes, ours is a cost plus margin model. So all the statutory cost, the minimum wage cost gets passed on with a percentage to the client. And we are seeing a good traction with most of our clients. They realize this is a government requirement, government regulation, and it's good for the industry overall and for the workers. And we are seeing good conversion on that front. International, as I had mentioned, it takes 1 or 2 quarters for the repricing to be adjusted.
Okay, all right, Mr. Singh, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's SIS. The stock is just about higher by around 0.6% in today's trading session. Overall, it is a bit of a subdued trading session, so the stock is just about managing to hold its head above the water today. We'll take a short break, but up next, we'll be connecting with the second company on the show. We have the management of Gulf Oil Lubricants who will be joining in to discuss their Q1 numbers as well as the road ahead. Stay tuned.
Welcome back. You're still tuned into Halftime Report. Well, Gulf Oil Lubricants reported a strong set of Q1 numbers with management confident of continued outperformance. We'll now speak with the management, focus on three key focal points: the volume growth outlook after strong Q1, Tyrex's growth trajectory, which is their acquisition, and the impact of higher crude oil prices now, because this quarter has seen a lot of it. To discuss the numbers and most importantly the road ahead, we are now joined by Ravi Chawla, who's the MD and CEO of the company, joining us now. Mr. Chawla, good afternoon. Thank you so much for joining us. Well, Q1 was really strong, 17% growth in the lubricants business. What is it that you're targeting for FY27? Will this strong growth continue across segments, especially in the light of high crude oil prices that we've seen right now? Won't that impact margins for you now?
Well, the quarter has been excellent growth, as you reported, 17% volume growth. We normally do double digit, and we've seen 30% increase in profits. I think for the quarter, we've seen supply security was a key challenge for our customers, our OEMs. So we've been able to really be agile and do that well. So I think the results that you saw were definitely keeping in mind the supply security. And as you rightly said, the costs have gone up. We're managing the margin within that cost band. We've seen close to 3 increases in the last 4-5 months. So managing that, and of course, continuing the 2 to 3x market growth. Market will grow at 3 to 4%. So we definitely look at that outlook. And last quarter has been a healthy start to the financial year.
You will continue this growth throughout this fiscal, and margins will be at 12.5 to 13%?
Yeah, so the margin band for us is usually 12 to 14%. The challenge on pricing is always there, but we are managing it well, controlling our costs also. So we continue to look at that, and the growth, volume growth will continue 2 to 3x the market growth rate, which is doing well. July to September quarter is a monsoon quarter. So it is usually the lowest quarter, but we continue to see a broad-based growth across our segments, our OEMs, our B2C business, and we see that continuing in the rest of the year. And hopefully, second half also we should see a lot of the automobile population of vehicles has gone up. That will result in a lot of good sales in our franchisee workshop business.
Okay, so you're saying that you're seeing broad-based growth at this point in time. Volume should be around 2 to 3 times X, what you are doing versus the market, and you're quite confident in terms of your margins as well. Mr. Chawla, just wanted to touch upon this acquisition in the battery space, Tyrex. What was the revenue this quarter generated? Is it EBITDA positive? How is it contributing in terms of profits? And what might we expect in terms of trajectory?
So Tyrex is a charger manufacturer. We're making chargers for the batteries and EVs. So this is a company which we've got 55% with our stake last year. And this did 100 crores last financial year. And definitely, the first quarter, some of the chargers that go into out in terms of installation have been low, but we anticipating a good growth here, and definitely looking at a 300 to 400 crores in the next 3 to 4 years from this business. It was positive last year and will continue this year also. And I think the growth is on because as you see DC chargers for buses, where we have 1 out of 3 chargers, and also AC chargers we make for some OEMs. This is a business which is growing. Of course, it is going to grow in line with the number of chargers that are installed. And we are part of that initiative, I would say. And also we are increasing capacity in the Ahmedabad plant and doubling it for the DC charger business.
And what is your acquisition, plan for the company going forward?
In terms of the increase in capacity, we are going to take it up to double it. And as I was saying, the outlook is to get about 300 to 400 crores in 3 to 4 years in terms of revenue and a similar margin trajectory as we have for lubricants.
Hi, Mr. Chawla. Good afternoon. What I want to also understand is what are the factory fill-up volumes this time? And also if you could give us a sense in terms of B2B infra volumes as well, what is it shaping up over there? While you've seen a growth this time, but help us understand this also.
So I think the growth has been broad-based. As I told you, supply security was a big challenge this quarter. So factory fill also has gone up for us for commercial vehicles. Mainly we have that, and that's done double digit. Similarly, B2C growth, as you mentioned, infrastructure, industrial. We've also gained some new customers this quarter because of our agile supply chain. But I think double digit for growth for us in all these segments have been good. Particularly, we have seen agriculture segment doing very well. And in the B2C market, our passenger car motor oils have done well. And we are also trying to sell a lot of premium grades. So I think for us, it's been broad-based and all these segments are doing well. And last year, there has been excellent growth in terms of vehicle sales across commercial vehicles, cars, two-wheelers, and we have OEM partnerships with them, which is for the franchisee workshop. So I think all of that has been double-digit in this last quarter and will continue in terms of what we look at the outlook.
Okay. Mr. Chawla, you spoke about the agri segment. Now there are fears of deficient rainfall. Do you think that could impact volumes going forward? One, in the agri segment, and second, the AdBlue segment, which has been growing for you exceptionally well. How is that doing? What was the volume growth here? You said it was a broad-based growth, but you've grown 20% historically. Did you see that number now as well?
Well, coming to the agri part, we have our own products which go into the B2C bazaar market, and we have tie-ups with leading OEMs. The tractor new products, new vehicles sold last year have been a record 20%. So that usage of the lubricants in the franchisee workshop is going up. Seasonality does play a role. The monsoon does play a role. We generally do a lot of below-the-line activation, so we're expecting that to continue. Of course, there's 3 or 4 seasons in the year across the country. Hopefully that will go well. The signs are quite encouraging now with some of the monsoon coming back. On AdBlue, we have been able to get to the top 2, top 3 position, as you mentioned, and we've been growing well. We have seen AdBlue also growing this year, and our sort of outlook for AdBlue is about 10 to 15% growth because we are on the higher price level in terms of our quality standards, and that is doing well. And of course, we have seen that AdBlue itself is getting also competitive. So we are happy to be in that, and also a lot of OEM partnerships here. So AdBlue for us is like a supplementary product.
Okay. What is the capex which is lined up for the second half of FY27, and what are you guiding for in FY28, and how would all of this add to your revenue?
Well, we are taking up our capacity in both the plants by 70%. So we continue growing 2 to 3x the market. We have certain segments where our market is below 5%, so we need to accelerate that. But we look at B2C growth, look at our OEM business. And our outlook has always been 2 to 3x the market in terms of volume. The industry is growing at 3 to 4%, and we'll continue to do that. And of course, look at opportunities where we could gain more. And definitely that where our brand is also strong, and we are getting it even stronger. So we would invest in our brand above the line, below the line. And our B2B industrial and our B2B infrastructure and OEM businesses are strong, where again we have market shares which are low, especially in infrastructure and B2B industrial. So coming up with new products and definitely looking at going ahead of the market and gaining market share.
Okay, all right, Mr. Chawla. Thank you so much for joining us today. Always pleasure speaking with you. So that's the word coming in from Gulf Oil Lubricants. The stock has spiked from the lows of the day after falling from the highs. So at the day's high as we speak. Time for a break now. Sachitanand Uttekar of Trade Bulls will join in with some trading strategies on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. You have the launch that is coming from Bajaj Auto, which has launched Pulsar 150 as well as Pulsar 125. You can see it at the side of your screens for you all as well right now. It's an important launch coming in there from Bajaj Auto. As of now, the stock is holding on to gains of around 0.8% in the trading session as well. But yes, that's the launch that we're seeing coming in for Bajaj Auto. Pulsar 150, Pulsar 125 is the launch coming in. You can see there management's on your screen for you all as well.
Thank you, everyone.
Launch. Okay, so let's that is Bajaj Auto, but with that we're going to keep it going now with the markets. And what's happening on the Nifty 50 is that 24,190. We are around that mark for the Nifty, around the day's lowest point. Not seeing much of a recovery that is coming in here. Then we're seeing IT that is managing to hold on to gains in the trading session as well. So yes, holding on to decent gains, at least for IT. Banks on the flip side is under pressure today. But on that note, let's also bring on board Sachidanand, the taker of Trade Bulls, joining us right now to talk to us in terms of the technical levels that we should watch out for today. Sachi, good afternoon. Thank you so much for joining us on the show. Today we're seeing a bit of a muted performance for the markets. We started off in the green, then we're seeing red on the screen. What are the levels one should watch out for?
Good afternoon, Vinny. Markets is lackluster right now. We have already seen a range-bound action in Friday's trading session. I think the same has been carried forward today. All it requires is a very strong closing above that 25,360 mark, where it's a 50-week exponential moving average resistance is placed. And on the lower side, right now it is trending near its immediate support of 24,190, where it's 50-day exponential moving average is. So I think unless we don't see a decisive breakout or a breakdown outside this particular range, one should not expect momentum. But from a trading perspective, it's better to avoid any fresh trades in the Nifty and wait for this levels to get surpassed, and then probably one can deploy a directional based trade. But when we look at the broader structure, broader markets, I think there are ample of opportunities going on. Capital markets and metals are buzzing today, and from that space, we like BSE. If you look at the overall structure, we have seen some signs of stability near its 200-day exponential moving average support. On the 60-minute scale, there's a falling wedge formation which is mature. We have already seen a good positive divergence on its RSI, so we're expecting a rebound in this particular counter. One can build fresh long positions in BSE futures, keeping a stop loss at 3272 on closing basis, and a trading swing can be expected towards 3386, followed by 3440. The other stock which is on our radar is Jindal Steel. Now, if you look at the last week's structure, we have already seen a very confident price action above its 200-day exponential moving average. Already there's a positive crossover on its 5 and 20-day exponential moving averages as well. So we're expecting a good follow-through action here. Keeping a stop loss at 1132 on closing basis, one can deploy fresh long positions in Jindal Steel futures for a trading target of around 1166, followed by a positional target at 1200.
Okay. What about other specific stocks that you might be looking at, Sachidanand, in today's trading session? Steel seems to be doing well in today's trade. IT seems to be showing some amount of upside.
From the steel space, we do like Tata Steel as well, but I think Jindal Steel, the structure has been very confident. We've already seen a good price action last week. There's a bullish flag formation on its daily scale. That's why we continue recommending this particular counter. Apart from that, Concor is one particular counter wherein we have seen some price stability. We are expecting a good reversal in this particular counter itself. One can keep a stop loss at 515 on closing basis and expect a reversal back towards 546, 560 zone.
Okay, take that point. Sachidanand, thank you so much for joining us as always. So those are some technical trades and bets from our technical expert. But let's understand what's happening in the world of F&O. Mangalam is joining us now with the setup. Mangalam.
Well, there is a fair amount of volatility and choppiness as we speak across the frontline indices. The Nifty Bank is the bigger culprit out here, even though the mid-cap index is doing a lot better than the other parts of the market. We are seeing some traction which is holding the market up, which is that of the metals pack as well as the IT index. The Nifty bank lower by almost 420 points. But as we speak, around the 24,200 mark is where the fulcrum is. The 24,200 call and the 24,200 put, both of them that expire tomorrow, fairly active in trade. 200 call has a premium of almost 66 rupees. The 24,200 put that comes up for you has a premium of close to around 67, 68 rupees as well. So put both of them together, you are playing for a premium of almost 150 rupees on either side of 24,200. Tells you again that the Nifty is likely to be in this range of 24,050 to about 24,350 thereabouts, and that is likely to continue as well. But if you look at the technical range for the market as well, it's pretty much positioned between the 50-day moving average of 24,182, very close to where the Nifty is right now, and on the way up 24,370, which is the 20-day moving average, which will prove to be a stronger resistance. So if the market were to bounce back from here, we would obviously see 24,370 as the next leg of resistance.
Okay, Mangalam, thank you so much for that. But with that, we're going to step into a very short break. After the break, we'll have Manisha Gupta, who will be in conversation with Arshil Barot of Metals Focus to decode the rally in precious metals. Stay tuned in.
Welcome back, and joining us on the show now is Harshal Barot. He's Principal Consultant, Metal Focus. Harshal, hi, thank you so much for joining in. And what the last couple of weeks has been, it's been one-way rise into the prices. We are holding above $46.50 an ounce right now. I remember our previous conversation where you did mention 4,600, 4,800, 5,000 in those jumps therein. From where we are right now, what's your sense?
I think, Manisha, the trend very much still looks positive. So I think the next hurdle is around $5,000. Importantly, given that in India we had a duty hike and rupee depreciation, that would equate to probably an all-time high in India level terms as well. So I think from a macro perspective, the environment has turned increasingly positive. Some of the decisions from the US Treasury, right from intervening in the yen market to bond buybacks to contain the long-term yields. I think all of this has sort of provided confidence to the market that the Fed is not in a position to hike rates, and even if it does, not very aggressively. So I think that's something that's changed this month. And we think, given the geopolitical backdrop as well and the US midterm elections coming up, the chances of a Fed rate hike are very, very slim, and that is clearly very supportive for precious metals investment.
How are you looking at the Indian buying, though? Because everybody keeps talking about IIJS and how that was a game changer. We saw stronger numbers coming in. Some estimates also talk about 700 crores of perhaps business done there and then. Of course, we do understand that there are orders that continue to extend if that works well. But how are you looking at markets currently?
I think India, as you mentioned, the jewelry show had a very good response. So from what we understand, the order flow was good initially. But given where the price is, there are chances that some of the orders are cancelled or delayed, which typically happens when the price rises very fast. But overall, we expect, I think, the Indian demand will recover, going forward, because we have a bit of pent-up demand given the last 6 months were slow. And given it is the wedding and festive season, so typically seasonally also this is a strong period. So we expect Indian demand to pick up, and with the price momentum picking, I think investment demand is also starting to pick up across a lot of markets that we are tracking. So jewelry demand, may see some disruption because the price has risen, but investment demand, which sort of slowed in the previous quarter from a retail perspective, I think that is starting to pick up.
When you talk about the physical demand itself picking up, is it going to be mostly bridal, or do you think there's going to be gold jewelry, studded jewelry? Are we looking at picking up any trends yet?
So I think, given there is the festive wedding season coming up, bridal jewelry, will definitely play a big role. But in terms of the daily wear segment, that's where I think the bigger disruption is in the market in terms of, shifting to lighter weights, lighter carats, so 18, 14 diamond jewelry. So the daily wear segment is seeing sort of more structural action taking place just because of the price. The bridal segment typically is sticky in India, so that still remains 22 carat. Yes, we are seeing weights being lowered there over the years because of the price, but we are not seeing a big disruption in that segment, which is sort of 50% of India's jewelry demand.
All right, weight is lower, but people are sticking to 22 carats. That's an interesting one to know. How are you also looking at silver? Because it's a divided street as far as that goes. A lot of people telling us, oh, gold is an outperformance vis-a-vis silver. Others tend to differ. How are you looking at this? And what's your sense also on silver?
So, Manisha, in two parts, I think from a short-term perspective, I think next couple of quarters perspective, it is very possible that silver may underperform. Because given the drivers that we are seeing for precious metals at the moment, I think they are far more in favor of the gold price rather than silver. But I think beyond that, I think once probably gold achieves or nears the all-time highs, that's when I think we expect silver prices to start picking up, and then maybe eventually outperform gold over a 2 or 3 year horizon. But from the next couple of quarters perspective, I think silver will underperform.
How are you looking at silver demand when it comes to India, physical as well as investment?
So compared to gold, what we gather is that silver demand is still slow. So we've not seen any major pickup in silver demand. It's probably also got to do with the fact that we have very strong imports in the first few months of the year. So people are still sitting on stock, whether it's fabricators or bullion dealers. So even though, we have these import restrictions around silver, but nobody in the trade is actually sort of feeling a shortage, which suggests that demand is still not high enough for that to pinch.
Point taken. All right, Harshal, thank you so much for joining in. So that's the sense coming in from Metal Focus. Very, very bullish when it comes to gold and silver both. Gold especially $5,000 an ounce as a target by the time this year ends. Silver next 2 to 3 years perhaps could be outperforming gold going forward. So clearly precious metals continue to glitter and glitter quite sharp.
Okay, closer to the festive season as well. So let's see which way demand goes and price especially. Thank you, Manisha, for taking us through that conversation. Mr. Barrow, thank you so much for joining us. Slip into a short break. On the other side, we'll talk about stock markets and stock-specific actions. Stay tuned for that.
Welcome back. Well, it's definitely pressured for the banks today. So we have the bank Nifty, which is now down around 0.7%. And like we sort of estimated right at the start of the show, there is a little bit of a worsening which has taken place in terms of the advanced decline ratio, which is absolutely even keel as of now. So 2,100 and 73 stocks advancing to around 2,178 stocks declining. So there's a little bit of a crisscross, as you can see, which seems to be taking place as we speak. But nonetheless, in terms of specific stocks, like we've been pointing out, it is a dull day for a lot of the banks in today's trading session. So do watch out for stocks such as Bank of Baroda, which is down around 2.5%, Ujjivan Small Finance Bank, which is down around 2%, Canara Bank, which has lost around 2% in today's trading session as well. But one stock that I'm tracking from the broader markets is Kaplan Point, and that stock is down around 2.5% today. That is because the US FDA has issued 10 observations to the company's sterile and ophthalmic manufacturing facility. Now, this particular inspection took place, which was unannounced. It took place from the 13th of August, and the company says that the observations are procedural in nature at this point in time, and they will be addressing the observations comprehensively and respond to the observations. But remember, for a sterile plant, for something that manufactures injectables as well as ophthalmic products, which is basically goes into the eye, it's always much trickier in terms of observations or any kind of US FDA action. So maybe that's what the street is a little concerned about. But remember that Kaplan has always generally had a good track record in terms of US FDA compliance. So let's see what the outcome is. But on that note, we're going to take a short break. We'll get you a lot more on the markets and get you Lalita Jewelry also, which has made a strong debut. So we'll get you an update on that.
Welcome back to Halftime Report on CNBC TV 18. Now, let's talk about Lalita Jewelry that makes its debut on Day Street today. Market cap crosses 11,500 crores on listing day. Let's go across to Mangalam to give us more details on this one. Mangalam?
Well, it's a strong listing that we've seen for Lalita Jewelers. The market cap, as you pointed out, has crossed 11,500 crore rupees on listing day itself. For one who is uninitiated, it is a jewelry retailer from South India. In fact, they have about 61 stores across 51 cities in all the major southern states and the union territories likes of Tamil Nadu, Andhra, Telangana. We have Karnataka as well as Puducherry as well. But if you look at the numbers, a large part of the growth, just as all the others in the jewelry space have played out, has happened just in the last year between FY25 and FY26, where there was a big spike in gold prices. We saw that surge across the board in all the jewelry companies, and Lalita Jewelry isn't any different. So their growth between FY23 and FY25 was a lot lower, but between FY25 and FY26, revenue for almost 17,000 crores has gone all the way up to 25,000 crores. Margins expanded as well, and a net profit jump from 350 crores to about 1,000 crores. But remember, this hasn't come by with improving internals. Their inventory days has jumped from 99 to about 159. Operating cash flow in the last financial year was negative 401 crores versus a positive of 290 crores in FY25. And borrowings as well doubled from 1375 crores to about 2,000 crores in FY26. And interest costs increased from about 191 crores to 242 crores as well. So the last year, everything did well in the jewelry business, but whether this sustains or not is something that the street will be tracking despite the stellar listing that we saw on the company today.
Take that point, Mangalam. Thank you so much for bringing us all those details about Lalita Jewelry, the new kid on the block. Well, that one is doing well. Banks, those are the ones which are at the day's low. Take a look at ICICI Bank. That is the one which is dragging the bank nifty lower as well. So that chart should come up for you on the screen. A sharp slide from the highs. SBI, Axis Bank, HDFC Bank, Kotak Mahindra Bank, all of these stocks are the ones which are putting a lot of pressure on the nifty as well. We do have the other names, the likes of BEL, Maruti Suzuki, Bharti Airtel, some of these stocks which are at the day's low in the Nifty pack. So the pressure continues. Whether we stop here or there is more pressure from the highs of the day remains to be seen. But with that, it's a wrap on this edition of Halftime Report. Stay tuned. Business Lunch will take all the action ahead.
Stocks swing between gains and losses ahead of U.S. Treasury Secretary Scott Bessent's Iran sanctions presser. Metals and IT gain, while financials and FMCG drag. Taj Hotels owner Indian Hotels scripts a merger with subsidiary Oriental Hotels to enhance growth, even as it is on the prowl for an acquisition of nearly 2,000 crore rupees in size. CEO Puneet Chhatwal remains tight-lipped on any likely deal. The 62,500 crore rupee mobile PLI 2.0 kicks in, offering incentives till FY31, targeting production of 39 lakh crore rupees and exports of 15 lakh crore rupees. Minister Ashwini Vaishnav bats for a homegrown mobile brand and an export push. Lenskart sees a block deal of near 2.6% of its equity, worth a little under 3,000 crore rupees, with a SoftBank fund being the likely seller, while Meesho sees a tad over 1% being sold, mostly by Y Combinator for nearly 970 crore rupees. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan. Good afternoon, guys. It's a volatile session for the markets, a dull day to say the least. The Nifty and the Sensex, both of them seeing cuts of about 0.3%. The Nifty near that 24,180 mark. As we speak, the banks seeing a bigger cut. That Nifty Bank index is down 0.7%. And we've got the mid-cap index that's managing to do better than the blue chips, but it's barely in the green, absolutely flat with a slight positive bias. Now, if you take a look at the sectors that are doing well today, in the green, we have the metal pack. We've got Hindalco, SAIL, Nalco, all of them up between 1 and 4% in trade. We've got Nalco there 2.5%, SAIL nearly 4% higher. If you take a look at these IT stocks, they're also managing to clock some gains. That index is about 0.5% in the green. We've got stocks like Infosys, HCLTech, Wipro, all of them gaining over 1% in trade. But on the downside, we've got PSU banks that's leading the fall. We've got that index is down 1.2%. We've got SBI that's down over 1%. We've got Bank of Baroda and Canara Bank, both of them down over 2% in trade. The defense pack also seeing cuts. BEL, HAL and MTAR Tech, all of them down between 1 and 3%. So that's how the markets are shaping up this afternoon. But first up on the show, we spoke to Puneet Chhatwal, MD and CEO of Indian Hotels. He says the company could deploy up to 2,000 crore rupees for inorganic opportunities from its 4,500 crore rupee cash balance. Take a look.
If any other inorganic opportunity comes up, it would really be a meaningful deployment of the cash that we have. We have 4,500 crores of cash. So we want to keep a watch list for any kind of bad times, unforeseen bad times that may come. And that could be 50% of that money. Another 50% goes into routine capex as well as new projects. But we keep accumulating cash in the quarter by quarter and years by years. So I think anything up to 2,000 crores is for us today not a big amount to think about. And also I must say that the going has been very good. What we discussed the last time I was on your channel, I think there was some misunderstanding in terms of our top line guidance. I think Mangalam was able to pin me down on that. And I think what I said at that time, 14 is minimum, but with a bit of luck, we could get to 15. So I think we're still very much in line with that of 15% plus top line growth. Anything which is closer to Indian Hotels, 35% or 30% plus. So a bandwidth of 30 to 35 is what we'll aim for.
Precious metals are on a tear in safe haven buying. Gold prices are at a 3-month high, while silver is trading at 2-month highs. Manisha Gupta is here to get us off all the action from the commodity space. Manisha?
Well, on a day where you have the equity markets declining, rupees slightly soft as well, bonds have declined. It is the precious metal prices which continue to shine well. It has been 3 weeks of constant gains, and this week as well, it has started on a positive note. If you look at the prices, well, gold is trading at a 3-month high, silver at a 2-month highs as well. And for the month of August, while gold has gained up by 14%, silver is up nearly 22%. The concerns about the US debt and financial stability is something that has been keeping gold in favor. The dollar index trading at around 3-month lows also has been quite supportive. And then US Treasury ramping up buybacks of larger dated government debt is also something that has led to money rotating in case of precious metals. The geopolitical tensions has been yet another reason. The physical demand, the investment buying, all of that seems to be coming back in precious metals as the prices have started to go slightly higher. It's going to be a very heavy, data-heavy week in that sense. You have the US inflation data, that is one thing coming up. Jackson Hole Symposium is yet another area where the US Fed will be speaking, and markets will want to try and get guidance about interest rates, currency, etc. That is something to watch out for. It also is about Canada now planning retaliatory tariffs after US imposed 50% on certain Canadian goods, and the talks between US and Canada seem to be all but collapsing. So the tariffs coming back into fore also has led to buying in the Western world as well when it comes to precious metals.
All right, Manisha, many thanks for those details. Now, Symbiotic Pharma Lab IPO, 1,757 crore rupee issue opened today. Earlier, we caught up with the management, CFO Raghavendra Ramachandran and CMD Anil Satwani of the company to discuss their plans on debt reduction and revenue guidance. Take a look.
The debt as of 31st March 2026 is roughly about 380 crores. And through this 150 crores of primary from the IPO, we expect to reduce it further. But on our API business, steroids and hormones business, where we already have roughly about 900 odd crores, this comes at an asset turn of roughly 1.5 to the assets. So that gives you a sense on a business like API, where we already have 1.5 times the asset turn. We have put in 870 crores in very niche business segments. One is the complex injectable, the other is the CDMO fermentation, which from our standpoint is more accretive to the existing business.
Look, historically, we have been an API company focused on the steroid and hormones, where we have the global leadership in this niche segment. And this is where our primary revenues are coming from. Definitely, this is close to $1 billion addressable market, and we already have achieved over $100 million in sales revenues. To that extent, we have a niche global leadership. But these numbers cannot be relied upon 100%. Why? Because you have to do an extrapolation using the formulation numbers where what would be the API size. Slightly complex, but you can be assured that in certain products within steroid and hormones, we have a significant global leadership.
On that note, it is time for us to head into a short break, but we'll get you all of the updates from West Asia on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. On to the latest updates from West Asia. U.S. Treasury Secretary Scott Bessent says Washington aims to sever every economic lifeline that sustains Iran. This comes ahead of an expected announcement from the U.S. to impose extreme economic sanctions against Iran. CNBC's Dan Murphy gets us the latest updates from West Asia. Dan?
Washington is preparing its toughest ever sanctions campaign against Iran, what Treasury Secretary Scott Bessent is calling economic D-Day. In an op-ed for the Financial Times, Bessent invokes the Allied planning for the Normandy landings. He writes, quote, "At dawn begins an economic D-Day, the single greatest financial offensive ever marshaled against an adversary." Bessent says the US is now entering the endgame, and that the objective is to, quote, "sever every economic lifeline that sustains the tyrannical regime until Tehran stands alone." Bessent also makes clear that Washington is putting everything and everyone in the crosshairs. He writes, "Any remaining tie to Tehran will hasten the economic ostracism of countries and entities, whether that tie be purposeful or willfully ignored." Iran is answering that threat with a threat of its own to the world's oil supply. The Secretary of Iran's Supreme National Security Council, Mohsen Rezai, said on social media that, quote, "Not a single drop of oil will be exported from the Strait of Hormuz or from anywhere in the Persian Gulf." He also said any country supporting America's economic war will be treated as an act of war.
We will first negotiate with them. We will hold talks and tell them to step aside and distance themselves from the United States. But if they do not act, we will strike. We will target that country's interests.
Iran's Foreign Minister Abbas Araghchi also dismissing America's threats as a sign of desperation when he spoke to press on Sunday.
They must understand that there is no option other than respectful dialogue with the Iranian people and a solution based on justice and dignity. They should put all of these aside and return to a path that has been tried before. Iran's nation will respond respectfully to the language of dignity.
So Dan, there with the latest on what's happening in West Asia. Now, investors are looking to US Fed Chairman Kevin Warsh to clarify his views on how the US Central Bank will react to stubborn inflation on Friday in his annual address at Jackson Hole Symposium. CNBC's Steve Leesman tells us more.
Markets seem likely to get some of what they're after from new Fed Chairman Kevin Warsh in his speech in Jackson Hole. That is, more on rates and his views on the economy. Meanwhile, the new chairman faces new challenges from higher bond market rates. Expectations for the new Fed chairman's first keynote at the conference include more detail on his economic views and the outlook for rates, updates on his 5 task forces, and clearer statements on how he will react to higher inflation, that is, dispelling any notion that he's unwilling to hike interest rates. It would make sense of Warsh to make a distinction between how much detail he gives about his outlook after a press conference, that is, when he speaks for the committee, and how much he gives when he's speaking for himself. Many in the market are hoping for more.
I just think we need to know the reaction function. I just think we need to know, what are you looking at? What is important to you today? Is it more inflation? Is it more employment? Are you looking at, by the way, there's a series of indicators in employment. Are you looking at demand, supply? Are you looking at a whole series of different indicators? To get some clarity on that, then markets can do their job in interpreting it and putting a price on that.
John Hartley, policy fellow at Hoover and economics professor at UT Austin, telling me, my guess is that Jackson Hole will tilt toward being a hawkish event as the FOMC is moving towards trying to tee up rate hikes in late 26 and 2027. The conference this year focuses on financial innovation and its effects on banking, monetary policy, and the global financial system. But the unofficial agenda will likely include the Treasury's attempts to tamp down high bond yields and how that might or might not end up involving the Fed.
So, Steve, there with what to expect from the Fed chair. But on that note, it is time for us to head into another short break. But more news and updates from Commerce Minister Piyush Goyal's Japan visit on the other side. Welcome back. You're still with us on Business Lunch. Commerce Minister Piyush Goyal is in Japan to further Indo-Japanese trade ties. Abhimanyu Sharma is here to get us all of those details from what's happening in Japan. Abhimanyu?
Several outcomes expected from India's Commerce and Industry Minister Piyush Goyal's visit to Japan, in which a review of the 2011 India-Japan trade deal is also on the cards. The deficit in bilateral trade for India is rising with Japan. Primarily, it's driven by specialized manufacturing and tech imports. Now, both the sides are looking to deepen their bilateral cooperation in several areas like semiconductors, critical minerals, and pharmaceuticals. Japan aims to invest $62 billion in India over the next decade. Over $1.2 billion worth of investments have already been made by Japan into India. It remains to be seen what further outcomes are going to emerge from the deliberations between the Indian leadership as well as the Japanese leadership. Now, industries from both the sides, industry chambers from both the sides are also taking part in deliberations. Piyush Goyal is slated to take part in a roundtable with industry chambers. He has already held meetings with the Japanese leadership and he's going to chair a roundtable on capital goods and automobiles. He met the leadership of several Japanese as well as Indian companies, and the Indian delegation is also going to meet the FinTech Association of Japan as well as the delegates from the Japan Aerospace Exploration Agency. It remains to be seen what further outcomes are going to emerge from the minister's visit and from the industry deliberations which are currently taking place.
All right, Abhimanyu, many thanks for those details. Now, in a bid to bolster India's mobile phone manufacturing ecosystem, the government has notified another tranche of the PLI scheme. It has allocated an outlay of 62,500 crore rupees for the next 5 years. Ashmit Kumar is here with all of those details. Ashmit?
Well, an important policy initiative, the formal announcement coming last week, Ashwini Vaishnav announcing the notification of the mobile phone manufacturing scheme. Again, as you correctly pointed out, the outlay 62,500 crore rupees. It will be spread across a duration of 5 years. Now, what's important is that it is markedly different from phase one. Phase one was focused more on ensuring manufacturing here, but there are two focus areas as far as this latest 2.0 scheme is concerned. Number one, of course, is mobile manufacturing. There's a graded mechanism for issuance of incentives between 2.25% to 5%. There are additional benefits if you do local sourcing. There are additional benefits if the R&D is done here, if the IP rests here, and that is, of course, geared towards ensuring more manufacturing here, ensuring more exports coming out of India. That's phase one. The other aspect, however, that the government is very keen on is developing a national champion. That was missing from phase one. What Ashwini Vaishnav, the minister, told us last week is that there are already conversations underway. They've identified 3 players. The government, they're in conversations with them, and they're hoping that by the mid of 2027 is when we'll begin to see some traction, some movement in terms of launching of an Indian brand that can compete with the best in the world. The focus, however, for the government is that there can be no compromise on the IP and the R&D being done here when it comes to a national champion, and there can be no compromise in terms of quality. The government's mandate is you have to compete with the best in the world.
All right, Ashmit, thank you so much for taking us through those details. But let's also listen into what the IT Minister Ashwini Vaishnav has to say.
Segments which are economy segments, then there are premium segments, then there are super premium, then there is a very high value mobile phone. So there are basically 4 segments normally seen in the smartphone. We are asking the industry which segment you would be comfortable with. Their point is that we would like to play in a segment which has very high volume. Because once we have the volume, then we can really have a sustained play, sustained production and a sustained market going forward. So the industry has to now take the final call. The industry has to now take the final call. They have to come up with the design and prove that the IP is their own. It is not just a copy of somebody else. It's very important to have the IP Indian owned by that company, and we are going to be very particular, very meticulous in evaluating that. As you know, in the each and every meeting with the industry, we always force them to have their design capability, make sure that it is Six Sigma quality, make sure that they are focusing on Swadeshi supply chain, make sure that they are focusing on having talent development programs.
Bajaj Auto has launched the all-new Pulsar variants in the 125cc and the 150cc category. The new models feature new engines, frames and suspensions and 5-inch screens with navigation support. The 125cc variant is available at an ex-showroom price of 92,990 rupees, while the 150cc model starts at 1.15 lakh rupees. And before we close the show, a quick check on the markets. The Nifty now at 24,175, below that key level of 24,200, about 0.3% in the red, around where we started the show itself. The mid-cap index also absolutely flat. We've got the Nifty Bank that's seeing cuts more than the blue chips. It's about 0.8% in the red. If you take a look at the stocks that are doing well, we've got Hindalco, Infosys, HCLTech. So those metal names and those IT names that are leading the up move or capping those losses, to say the least. And on the downside, we've got those defense name stocks. We've got BL, which is the top Nifty loser. It's about nearly 2% in the red as we speak. We've got Bajaj Finserv, Adani Ports, SBI, all of those stocks also in the red. And if you bring up the advanced decline ratio, it's right now in favor of the declines, but almost even Stevens on that. But with that, it is a wrap on this edition of Business Lunch. Mid-Cap Radar will take all the action forward.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always Vivek Iyer. Well, markets have taken a turn for the worse. We are at the day's low and the Midcap index is absolutely flat. Some positive bias, but the advance decline ratio are in the favor of declines. Banking index putting a lot of pressure on the Nifty. A lot of constituents there also at the day's low.
Good afternoon, Sonal. Absolutely right. Quite a dull trading session, especially in terms of muted volume activity also that we are seeing. But we have a lot lined up for you in today's show, including primary market action. So that's something that we'll be tracking as well. Let's start off with the top headlines. Market trades near the low point of the day with the Nifty trading below 24,200 levels. Financials, FMCG and consumer durables drag, while IT and metals buck the trend.
Taj Hotels owner Indian Hotels scripts a merger with subsidiary Oriental Hotels to enhance growth even as it is on the prowl for an acquisition of near 2,000 crore rupees in size. CEO Puneet Chhatwal remains tight-lipped on any likely deal.
HCLTech Technologies announces their AI-first strategy. CEO R. Sri Krishna says over 50% of the company's revenue is already AI-infused. The company reportedly is also looking at a $3 billion revenue target by 2029. Brokerages, however, stay divided on the stock.
Retailer Vishal Mega Mart announces the reappointment of MD and CEO Gunender Kapoor for a fresh 5-year term. Stock skyrockets at lunch hour.
A muted market debut for Horizon Industrial Park stock. The stock lists at rupees 60.25 a piece versus an issue price of 60 rupees. Shares of Lalita Jewellery Mart on the flip side list at a 32% premium at rupees 265 rupees a share versus an issue price of just 201 rupees a share.
All right, those are the top headlines that we are tracking. For the markets, we started in the green, but in last couple of hours, we have seen a sharp fall. There is an attempt to recovery right now as we speak. So the Nifty is above the 24,150 mark. However, it is the bank index which is putting a lot of pressure on the Nifty as the banking index is seeing a bigger cut in trade as we speak. The mid-cap index, though, is the one which is just at the flat line, but the advance decline ratio is in favor of declines. So let's just talk about a lot of individual names that we have. Doesn't look like a very green looking screen on the broader markets.
Well, that's right. And, defense, aviation, all of these names, capital goods also, at one point of time was doing quite well, was bucking the trend. But defense has taken a turn for the worse. HAL and Bharat Electronics, both of these stocks at the day's lowest point, even as we speak. But these names and a whole host of other names is what Ria has on her radar. She's standing by the wig wall to take us through all of the mid-caps that are moving around in the session.
Well, yes, starting off with the gainers first, we have Vishal Mega Mart as well as HCLTech Technologies, both seeing strong gains in today's trading session on the back of strong volumes too. Nearly 11 to 13 times the 30-day average volumes traded on both of these counters. We also have Urban Company, EID, Parry as well as Reddington seeing strong gains today. Urban Company up nearly 7%, Reddington also up over 5%. And in addition to EID, Parry, some other sugar stocks also seeing some gains in today's trading session. And apart from these names, we also have stocks in the segment of rice exporters, which are seeing healthy gains today. There's LT Foods as well as KRBL. In fact, LT Foods is trading on the back of strong volumes, nearly 75 times the 30-day average volumes traded today. And on the flip side, looking at some of the losers in today's trading session, we have BLS International, Aegis Logistics, Schneider Electric, Credit Access Grameen, as well as Coromandel International. All of these stocks taking a cut in today's trading session.
All right, thank you so much for joining us with all those details, Ria. So those are some stocks which are on our radar now. Let's move on and talk about some primary market action. Delhi-based air freight forwarding and logistics company Skyways Air Services, 583 crore rupee IPO opens for subscription today. The issue comprises of a fresh issue of 399 crore rupees and an offer for sale of 184 crore rupees. The proceeds from the issue will be used towards the debt repayment of 216 crore rupees and working capital. Let's welcome Yashpal Sharma from the company to discuss the issue opening of their company, most importantly the outlook going forward, and to understand the business as well. Mr. Sharma, good afternoon. Thank you so much for joining us today. Let's talk about the business now. First up, on the proceeds after this particular IPO, will you be completely debt free? What will the other usage of these proceeds be?
Hey, good afternoon to you. Thank you for having me here. So after the listing, the proceeds are going towards, a sizable part of the proceeds are going towards reduction of our debt. So about 216 crores we use towards the reduction of our long-term debt. And also about 130 crores we are going to use in the working capital growth of the organization in the future.
Okay, Mr. Sharma, give us a sense of the current total debt. We just missed that number. What is the current finance cost at which your borrowing is at? So that will give us a sense of what could be added to the bottom line once this particular 220 odd crore and 130 odd crore, does get extinguished from the balance sheet.
So at a net level, we are only at about 198 crores debt. We have a long-term debt which we had taken for certain acquisitions, and also the working capital debt. So in all, the gross debt book looks like about 600 crores. And once the debt percentage, of course, is different from banks to banks. The working capital debt is slightly at a lesser cost at around 7.3 to 7.5%, and the long terms are slightly in the range of 9 to 11%. And that is what we intend to do, that we want to deleverage our balance sheet by, getting this debt off us. And this will really support us as we grow towards improving our profitability. We expect about 16 to 18 crores of interest cost reduction through this debt this year. And definitely in times ahead, that will be a good one for our profits.
Okay, 16 to 18 crore rupees of interest cost savings is what you'll see in this year, and you are sitting on a base of around 63 crore rupees. Mr. Sharma, two things that I've noticed in your financials. One is your operating cash flows in FY26 have seen a turnaround. It was like negative 9 crore rupees in FY24, and now they are at 113 crore rupees in FY26. Additionally, your employee attrition was 43.7% in FY24, which has come down to 18.7% in FY26. What led to this improvement just ahead of the IPO year?
So, changing your strategy from time to time is a very constant, and you have to relook how you're structured in an organization. And as we have been strongly investing in our technology piece in the last 7-8 years, and this technology is helping us to, improve the ease of transaction for our customers, and also our internal piece, tying up the strings with our, we are today API with all our major airline and shipping line partners, our integrator partners. So that has helped us to, restructure our organization in terms of the workforce. And we feel that, in times ahead, the increase in workforce would not be as much in the increase of our business. So the
cash flows? What about operating cash flows?
So the operating cash flows, as you scale up your business, the profitability starts to get better. We also get PLI, incentives at the end of the year from our carrier partners when we hit the higher levels of our scale, which is helping our profitability. And also, some of these GST refunds, etc., which were, our industry air cargo was kind of in the sunset clause till 3 years ago. And after that, GST was imposed. So there was a cycle in which the GST refunds could start coming in, and which is now over the last year, that piece has sizably improved and is helping on our cash flows now.
Is that something which would not be sustainable? You can't get GST refunds every year, right? So what happens to operating cash flows from here on?
So see, the profitability cycle of the organization is definitely, like I said, the volumes are growing very nicely for us. And those higher volumes are helping us to improve our profitability. And as you saw that, like you spoke on the attrition piece just now. So if the workforce increase and the other costs are kept in check, and you're able to use technology to improve your reach in the market, acquire bigger customers, a bigger number of customers, that helps you to make sure that your cash flows continue to remain better in times ahead. Also, the way we have been able to recover our dues from our customers, the working capital cycle has got better. If you would have seen, it's come down from 90 to 75 days at a gross level. So a lot of these factors are helping us in improving our operational profitability.
Okay. The other question which we want to ask you is, we take all of your points on board. In certain years, what we noticed is that, the trade receivables have grown faster than the revenue. So are you supporting your partners in a manner in which you're stretching collection cycles to book revenue? That's something that, the street would like to know. Going forward, what is going to be the policy that you follow as far as revenue recognition is concerned?
So we've not extended any extra days. And like I said, the gross days have actually come down. If you look at how they've come down from 90 to 75 days, the organization is very handsomely positioned with, controlling a sizable capacity from the carriers, which helps us to go to the customers. And we are the largest air cargo company of India, in the air export segment. So we have a 5.64% market share. So that helps us, in fact, to leverage businesses at a faster pace. And also it helps us to get better profitability and better stickiness with the customers.
The current working capital cycle, and how much has how much has it reduced from? Give us these two numbers.
So from a gross 90 days, it's gone down to 75 days. And because we also get credit from our carrier partners, so currently we're at about 43 net days.
And this is something which is sustainable?
Yes, absolutely.
Okay. Mr. Sharma, in terms of partners, you have a significant ongoing contract as far as Qatar Airways is concerned. We understand that there's a bit of a renewal pending as far as Qatar is concerned. What is the status on that front? And as far as your other partners are concerned, what is the typical cycle or typical contract period that you tie up with them for? And how many of these contracts are up for renewal, in the coming year?
So most of this year's contracts are already renewed. And, what happened in the Middle East in March actually just pushed a couple of contracts to take slightly longer than they usually do to get signed. The Qatar Airways contract is all done. We finalized all the terms and, just the sign off will happen hopefully in the next few weeks. So we're good to go. Generally, all the carrier contracts in terms of capacity are for 12 months. And that gives us access to great capacities that these carriers have, whether they are some of the European carriers or Middle East carriers, Indian carriers, and even Far East carriers. So we sign up for a year and that gives us access to a very sizable capacity from them.
So your Qatar renewal will happen, is what you're saying?
Yes, absolutely.
Okay. So two more things from your RHP. A UK complainant filed an FIR in December 2025, naming the alleging bribery and inflated freight rates causing 44 crore rupees direct loss. What is the stage of this FIR police investigation? And there was some compliance and secretarial function as well, some compliance issues there. What are the updates on these two pieces?
So the EOW case, all the relevant documentation has been well filed with the department, and the investigation is on a completion stage now. And matter is sub judice, and we've given all the disclosures in the RHP as well. And we are very hopeful that law will find the right course and come out with their judgments in the right way.
And what about the compliance delays? ROC filing delays from 16 form types. There were Labour Welfare Fund non-registration in several states. What led to those compliance issues?
So there were certain issues that were pending. The one that we had done an acquisition of one of the companies where some things were pending, but they've been taken care of now. And all the necessary compliances, we are a very compliant organization. And we make sure that if anything by any chance is also left behind, we take care of them and get them completed in very quickest possible time.
Okay, Mr. Sharma, thank you so much for joining us. We wish you all the best for your ongoing and upcoming IPO, and we hope you will join us once again and give us more specific guidance metrics to track as far as FY27 is concerned once you get listed onto the exchanges. Thank you once again.
Thank you. Have a great day.
Well, we'll now slip into a short break. Up next, we will connect with Motilal Oswal's Ruchit Jain for a quick technical check on the market. Stay tuned.
Welcome back. The weakness in the market continues. A lot of these banking names are at the day's low. So let's try and understand what is the next important level we'll be tracking on the Nifty. Richard Jain from Motilal Oswal Financial Services is joining us for just that. Richard, good afternoon. Do you think we'll see lower lows now? And what is the sector which will continue to pressurize the market? Bank Nifty, do you think the downfall will continue?
Yeah, hi, very good afternoon. Well, we believe that markets are just into a consolidation or a time-wise corrective phase. The support is there around 24,000, 23,900 zone. But until that range breaks, I think we won't be in a camp where we expect some significant downside from here on. So even if you look at the market breadth since last 12-15 days for the mid caps and the small caps, that has not been that bad, which we usually see in the downtrend. So the broader trend does not seem to be negative, but more of a time-wise correction. I think 24,000, 23,900 should hold on the lower side. But yes, one should not even expect a significant momentum until we surpass that 24,500 mark again. So whether if you even look at the Bank Nifty index, then 57,000, 5600 remains a good support, where the 200 EMA for the index does the trend. Things just seems to be in a consolidation or time-wise correction for the near term.
Okay, Richard, and what are your individual trading ideas for the day?
Very selective, but we are looking at one theme where, in spite of such markets of last 10-12 days, which are the sectors or which are the stocks where we are witnessing new highs getting formed, or where the momentum is on the stronger side. So within stock-specific suggestions, Siemens is one stock which is looking quite positive. A clear high top, high bottom structure on corrections. The stock has not even breached its 20-day EMA. And today, the stock has resumed its broader uptrend. So Siemens, I think, can be bought at current levels with stop loss below 39.50 for potential up move towards 4,300. And commodities is one segment where we are looking at a good momentum on the positive side. The metal space, we can see the volumes are again getting built up, and the metal space has already gone through a corrective phase of 3 to 4 months. So Hinzing within this entire sector looks quite robust after the recent base formation. So Hinzing can be bought from a trading perspective with stop loss below 595 for potential up move for 630.
Okay, all right. Thank you so much, Richard, for joining us. Well, mid-cap index is just at the flat line. It's up around 7 odd points. And the advanced decline ratio has worsened in the favor of declines as well. So keep an eye out on that one. For now, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets. And we'll talk about BLS International as well. A sharp fall in that stock price. We'll tell you what's happening there.
Welcome back to Midcap Radar. Well, one particular stock that's in focus today is BLS International. Sharp downtick post and then a brief recovery. A lot of worries regarding newspaper reports. Company has also gone ahead and given a clarification on these reports. Winnie has gone through all of these details. Winnie, give us all of the details regarding BLS International and what's your outlook here?
Absolutely, Vivek. So, first up, let's talk about the news reports that came in, right? They said that there's a Shenzhen visa probe that has been widened by the Spanish court. Now, this is actually going on for a while. And now, they said that the expansion of this case that comes in for BLS International as well. And what does BLS International do for the Spanish government, right? In terms of visas, they are handling appointments and document intake for several Spanish missions. Now, this also falls under scope of that investigation which has been going on for the Shenzhen visa. This probe is mainly for Shenzhen visa, residence, work permits, allegedly, which were cleared on questionable or forged paper. So, this is the case that was going on for some time, and now that probe has been expanded and that has been given to BLS International is what this newspaper reported suggested as well, that it's an expansion of the probe. What is BLS International saying? They are saying that and categorically rejecting the involvement in any of these irregularities that are mentioned. They're saying that there's no evidence of establishment of wrongdoing by the company, and especially strictly their role is actually very administrative in carrying out the work that they are doing. They are not the ones clearing it. They are just filling the mediatory forms of that. So all the decision in terms of processing, issuance of or refusal of visa are on the consular or the diplomatic authorities that are there. It's not on BLS International is what they're clarifying. But as of now, we're seeing that the stock has not seen a strong recovery coming in post the clarification as well. But we'll watch out for that.
All right. Thank you so much for joining us with all those details. Vinny, BLS International at the day's low is down around 11.5%. Well, the mid-cap index has slipped into the red. It is down 20 points as we speak. Markets are at the day's low. From the broader markets, though, despite the fall that we are seeing in the mid-caps, Muthoot Finance is the one which is up 5.5%. We do have HCL, which is up 4%. There is Siemens, which is up around 4%. Aarti Industries is making a comeback. A lot of these chemical names actually are doing well in trade. For instance, we do have Bajaj Mines, which is up around 6%. That's the rate that I had the last time I looked at that stock. Vodafone Idea absolutely flat, but the positive movement continues there. LT Foods is the other one, which is up around 8%. We do have Parag Milk Foods, which is up 6%. Hudson Agro is the other one, which is giving it some company. A lot of stocks in the green in the broader markets.
That's right. And mid-cap IT stocks also under a bit of pressure. Coforge, Persistent, these stocks seeing a bit of selling pressure as well. But with that, it's all the time we have on this edition of Midcap Radar. Finding Alpha when we return.
Well, the chemicals industry is one of the most critical pillars underpinning global economic activity. While China has long dominated the global chemicals landscape, India is steadily making its mark, supported by new areas of growth and expanding opportunities across the sector. Which phase are we in for the India's chemical industry, and which companies are best placed to stand out? Hello and welcome to Finding Alpha. I'm Nigel D'Souza, joining in from the Mumbai News Center. And to help us decode the opportunities and the outlook for the chemical sector, we're now joined by Ranjit Chirumala, the Senior Vice President, Research, Agri-Chemicals and Midcaps at IIFL Capital Services. Well, Ranjit, we appreciate you coming down to the studio. It's not a very easy subject, but over the years, I've seen that you're very passionate about this subject. So we thought we'll invite you and we'll explain all of this to our viewers. So thanks a lot for coming down.
Thank you, Nigel. Thank you for having me.
All right, Ranjit, let's get a few basic details first, before you take us a little bit deeper into the sector. Tell us what's the size of the global chemical industry, and obviously, from our viewer standpoint, we would like to know, where does India place? What's India's chemicals industry size? What kind of growth are we looking at? And where are we headed in terms of the global contribution?
Sure. Thank you, Nigel. It would be interesting to you to understand chemicals, and you would be positively surprised to learn that you actually use chemicals on a daily basis. Right from the day you get up in the morning, you have your oral care, those are chemicals. So chemicals is an industry which sits behind each and every industry. While we may not recognize it, but over the last couple of decades, or at least a decade, the market has recognized that. So give a few examples. You take home paints, that is chemicals. Coatings, cleanings, that is chemical. You take food, that requires agrochemicals, which is again a chemical. Fertilizer is a chemical. You talk about mobility, electrical vehicles, that again there is a chemicals that is involved. You take about electronics, so clearly there is a lot to do in the chemical space. So while it may look surprising to you that we actually use chemicals, but we have never recognized the potential of the chemical industry. Now there is a paper of Nifty Aog, which puts or pegs the Indian chemical industry at $220 billion. And the thing that it marks is that we are a sub 3% when we compare it to the global chemical industry. Global chemical industry would be around $4 trillion kind of a market. So India has been growing at a double the rate of global agrochemicals. So if you look at global chemicals industry is growing at a 2 to 4%. India is expected to grow at a 6 to 8%.
Okay.
So that is where we are at. Probably 220 billions will go up to 300 odd billions by FY30. Niti Aayog and the government of India is doing a lot of push to drive this.
All right. So from around 200 or $220 billion, we are headed to around $300 billion. So at $300 billion, how much will India be as a percentage of the globe?
The aspiration is that from a sub 3%, the expectation is that we should go up to at least 5 to 6% of the global chemical industry.
And as you mentioned that we are going to be outpacing the global growth as well. But let's focus on China, because that's the big daddy in there. Over the last 20 years, I think so, the way they have scaled their sales as well as capacity has been phenomenal. So let's get China out of the way. How much do they contribute to this global pie that you spoke about this $4 trillion chemical industry?
So China is both a major producer and major consumption. So if you look at their production, almost 40% is what they contribute to the global production. But again, what we have seen is that they set up a massive scale in the chemicals. When you talk about China chemical industries, you talk about in million tons. You never talk about in few thousand tons. So that has been the scale of the China chemical industry that we have seen over the last few decades. The entire Easternization story that if you kind of recollect a couple of decades back, where Europe was a major producing nation for chemicals, then they started taking care of the environment and they started carving out certain chemicals, and that is where China stepped in and they took that significant opportunity. And as a result, what we see now, they are almost 40% of the global chemical industry now.
All right, so China is the big daddy in there. But India would have some sectors, some spaces where we stand out, right? So if we have to highlight, where does India stand out? And then we'll get to where India is lacking. So if you want to put down a few pointers, or where is India holding on to its own?
So if you talk about what are the strengths of India, I will classify into 6 different parts. The one is the niche chemistry. India, if you look at what we are good at, is cracking the multi-stage, multi-step reaction. So you give us anything, we are very good at backward integrating. Though we will not develop new product, But once we know the products, we have that capability to make it in India and crack that process. And that is what even we have seen during the COVID times. We were also the ones to make vaccines for the world. So that is the key point that we see as far as the Indian chemical industry is concerned. And if you talk about the pockets, as I said, it's easier to understand when you compare it from the user industries. Agrochemical will become the one segment, pharmaceutical will become the other segment. The dyes, the clothes that we wear, it requires dyes, and dyes are nothing but chemicals.
Correct.
So if you take that particular thing, as far as the agrochemical is concerned, we are the net exporter. So there are very few industries which India is a net exporter, and agrochemicals is a one such thing. The second, if you look at dyes, colorants, intermediates, and that is where India has become a net exporter. And we have done a significant technological changes, or you call it process changes. That is what has led to these things.
Okay.
The third is that a select niche chemicals. So wherever there is a value addition, while China is concentrated on bulk, volumes, India carved out its niche that, okay, this is the value addition that we can bring to the table. We will cut down the number of steps. If it is a 25-stage step, we will cut down it to 15, and that is where we will give the idea.
Right.
The fourth is the competitiveness. As I said, we always look about the process, how to improve the process, cut the throughput or improve the yields, and that is what made us the low-cost producer. The last and the final thing, if you look at the talent pool, given the size of our populations, given the number of students graduating, and BSc chemistry is the core. So we have the right talent pool. We also have a very port infrastructure, strong port infrastructure. When you talk about chemicals, it is always about import and exports. Having a good port infrastructure, having a seamless trade is also important. So all these things, when you look at in totality, that is what places India ahead of the other nations.
Lovely. All right. So agrichemicals is where we are exporters. You're seeing pigments and dyes as well when we stand out. The talent pool is good. And you give Indians a job, you know, they'll put things together, they'll cut down the processes, and in fact, they'll give you the best possible output. So we got that. What about where India is lacking? There'll be a few instances, right? I mean, I've heard forever that the R&D as a percentage is actually relatively lower. So put down a few points where India is lacking, because that could be where the potential opportunity as well is.
Again, if you look at different parts to it where India is lacking, hydrocarbons, that is the basic raw material for any chemical industry, and we don't have access to hydrocarbons. When I say hydrocarbons, it is largely the natural gas. And that is where India continues to lag, and unfortunately, we can't do much on that. This is a natural resource. Beyond that, if you look at the scale and the backward integration, that is what I highlighted. China thinks about scale.
Yeah.
Whereas India thinks about the niche value addition thing. So that is what is missing. You rightly pointed out on the R&D. So this is the one thing which I used to tell all my clients in my initial marketing story, that don't go by the word specialty chemicals. That has kind of become a misnomer. By specialty, what you need is you have to invest a lot into R&D. You need to create a new products, develop new products. Are we doing that? No. What we are good at is that process chemistries. You give us a product, we will give it at the low cost manufacturing. That is, and another thing, if you look at the commodity kind of a scale, so India has a very high production of propylene, high production of ethylene. Yes. But what it is going into is a polymers. Propylene is converted into polypropylene, ethylene is converted into polyethylene. Look at globally, 90-95% is converted to polymers. Ethylene, 60-65% is converted to polymers. But when you do globally, a sizable part is diverted to the chemical industry. Okay. And that is where a lot of value addition, be it propylene or ethylene, can be done. And that is what is lacking. And lastly, if you look at the infrastructure, Gujarat is a best example, Dahej. We have created almost a mini China out there. But except that, where have we in the rest of the India? We have seen some initiatives coming from the Odisha government, some initiatives coming from the Vizag. So hopefully over the next 5 to 10 years, we will be able to create these mini clusters. This is important because, as I said, chemicals is more about the import and export. We need to have that seamless. We have the ingredients in place. It's now us for put up the capex and then scale it up. Okay, interesting. So there are some, areas where India can improve on. We get that. You have put down a list of all the chemicals that we import. Right? So if you could tell us, where is maximum import dependence? And also, which are the companies that are looking to actually fill in this gap? Because there could be a potential, right? Please go ahead. So if you look at, as I said, we are dependent on hydrocarbons. And that is what has been limiting our ability to scale things up. Right. So the good part India is that we have very strong demand. So there is a demand that is available. While the rest of the world is struggling with the demand, You take India, India is a growing nation and the demand has been very strong. But there are pockets where, a few examples that I would like to give is that ammonium nitrate. We are still 30-35% import dependent. And there are capacities that are coming up. Deepak Fertilizer is setting up that capacity. Chambal has set up that capacity. And there are a few other capacities that are coming up. So what has done over the last 1 decade, if you look at it as kind of a incentivized or make promoters aware that this is the way to go forward, we need to tap these opportunities. The case study that I would like to highlight here is a Deepak nitrite. A decade back, entire phenol or almost phenol was imported. Here was a promoter who kind of had this vision, we have to tap this opportunity. It was a big risk at that point of time. They're probably making 100 crores of a profit back then, but they had a vision of setting up a 1,500 crore capex. So that was the kind of a risk that they took. In the hindsight, if you look at, that was a very good decision. They were able to reap benefits. So India, if you look at that, import dependence has been cut down by, I think, less than 20%. They have increased their capacity from 2 lakhs to almost now 3 lakh tons through debottlenecking. What they're doing next, they are now have their target set on polycarbonate. In India, almost 3 lakh tons of polycarbonate is imported.
Everything is imported, right?
100% is imported. There is no manufacturer. But what it makes to make polycarbonate, polycarbonate is just the glass. It's a transparent glass. And the growing real estate is what is driving the demand. PC need bisphenol A. Bisphenol A needs phenol. They already have phenol. They are setting up another plant of phenol. This will take 3-4 years. But again, the intent is strong to tap the import substitution thing. But we can't do this for everything because, as I said, hydrocarbons is the weakest link for us. If you talk about methanol, almost 100% is kind of an imported. We don't see anybody setting up methanol capacities in India. You talk about acetic acid, again, there are challenges because these are the capacities which require scale. And that is where the intent is lacking at this point of time, but visibly because of the weakness in the hydrocarbon chain.
So you told us about phenol, the Deepak nitrite, they went ahead and they put on that capex. So currently, how much of phenol is imported?
Currently, to my understanding, it should be less than 15-20%.
And at one point of time, it was...
They have a market share on 55% odd thing.
And at one point of time, almost all the phenol was imported.
Right.
And now
there were companies, but not to a scale that we can talk about.
Correct. And now polycarbonate is the other one that they're looking at. They're trying to help India in terms of the 100% import dependence, reduce that a little bit. Right? Okay, all right. Now, India's chemical industry, Ranjit, has gone through various phases. From the bulk producer, then gradually moving towards specialty chemicals as well. Then we went through a phase of euphoria because the China Plus One theme was up and kicking. And then from 2022 onwards, suddenly, these companies came under pressure, margins came under pressure, China started dumping more, destocking did take place. Currently, which stage are we at?
So I would like to take you back a little bit if you talk about pre-2010 era. So 2020, what was the industry looking like? So as I said, chemicals is what we use on a daily basis. So this is an industry which has been there since decades, even without we realizing it.
Correct.
But pre-2010 era was all about commodity, low cost of production. And that is what it was into. So we were good in caustic soda, the soda ash. So all the bulk commodities is what we are good at. From 2010 to 2020, if you look at the series of events that has happened in China, we have seen a huge clampdown due to the environment. There was significant clampdown, there was regulation that was changed. So suddenly China started cutting production. And the world which was heavily dependent on China started realizing, hey, there is an alternative. So from 2010 to 2020, what we saw is a euphoric trend in all the chemicals. You just need to have a name of chemical in your company name and the stock kind of did very well.
Correct.
So that was a euphoria that we see. But what happened after 2020? COVID struck. Initial 2 years again just inflated because China was virtually set. They had a zero COVID policy. They didn't open up until 2022.
Correct.
So those 2 years, everybody wanted to stock. And what we saw, like I would like to give an example of agrochemicals. A $70 billion market globally went up to $85-90 billion because everybody was fearing for supplies. If they want 2 months, they were keeping 4 months of supply.
Correct.
That in a way led market believing that this is a structural growth and all stocks did well. But what happened 2022 to 2025? Reality check was there. China started, hey, we are here to do the business. They started slashing prices. In the US, interest rates were going up. So there was a just-in-time inventory concept that almost every company started. The supply chain decisions were started being taken by a finance guy. So that is where we saw probably a steepest destocking cycle. And we have on record from the earnings call commentary from the best of the worlds, BSFs, BS, that the destocking cycle that they have seen the last 3 years was the worst in their lifetime. That was followed by the deflationary period. So that is what kind of a segregated, and the market started believing not everything is specialty chemicals. And that is where what we now see 2026, there is an easy way that has been set up. Here on the market is what they are looking forward is a sustainable growth, customer stickiness, long-term contracts, what value. So margin, EBITDA margin is a slightly different thing. They are largely EBITDA per metric ton. What is that you are going to protect, and what is the moat of your business? So that is where the focus has shifted.
So now from 2026 onwards, the men will stand apart from the boys, you know, and after the painful period, probably things are on the mend, and they could also look up for select chemical companies.
Yes.
Okay, let's focus on a couple of big themes then. The semiconductor space, that is red hot. Everyone wants to know which is the chemical that will be used in the semiconductor space, point number one, and battery chemicals. That's the other big area of interest. So from both these two themes, which are the chemicals that will be used, and which are the companies that could potentially benefit from it?
So firstly, if you look at the semiconductor space, so India as a nation is putting a lot of emphasis on making semiconductors in India. And we have seen capital subsidy up to the 70-80% being given to the companies. So one company that I would like to highlight here is the Archean Chemicals.
Archean Chemicals.
Yeah, they are making a silicon carbide. They will import wafers. They will do the fabrication work there. And that is a theme which you will directly fit into the semiconductor theme. In addition, it would be interesting to know that semiconductors is a chemical intensive industry. You need basic chemicals like hydrofluoric acid, hydrochloric acid, sulfuric acid, ammonia, but the level of purity is completely different. We would have spoken about 1 or 2% impurity. There the things have moved to ppm levels. Now semiconductor will require ppt, parts per trillion kind of an impurity profile. So even though company may be making that, but it will be very difficult and complex to achieve that PPT level kind of a profile. Whichever company is able to do that is what will be able to supply. To begin with, I will say that this is still early days for the Indian chemical companies to tap semiconductor opportunity. But as the capacities develop, there will be a localization theme that will have to play out, and the companies which have the right product with the right purity profile will be the ones to tap this opportunity.
So we've got that. Archean Chemicals could be one of the potential beneficiaries as India focuses on the semiconductor play. Very quickly, if you could tell us about the battery chemicals as well, because there will be mobility over there and there'll be renewable energy as well, right? So please go on.
So to cut the battery into different parts, there is a cathode, there is an anode, and there is an electrolyte, and there is a separator. Each of these by nature are chemicals, while the extent will be different. So anode is a much simpler thing, it's a graphite. So ones who have the exposure to graphite and you are able to purify that, they will be the suppliers. The cathode is what is typically made up of NMC, nickel, magnesium, cobalt, copper, or it could be LFP. The way we are seeing is that LFP chemistry is kind of a catching up now. To make LFP, you also require FP, ferrous phosphorus. So there are quite a few chemical companies who have kind of an announced capex, and they have serious intent. So if you look at the LFP way, Gujarat Fluorochemicals is the one that has kind of a clearly announced their serious intent to tap all these opportunities. In the peripheries, you look, the management's talking about SRF, Navin, and there are quite a few other managements as well.
This is battery chemicals.
This is battery chemicals, pure battery chemicals. As I said, cathode is LFP, and then you have FP. Sudhir Pharma is one such thing who is talking about setting up an FP, which you eventually will go to make an LFP, and that is what would go into making a cathode active material or a battery. Electrolyte is what is there, which would be a customized thing, electrolyte salt, and these are again the chemicals.
So let's break it down then. Battery chemicals, when we're looking at that, the stocks that will be in focus will be SRF, will be Gujarat Fluoro, I think so, is what you mentioned. Which are the ones?
Gujarat Fluoro is what has announced.
Himadri Chemicals as well?
Himadri has announced. So these are the companies. The one which I have direct coverage is Gujarat, which has a clear focus on these things.
Gujarat Fluoro.
On the peripherals is what you will have SRF and Navin talking about it, but we yet don't do any meaningful capex committed to this space.
All right, Ranjit, you're giving us a lot of data. For the timing, I'll tell you what, we'll slow things down a little bit. We'll take a short break, come back, and we'll focus on the other gases as well that we would like to know. R32 is something that we'd like to chat about. Stay with us. Welcome back. You're tuned in to Finding Alpha, and we are dissecting the chemical space. Well, Ranjit, I want to ask you about another important factor. That's the R32 gases. Now, the Kigali International Agreement, that has a couple of factors that it's considering, right? The focus is on gradually reducing the production of high global warming potential. I think that's right. GWP agreement. To low GWP refrigerant, which means that they'll be adopting R32 refrigerant gas. So tell us about the pricing trends on this R32 refrigerant gas and which are the companies that are best placed to benefit.
So to set the context here, there is a concern on the rising temperatures globally. Global warming. So in order to address that, the countries have come together and they signed an agreement that they will like to reduce the constituents that are leading to the global warming. And that is where the refrigerant piece comes into play. If you look at the refrigerants history, we started using chloroform, carbon tetrachloride. From there, we shifted to HCFC, hydrochlorofluorocarbon, and from hydrochlorofluorocarbon to HFC, and now we are talking about HFO. Okay. So if you look at this, the developed nations like US has already adopted that, and they are now phasing down the HFC consumption. China, a couple of years back, has started adopting that, and they are phasing down. When it comes to India, we are under an A5 class, which means calendar year 2024, 2025 and 2026. These are the determination period. Okay. In these 3 years, whichever company manufacturing, that would be taken into account and they are eligible for the quota. Correct. The next year is going to be the free year where you have seen quite a few companies announcing capacities, Stanfac, Stallion, Chemplast, while the incumbents are SRF, Gujarat Fluoro and Navin Fluorine. Okay. So there are these 6 companies who have kind of announced capacities and they're already there, while SRF, Gujarat Fluoro and Navin, they're already making HFC. Okay. So here in HFC, when you're talking about a phase down in HFC, there are 4 or 5 different constituents, namely R125A, 124, 134A, and there are blends. Within that, if you look at, some have a higher GWP, R32 is the one which has a lower GWP.
So give us an example. You said R125, they are moving to R32. So we're talking about GWP. What is it, GWP in R135, and what does it come down to in R32?
Yeah, it has an highest GWP for R25 above, don't see the specific number, but if you look at, it's almost 1/10 the size. So if you have R125 at a higher end of the ceiling, R32 is at the lowest end of the ceiling. So what is happening in a phase down is that if there is a blend which has a higher composition of R125, you are by force have to replace that by R32.
And R32, that is R32 producers, as you said, are the likes of Navin,
Gujarat Fluoro, SRF at this point of time. The 3 companies which have announced capacities are Tanfac, Stallion and Chemplast.
Okay, all right. So we got that then. These are the companies that could potentially benefit, but we'll have to wait for the quotas and to see how things pan out from here on. That's on R32. And just to close the loop on that battery chemicals, Neogen as well will fit into this piece?
Yes, it does.
Okay, all right. So we've got that out of the way. Now I want to ask you one final query before we let you go. Sure. Because, we have the management of Deepak Fert, who comes on the channel and they are talking about putting up capacities, making India self-sufficient, and they're very optimistic. So tell us, what is your view on that stock? And the other one is Sudarshan Chemicals. They went ahead and they did a big global acquisition. The stock has been fairly volatile after that, but they've given a very strong guidance. Yes. What's your view on both these 2 names?
So Deepak, on both these 2 names, I have a buy rating and I have been positive on these 2 names. Deepak Fert, if you look at, there is things that are changing is, one, they have set up a ammonia plant. So few years back, they were importing ammonia and making TAN. Now that ammonia plant has come on stream, it's been 2 years. Interestingly, what has happened in the last 2 years is the gas prices were elevated and they were not able to make much money out of that particular capacity. They have now got into a 15-year long-term contract with Equinor, and that is what has kicked in from May 2026. The management has been on record saying that there will be a substantial cost savings of that particular contract, which is kicking in, which would be mostly visible in FY28, because since it has started from May. In addition to that, there are 2 large capacities that are coming on stream. They are putting up an additional TAN capacity and nitric acid capacity, collectively upwards of 4,000 odd crores. So that is what should get commissioned over the next few months. So FY28 is what we will see a partial benefits of these new capacity, and then the gas contract kicking in, and that is what is driving the EBITDA for that particular company, and we'll remain positive on that. Coming to Sudarshan, here is again an interesting case. A smaller Indian company had this aspiration to become a top 3 global pigment company, and that is what drove them to acquire the Hoiberg. And this is an interesting acquisition. This was a Chapter 11 filing, and they got all the distressing got done away, and they have got a clean assets on them. The story here is that Indian EBITDA should be anywhere between 400 to 500 odd crores. The new acquisition should eventually get them a 1,000 crore kind of an EBITDA. So there is a visibility of a company going from a 400, 500 crore EBITDA to almost 1,500 crore EBITDA. The risk is definitely the execution. Global acquisitions have not transpired the way one looks at. There will be challenges, but if the management is able to pull this off, then we have a company which is providing a significant earnings growth.
And very interesting, Sudarshan Chemicals doing 1,600 crores of EBITDA in the coming years with the current market capitalization of around 10,000
Management guidance is 1,400 to 1,500 crores, but as I said, 500 plus 1,000, 1,500 is what should be achievable.
Well, Ranjit, it's been a pleasure having you on the show. Thanks a lot for joining in, dissecting the sector for us, telling us where India stands right now as a percentage of the globe at around 3% and expected to go to around 5 to around 6%, and where India stands out and where India is lacking. Thanks a lot for joining in. Well, we'll wrap up on this edition of Finding Alpha. Do stay tuned. More news and updates coming up on the other side. Thanks a lot for watching.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
We're seeing Taiwan index is holding on to mild gains of almost 0.1%.
The Iranian parliament has backed a draft law to charge ships for Strait of Hormuz passage.
The Indian basket have been added to the FTSE all-cap index.
The Nifty settled 30 points higher in the pre-open.
Yeah, always eyes are set on anything which is good.
Blackstone promoted. So we just quickly talk about that. Very flat opening.
Nifty flitting between the red and green around the 24,250 mark.
Now, both the sides are looking to deepen their bilateral cooperation in several areas.
There are additional benefits if you do local sourcing. There are additional benefits if the R&D is done here.
Well, markets have taken a turn for the worse. We are at the day's low and the mid-cap index is absolutely flat.
Okay, well, that is the day so far. Markets are down about 80 odd points, and we are at 24,170 at this point in time. I mean, it's a pretty dull day once again. The only index with gains of over 1%, there's only one, which is the Nifty Metals Index. Otherwise, it's pretty down and out. The PSU Bank Index is down about 1% plus. Defense is down about 1% plus. So, yeah, I mean, that's about it. Two indices with losses of greater than 1% and one with gains of over 1%. Otherwise, I mean, sideways. It's been that way from the word go, from the opening bell. Lots to cover, though, in terms of individual names, individual stocks. With me, my colleague Rima. Rima, hi.
Hi, sort of a slow burn kind of a trading session. We started off around the 24,300 mark. As we speak, below the 24,200 mark, 78 points lower. Asia closed in the red. The Korean markets and Hang Seng down 3 and 2% respectively. And today you're seeing banks underperform, particularly PSU banks. So a Bank of Baroda, State Bank of India are under pressure. But on the whole, the Nifty Banking Index has a cut of nearly 400 points. The advanced decline ratio for now is in favor of actually, it's 1:1. It started off in favor of the gaining side, but now it's the two lines have met. Lots of individual big movers, but jewelry stocks are active once again after the strong listing by Lalita Jewelry Mart. So pull up a Senco, that's higher in trade. Sugar is rebounding after Friday's losses. So there is activity which is visible there. And Vishal Mega Mart has been strong since the start of the trading session. Lots to unpack in the final 1 hour. Let's tell you what we've lined up on the show. Markets at the day's low, the Nifty below 24,200. Broader markets are lackluster. Financials on the back foot. Real estate, metals are the gaining pockets today. Strong market debut for Lalita Jewelry Mart. A deep dive into the business model coming up on the show. We'll talk about the action unfolding in the precious metals and sugar space. Shanti Gears extends the rally into the second trading session. What's triggered the up move? We'll talk about the way forward in just a bit. But for now, let's get in a few trading ideas. Closing bell, closing trades with Mitesh Thakkar. Mitesh, what trades have you taken? Is this a frustrating kind of a trading session?
Yeah, so I think, the first thing which happened was that we kind of opened just about 24,300, which was the supplier level, and immediately dipped below that. So I think the breakout kind of never came into effect. And therefore, we are back to the range of 24,300 to about 24,000. So I think wait it out on the index, not much of a signal. The Bank Nifty had a low of around 57,000 on Wednesday last week. So that's the level to watch on the Bank Nifty, and 24,000, as I said earlier, is the level to watch on the Nifty. These are the two levels on the respective indices which I'm working with. On the stock side, I have one buy and one sell. Steel Authority is on the buying side, keeping stop at 175. Look for targets of 190 here. While Zydus Life and again, this is a conditional call because the stock is just trading around the support area of 1,100 to about 1,097. If it breaks through 1,095, take a sell call or a short side trade with a stop at about 1,117 for targets of 1,050.
Okay, all right. Those are some individual kind of rates which are coming through at this point. By the way, look at names like a JSW Steel, Tata Steel, Hindalco. Any view here on some of these names?
So, the metal pack, Prashant, good afternoon, is looking much better. I had a buy on Steel Authority, but JSW Steel was also under consideration. Very good setup over here. The recent swing high was around 1330. So, while we are now getting close to that, I believe that there could be a breakout beyond that, and the next trading target would be around 1400. So again, a positive view on JSW Steel as well. Similarly, Tata Steel, look at the last 4 weeks of price chart and you will see that around 180, 182, the stock has bounced back from these levels on multiple occasions. Even way back in March, I think, we had a closing low from 183.5. So this is a very strong support zone. It's just bounced back from those levels, but if it starts getting past 188, 189, then I think the stock could head towards 200 plus levels.
Okay, that's Tata Steel headed towards 200. Mitesh, thank you for joining in. We'll connect in just a bit. Let's talk about Lalita Jewelry. What a strong, sparkling debut on day one. Market capitalization too surging. Mangalam joins in with the details and the numbers. So what's so exciting about this?
Well, it's the valuations to start with, Reema, but it's a good listing that we've seen for Lalita Jewels. It's up almost 25%, the market cap closer to 11,500 crore. And for the uninitiated, it's obviously a very strong jewelry retail company based out of South India, has about 61 stores, 51 cities across all the 5 major states, including the Union Territory of Puducherry in South India. But we need to be mindful of a couple of things out here as well. While the company has been growing and been doing extremely well, all of last year was where majority of the growth of the company came by 1 year before the IPO, and that was also led by the big surge that we saw in gold prices. So FY26 as compared to FY25 has been extremely strong for the entire jewelry sector, and Lalita Jewelry obviously has benefited from that as well. So if you notice the numbers, between FY24 and FY25, the revenues were between 16 to 17,000 crore itself. That jumped all the way up to 25,000 crores in FY26, and margins, which have been between 3 to 5% over the previous 3-4 years, jumped all the way up to 7% in FY26 as well. And as a result of which, the net profit jumped from 350 crores all the way up to 1,000 crores. So on that basis, looks like 11.5 times trailing price to earnings is, at a value priced as against what you would see for the other jewelry companies. But remember, this sort of growth may not continue because the unprecedented jump that we saw in gold prices. In doing so, the inventory days of the company increased as well. Operating cash flow actually turned negative in FY26 as against positive earlier to about 400 crores versus about 290 crores, which was positive in FY25. The gross borrowings of the company increased as well. And alongside that, we saw inventory days increase and interest costs increase all the way up from 191 crores to 242 crores as well. So strong listing, decent valuation, but a couple of risks that we need to keep in mind as we look along for Lalita Jewelry. All the other companies, however, are trading at much higher valuations. So maybe some weakness is in the price already despite the strong jump.
Okay, thank you very much for that. The other listing today was Horizon Industrial Parks, but this one made a very muted debut. In fact, as we speak, it's trading with a mild cut compared to the issue price, which was about 60 rupees. Yeah, it's still down, close to about 5 rupees, 57 here. I think the only concern is, one, it's still loss-making, and that's on account of the very high finance cost and the depreciation on the books, considering that the company owns the land that it leases out to manufacturing companies or for warehouses to e-commerce companies. So the company owns the land, they've already bought it, and only part of it is monetized so far. So the cash flows from the remaining are still not able to meet the finance costs. So depreciation is high because of the hard assets and the finance costs. The IPO proceeds will partly address the high finance cost, but we'll have to wait and see, because for now the company is reporting losses at the bottom line. So we had a chat with the management earlier today. Listen into some key takeaways.
In terms of rental yields, even if you look at our numbers in the past, we've done lower double digits, and as the quality of the product mix goes up, you'll see improvements in our yield on cost also going ahead. We did 605 crores for financial year 26. We're almost tracking a number which is significantly higher than that, for our March 27 exit run rate. As you know, we've been developing close to 5 to 6 million square feet of area and leasing that in these platforms. That's almost adding 25% to our operational throughput. So, you can do the math and you'll know that, FY28 has, a lot of upside in store.
Dipan Mehta is now joining in. Dipan, you want to comment, Lalita or in Horizon Industrial Parks?
Yeah, well, Horizon Industrial Parks was quite a difficult business to understand and value. The loss making. And basically, they have a logistics kind of a niche where they manage the wooden pallets, which go through these trucks where the supplies are made. So it's a difficult business to understand and value as well, but it's got great promoters. So let's just give them some time. I think it may go the
Dipan, sorry. I think that's Leap India, which is also a recent listing.
Oh, sorry.
Yeah, the pallet companies that, I mean, I know what you're saying, the wooden pallets, right? Which is the...
There are so many IPOs coming, Prashant.
No, but I was also thinking they're both largely, in a way, kind of similar spaces. I mean,
Apologies, your first mistake on CNBC.
No. I thought I go on, but yeah.
Horizon Park also, basically, that company also is having its same kind of similar, it's having its logistics parks and it's providing all the logistics support and everything. I think that, so long as it's not solid profit-making, investors generally should be a bit careful. Coming to Lalita Jewelries, it's the valuation. At 11 times, it is amongst the cheapest jewelry stock, but then the net profit went from 300 crores, which was flat for 2 years, to about 1,000 crores in last year. So, and we have seen this time and again that when a company is going for an IPO, suddenly we see spike in the profits. How much of it gets sustained after listing, that's to be seen. But maybe, it could be one-off or it could be, something specific in that particular year. Whether it's sustainable or not, time will tell us. But its valuation is attractive, which is why it got, this kind of a listing. Even at these levels, it is about 11, 12 times so, which is quite, I would say, attractive as compared to some of the other retail jewelry stocks.
There was the other one, it is attractive. I mean, others are all trading at 1 times, 1.5 times, 2 times sales. This one, of course, at about a half time sales, FY26 numbers, that is, with those 61 stores that Mangalam pointed out. Dhoot Transmission, Deepan, have you looked at that one?
Yeah, again, I thought that the kind of valuation was a bit expensive. And in terms of business model and other thing, it was pretty much, we have seen other businesses and listed peer group, I think it was more expensive. So that also, I think, with these IPOs, you need to be a bit careful, give them 3 to 6 months or so, let them settle down, let us see 1 or 2 more quarters. Is the management giving guidance? What exactly is happening on the ground? Typically, we tend to understand these companies far better after 1 or 2 con calls and there's better communication. Unless it's something spectacularly different business model, then one could look at it. But I think that if it's kind of a typical peer, existing listed peer group company, it's all about valuation. And I thought Dhoot was quite expensive from that point of view.
Okay, Deepan, stay on. We also have Manisha joining in because precious metals are on a tear on safe haven buying. Gold prices are now at a 3-month high. Silver trading at a 2-month high. Manisha is joining in with the details. Manisha.
Well, thank you so much for that. When you look at the month of August as well, we've seen gold prices gain up by 14%. Silver is up 22% right now. And when you look at the kind of price moves that we've seen, well, we did see January hit an all-time highs of $5,600 an ounce. From there, we saw the prices decline all the way to $3,900 as well. And we are back above $4,600 an ounce right now. The last $400 of a jump up has come in actually in the last 2.5 months itself. So very strong gains coming in for gold there. Same goes for silver as well. We've seen a low of 57 on the lower side. We are trading at around $70 an ounce on the higher side here as well. Well, it has to do with the yen intervention, the US debt bond purchase, the geopolitical tensions, the fact that you're looking at US debt spiraling over to nearly $40 trillion therein is what really seems to be supporting the markets right now. If you look at the overall, asset classes right now, equities have kind of declined. The dollar index is trading at a 3-month lows. It only is a couple of things that are surging up. One is metals and the other is crypto, by the way. But the street does believe that with the physical buying, Indian festival and wedding season buying, as the gold prices have started to run up, the investment buying seems to be coming back as well. We've seen last 2 months actually see ETFs and the gold funds do quite well in sense of overall participation. So that is where the street is working with. From here until the end of this year, the global banks and brokerages believe that we could be looking at $5,000 an ounce coming back for gold, and silver perhaps could be trading at around 85, 90. So there are bullish calls continuing for precious metals.
Okay, what about sugar? Manisha, sugar stocks also in focus after policy initiatives by the government to cap sugar prices. Is that helping? Are sugar prices slightly lower or have they stopped going up? And what's the industry feedback?
Well, it seems to be consolidating for sure. If you look at the overall sugar prices, we have gained up by 35% as compared to last year festivals. So, well, yes, a strong jump coming in there. But the sugar cooperative mills, what they're talking about right now is that they will start crushing by 15th of October. Now, this is at least 15 to 20 days before when you usually see crushing begin. So there is the Sugar Federation now asking government for some kind of a financial assistance, because as you start crushing earlier, you see recoveries go down by 2 to 3%. So that perhaps could be a loss therein. And then as we have been talking about, from stock limits to how much sugar can you hold, and then the sugar imports of 1 million tons as well. All of that, as you said, have in some sense led to some easing in prices. Are we way off? No, we are not. We are still holding around that 58 to 60 rupees a kg. We've seen a high of 65 rupees a kg as well. So slightly off those kind of highs, but the markets believe that this festival season you're looking at stronger demand and the prices more or less would continue to stay elevated.
Okay, all right. Thanks a lot for that, Manisha. Well, Deepan, what do you make of the sugar basket or even metals, showing some strength now?
Yeah, Nigel, I think very positive on sugar. And I've seen this play out several times over the past decades that the sugar companies, they have this golden period where they make abnormally high profits. And I think they seem to be getting into that zone because of the way sugar prices have gone up and a lot of stability has come in their operations through ethanol as well. So I think that, considering the position they are in, you could expect good numbers from sugar companies. Valuations are cheap. I think it's a great trading opportunity for investors, hold it for 6 months or so. And I think these stocks can deliver, who knows, 20-30% type of returns also. Go for the bigger ones. I think Balrampur Chini is there, or some of Bajaj, Hindustan, the larger company. I think they have got more diversified operation. So I would prefer to go with those companies. But there's one more company that comes to mind, which is Praj Industries, which has been a big loser for the past, I think, 2-3 years or so. And maybe it could be fresh investment in sugar capacity, or for that matter, ethanol plants, which may benefit this company.
Okay, got that. Vishal Mega Mart, the stock's been a rocket after the CEO got an extension for 5 years. I know it's important to have continuity, and he's the person who sort of steered the company through the IPO and has been delivering on good numbers. But from here on?
No, I think, Rima, whether it's Vishal Mega Mart or V2 Retail, I think all of these companies have come with good set of numbers. Their internal dynamics are better than Trent also, and valuations are far reasonable. They're a nice sweet spot, where they are working with tier 2, tier 3 cities and gradually expanding their store network. Same store sales growth are high single digits, so that's quite a comfort and impressive. So very positive on these companies. I think they have a great prospects next few 2-3 years or so, because the industry also is going from the unorganized to the organized sector. And Vishal Mega Mart and its peer group companies, they do a lot of internal manufacturing. So it's all their private labels which is driving the sales, so which has got higher margins. So very positive on those companies.
Another name which is jumping up today, I don't see it, is Max Estates, which is the real estate company out of NCR. And that is up, the last I checked, some 12% on, what are very large volumes on it as well. I'm not sure if there's any news flow. I don't think so, but that is come up quite smartly. Look at that, 18 lakh shares on Max Estates. These are large volumes for a name like this one. And it's not as if, real estate as a pack is doing well, or this is a company-specific move. From 300 rupee levels 6 months back. Actually, during the sell-off that we saw during March, it's come up to about almost 550 rupees at this point. I don't know if you have a view. Have you looked at this one, Deepan?
No, but I suspect that, the land bank play would be there over here. And a lot of these companies are quite attractive. You can look at this, you can look at Mahindra Developers, then Birla Estates also, which was earlier Century. I think these companies, and Raymond's also real estate play. These companies, they have the advantage of the land bank of the parent company or the promoter group. And then it's just a matter of monetizing this, and it becomes the vehicle for monetizing all those land banks. And typically the market finds it very difficult to value these companies because the value of the land is so enormous, but it's difficult to understand how actually it will play out. But sometimes you do get these kind of companies that I suspect that Max Estates also would be much below its net asset value or its breakup value, which is some sort of catch up is taking place over here, and maybe some new launches or something could have happened as well. So these are companies which I would say are trading at maybe deep value, and they're getting some recognition just now.
The most important, as Deepan said, right, how to value land and what the value to assign to it, etc. is, of course, the example, the clearest shining example is DLF. It's done well, of course, I mean, over the last few years, but basically almost 20 years now, right? I mean, since listing, and even 20 years back, the clearest, largest name in that part of the country with an enormous land bank, but basically around the price where it came to the market at. And it's been almost 2 decades now. Anyway, so that's real estate for you. Just want to also put the spotlight on Shanti Gears for a quick bit. Stocks up almost 35-40% in the last 2 days. So there was news on Friday that the promoter, Tube Investments, has raised its stake in the company to 73.2%. So Vinny's here with, of course, I mean, the transaction is now well known, but just a spotlight on the business of Shanti Gears itself. Vinny, take it away.
Hi, so like you rightly mentioned, right, in the last 2 days, almost 2 trading sessions, 40% uptick for the stock. Before that, the stock was actually at a 52-week low. That announcement came in, promoter Tube Investment is raising stake. They additionally added 2.71% stake. So now the overall stake stands at 73.2%. The business of the company is what they're mainly into the business of manufacturing gearboxes as well as gear products, and Tube Investment had started acquiring controlling stake in 2012. That time that bought around 70.1% stake, and then over a period of time now the stake has come up to 73.2%. What is the outlook in terms of the business as well as Q1 FY27 numbers? If you just take a look at that, Q1 FY27 was a weak set of numbers that was reported by the company. Margins were significantly lower, revenues were down as well, and the unexecuted order book that stood at around 378 crores. FY26 was also not anything exciting. Free cash flow that time also had come down as well, and the company had highlighted during FY26 the main reason for that was due to decrease in order flows. But what is the annual report highlighting in terms of the outlook of the company going forward? They said that order inflows now are gaining momentum during the second half of FY26 and onwards, that they've seen some bit of a pickup in terms of momentum, and obviously they're expecting this to further see an improvement, and that is why, maybe we'll have to wait and watch what the business does in terms of a performance from here on and order inflows. But as of now, the stock is buzzing because the promoter has increased stake.
Thank you very much for that. Dipan, I think we'll leave the conversation here out of time, but thank you very much for joining in. Another stock doing very well is Hexaware today after that AI Investor Day, which took place over the weekend in Chennai, where the company for the first time said that, the more than 50% of the company's revenues have an AI element in them. They're calling it AI infused. And I think that's got the street quite excited. It's been a bit of an underperformer, and now it's playing catch up. Get into a break. Once again, Dipan for joining in. On the other side, our Alpha Manager for the day, Pramod Gubia, Marcellus Investment Managers, will join in for a chat. Stay tuned.
Okay, welcome back. Pramod Gubi is with us, co-founder at Marcellus Investment Managers. Pramod, good afternoon. Good to have you with us here. Thanks for joining in. Everyone's positive on markets, but when you ask around for ideas, ideas are scarce to come by. Because I guess that big reset has happened, right? Earnings have come and stocks, of course, are not waiting. They've reset, and of course, pricing in 27 numbers, 28 numbers in some cases. So just reflect on that, if you will, Pramod. It can't be negative, but where does one look for ideas in this market? What are you finding attractive?
No, absolutely. I think at least till about 3-4 months ago, we thought that the market had been through a time correction. Although on an absolute basis, valuations were not compelling, but at least you could look for some ideas. But I think the combination that the market bounced back, plus we had a great earnings season, has meant that the few pockets of value have also been sort of covered up. So therefore, I think our approach has been more bottom up to that extent. This is a better setup for somebody like us. It's not a runaway rally where you have obvious themes driving. For bottom-up stock picking, I think it requires a little more hard work, but I do think that this market is wide and deep enough to find enough ideas, particularly if you have a longer-term mindset, because I agree, even in places where there are very strong growth setups, valuations aren't compelling, but at least the visibility on growth is pretty strong, particularly in areas like manufacturing, where I think whether you like it or not, the rupee depreciation has given a little bit of a fillip, particularly on the exports or at least import substitution. Again, valuations are not good, but at least earnings predictability for those who are willing to take any sort of short-term pain, because the macro is such that anything could happen, leaving the downside open. But if you're focused on earnings compounding from a long-term perspective, there are still opportunities in the market.
Pramod, the one space that was emerging as a favorite was the quick commerce space. But people only held back on account of fears of competitive intensity suddenly becoming more aggressive, with more entrants coming into the fray. Now, we were having a chat with Bernstein earlier, and he sort of said that the competitive intensity is cooling off. So discounts have come down by 4-5% in the last 1 or 2 months. And now most players appear to be focused on sweating their assets. They've all reached that critical size of nearly 1,000 dark stores. So enough for them to cover the urban tier 1 cities that they're catering to. So at least that headwind in terms of competitive intensity seems to be abating for now. Where would you all stand? Is that a bottom-up idea, either an Eternal or Swiggy?
Yeah, no, it is. We do have exposure to one of them at least. And we are looking at it with a little bit of caution. I do agree that competitive intensity is abated for now, but I think we will see bouts of competitive intensity waning and waxing here. There are some big players who have entered the market with very deep pockets, but heartening to see that there is no irrationality in the competition. Given the size of the market, given the growth runway, I think this will be a long haul. Valuations are important, but at the same time, I think the key to watch out for is capital coming into the sector. And that will drive significant volatility, both in terms of short-term profits as well as stock prices. Again, this is not for the weak-hearted. There is plenty to grow into, but at the same time, I think volatility will be part of the margin and stock price profile.
All right. Hi, Pramod. Good to see you. And I think Equitas Chemicals, the erstwhile, I think, AMI Organics was part of your portfolio earlier?
Yes, it was, and I think it did really well for us.
Did really well for you all, yes. So I want to know what's the view now on chemicals, because I recall when you all were talking about it, not too many people were talking about it. Now it seems that in fact, this Middle East disruption has pushed up prices a little bit, and sometimes these sort of these sort of things actually play out in favor of keeping the chemical prices as well a little bit elevated, and select companies could benefit. What are you all bullish now on from the chemical space, and how do you all view this cycle? Because it went through that phase of euphoria in 2022, then we saw prices correct, and now there appears some sign of stability. So your take.
Yeah, this is a much more stabler setting to play because I think the China plus one theme is real. Leaving aside the commodity price inflation, I think those things are beyond our control. But we are looking at segments where there is genuine intellectual property strengths, which can protect both in terms of commodity price inflation, because you have pricing power, you can pass it on to customers, but also competitive intensity remains relatively benign, particularly from commodity chemical suppliers from China and so on. To that extent, I think this is a much more stabler setting to invest in chemicals as opposed to 2022, which you alluded to, which was a raging market, partly driven by Chinese capacity being left out of the global market. We saw what happened to that as soon as China opened up. We're not in that volatile setting anymore. So to that extent, I think going by my earlier point about India's manufacturing exports, or at least import substitution picking up, chemicals should be one of those sectors or subsectors within the broader manufacturing theme to play for, because unlike a lot of other sectors where you either need labor intensity or capital intensity, this is a sector which plays to India's core strengths, which is scientific and engineering talent. This is not cutting edge, but at the same time, clearly not exposed to the capital intensity aspects of a whole host of other sectors.
You want to give us some names?
Well, I wouldn't like to talk about specific names, but like I said, better to look at companies in, say, for example, the API sector, something that we've been bullish for quite some time. And this is where the competitive advantage, because you're entrenched into the entire value chain of the customer base, and therefore you protect it from competitive intensity, at the same time retain some pricing power should there be inflation in commodity prices.
There is a new API company which came out with their IPO, Symbiotic Tech. Have you all had a look at it? More than 90% of the revenues are APIs. So the company is getting into complex injectables and CDMO. So they're seeing that as the other two growth levers, which are yet to play out.
Well, we don't typically participate in IPOs, but this is a sector of our interest. So obviously it will be on our radar. We'd like to see the stock price settle down and look at the performance over some time before starting to take position here, but certainly right up our alley.
Okay, Pramod, we'll leave the conversation here. Thank you very much for joining in.
Thanks for having me.
Okay, let's do a quick check then on the FNO market. As of now, the PCR is holding at around 0.8 or thereabouts. And the call writers, they are playing that the 20 DMA will get protected. And I say that because the 24,300 call, pull up the premium from around 72 bucks, that's come down to around 25 rupees. Similar is the case with the 24,200 call. The premium out there is halved. At the end of Friday's trading session, it was ballpark around 130. That's come down to less than 65 rupees. So the call writers, they are at play. They are trying to protect the upper levels. However, the Nifty is down close to around 85 to around 90 points as we speak. But on the 24,100 put, you're not making any money. In fact, the premium has come down a little bit. From around 23 rupees, it's come down to around 22 rupees. So that's giving you a sense that there is some signs of put writing, because directionally you've got it correct, but yet you're not making money on a put that's a little bit away from current prices. So the 24,100 put at some point of time will come up for you on the screen. Individual stocks, Manappuram, that's come in for a bit of a short squeeze. That was one of the stocks that we pointed out earlier today. That's the one that, in fact, came out of the FNO ban, and that's seeing a bit of a squeeze today as well. NMDC, the stock has not done much. In fact, from the top, it corrected a little bit. Now it's stabilized around the 85 rupees today. It appears there is a bit of a short squeeze on that one. And IOC, there's actually long rolls that we're seeing on this one. I don't know whether or not the street is factoring that crude oil prices actually dip in the coming, in the upcoming series, which will be the September series. But there are signs of fresh buying on that particular name as well. So for the time being, it appears we're in a bit of this range. On the downside, 24,050. On the upside, around 24,370. That's the broad range that we're working with, given that tomorrow we have the monthly expiry that will play out. For the time being, we slip into a short break. As always, we'll get you some trading ideas from our technical expert. Stay tuned. Welcome back. Well, let's welcome Mitesh Thakkar back on the show. Mitesh, tell us, you got a couple of fresh trading ideas?
Yeah. So I have a STBT on Britannia. It's fallen below all its averages. The indicator setup is negative. It's at about 52.94.95. Keep a stop at about 5315. Look for a target of around 5250. And we've talked about this steel and metal pack. And JWC was a stock which we discussed. So we'll take a BTST there with a stop at about 1308 for targets of 1340.
Okay, thank you very much for that. Let me quickly just touch upon Hexaware and the kind of gains that we're seeing in Hexaware today. The company held an AI Investor Day over the weekend in Chennai. And it was all about AI. For the first time, the CEO, Sri Krishna, spoke about more than 50% of the company's revenues are now AI infused. There are reports which say that the company also spoke about doubling their revenue growth. The aspiration is $3 billion, but this is what reports are saying. This is not something that the company shared at the Investor Day, so just clarifying on that. A lot of time was spent on identifying new AI opportunities. They acknowledge that there is AI deflation, but that there are new opportunities opening up. So for starters, they said that more than 60% of the AI pilots fail because the data is not ready. This is what we call the technical debt. So data readiness is an important aspect. Secondly, they spoke about how now AI agents will be doing the job. They will be executing. So there is work required around governance, around security for AI agents, and even the execution of that. Then they also touched upon an aspect saying that maybe there is an opportunity to take away a little bit of work from the SaaS companies. So, today customers will take on a SaaS product from, say, an SAP Salesforce, and then they will apply it in the company's context. So now they're saying that maybe there is a system in which the company still uses a Salesforce SAP, but that is used to only provide a system of record. On that, the IT services companies will provide an AI intelligence layer, and this will be contextual, and the knowledge will stay with the AI company, with the customer per se. So they're talking about various opportunities. We'll have to see how this plays out. For starters, the stock is excited. The brokerage view on this is a tad bit mixed. Well, for the markets per se, still, unchanged from the 230 levels, so still down close to about 75 odd points. But there is one overhang on the global market, and that's what's going to come out of the Scott Bessent press conference today at 11:30 p.m. India time, so around midnight, because he has spoken about imposing the toughest sanctions ever. He called it the economic D-Day. So all eyes are going to be on that. He went on to say that Washington aims to sever every economic lifeline that sustains Iran. So let's go across to CNBC's Dan Murphy, who gets us the latest updates and what we should be watching out for.
Washington is preparing its toughest ever sanctions campaign against Iran, what Treasury Secretary Scott Bessent is calling economic D-Day. In an op-ed for the Financial Times, Bessent invokes the Allied planning for the Normandy landings. He writes, quote, "At dawn begins an economic D-Day, the single greatest financial offensive ever marshaled against an adversary." Bessent says the US is now entering the endgame, and that the objective is to, quote, "sever every economic lifeline that sustains the tyrannical regime until Tehran stands alone." Bessent also makes clear that Washington is putting everything and everyone in the crosshairs. He writes, "Any remaining tie to Tehran will hasten the economic ostracism of countries and entities, whether that tie be purposeful or willfully ignored." Iran is answering that threat with a threat of its own to the world's oil supply. The Secretary of Iran's Supreme National Security Council, Mohsen Rezai, said on social media that, quote, "Not a single drop of oil will be exported from the Strait of Hormuz or from anywhere in the Persian Gulf." He also said any country supporting America's economic war will be treated as an act of war.
We will first negotiate with them. We will hold talks and tell them to step aside and distance themselves from the United States. But if they do not act, we will strike. We will target that country's interests.
Iran's Foreign Minister Abbas Araghchi also dismissing America's threats as a sign of desperation when he spoke to press on Sunday.
They must understand that there is no option other than respectful dialogue with the Iranian people and a solution based on justice and dignity. They should put all of these aside and return to a path that has been tried before. Iran's nation will respond respectfully to the language of dignity.
Okay, that's what the street will be watching. We had a chat with Mark Matthews earlier today, and he kind of said that don't expect any sanctions to have, a big impact, a material impact on Iran. China and Russia, according to him, will continue to do business with Iran. The latest US measures could largely be for show. That was one. Secondly, he said that maybe the takeaway is now that the warfare is moving away from the military side to an economic side, which is positive for the global markets. But again, his view is that it's not going to be economically very significant or effective. And thirdly, he went on to say that Iran can survive the sanctions. Russia is a key example of a country becoming more self-sufficient despite prolonged sanctions. But that's going to be the key watch point. Amrish Baliga is now joining us on the show. Amrish, afternoon, and thanks for joining in. Let's talk about the one stock that you're recommending today, Sudarshan Chemicals.
Yeah, Sudarshan Chemicals is a leading player in Indian color pigment industry with about a 35% market share. Among the top 3 players globally, have about 4,000 plus customers, 19 manufacturing facilities, 11 sites across 11 countries. And they have a wide portfolio of about 1,600 plus pigment products, which is used in coatings, paints, printing, plastics, as well as various specialty applications. Domestic demand has shown an uptick thanks to these few decent-sized paint manufacturers who have put up new capacities, have also expanded. So this is positive. About 48% of the pigment revenue is from exports. And internationally also, the competition is coming down a bit because the older facilities are shutting down due to environmental issues. The Huback group, which they acquired, that's turned profitable now. So net debt also has been reduced to about 531 crores, should be zero by FY29. So expected EPS for FY28 is about 60. And with this, my price target is about 1620.
Got it. All right. What about valuations? I was just speaking to an analyst of IIFL, Ranjit, who's been tracking the space for very, very long. He was saying that the company does 400 to 500 crores of EBITDA. Then they went ahead and they, acquired that overseas asset. Now they're talking about 1,500 crores of EBITDA in the coming years, and the current market cap is around 9,500 to around 10,000 crores. So what multiple would you give it?
In fact, I would give it a multiple of close to about 28-30, although the target price which I've given is less than that. And the most important thing out here is, how soon they're able to, get it on track and, assimilate with the group overall, and which they've already shown. So I think they've crossed that. Because of which I'm quite comfortable as of now.
Got it. All right. Let's talk about a couple of other companies then. Hindustan Zinc, I think you were positive on that name, right? What's the view?
In fact, I was positive on that. It achieved my target price. And at these levels, I would be a bit cautious. I will not go out and buy. If I have, if someone has in the portfolio, can possibly hold on. For levels of closer to about 640 to 680. I think going beyond that would be a bit difficult.
All right, I think the futures as well is at a big discount actually. So I don't know whether the street is factoring in, maybe a probable OFS on one of the entities or maybe in fact a dividend. Hopefully that's a sweetener. So the futures are actually, I think, at a percent, $6-7 discount or $8 discount in comparison to the cash market rate.
Okay, well, I think the CAS session has gotten underway now. It's 3:20, which means that the 3:15 the regular trading stopped, and 3:20 is when you can start entering orders as far as the CAS session is concerned. The timing is 3:20, 3:28, and between 3:28 and 3:30 is when rate is final rate is calculated. And the rate, of course, is a random close. In that sense, 24,182 and 24,209. That's the August futures. Of course, futures and options market will continue to trade all the way till 3:40. Sudarshan, Amrish, just a quick word on Sudarshan Chemicals. What are your numbers for 27, 28? There are basically the only question here is the European asset. Will they be able to sweat it properly and make it work properly? There's been some pushback. That And that's the big unknown, right? It's first of all, it's an acquisition. Second, it's Europe, where you got all kinds of problems with regards to high gas prices, an economy which is not doing all that well. That's been the pushback on this one for a while. So what are the numbers you're factoring in, 27 and 28?
See, I mean, for 27, 28 overall, I mean, I'm looking at a 60 rupees EPS, like what I said. And I mean, we are expecting that, like the next 1.5 years, I think is more than enough to get the whole thing on track. To a certain extent, I mean, they've been able to bring it on track. But I think the next 12 to 18 months should be good enough.
I see. Okay. All right. I think what we can do is just take a quick break here. We'll just come back and we'll continue the discussion. There is flash coming in on Ramco Cements. They're saying that MMRDA Act halts mineral land tax obligation. I mean, I think this is largely just an acknowledgement of what the Act says, and we've sort of covered it extensively. And I think they're giving some numbers. Company incurred
160 rupees per ton.
Per ton, which, I mean, basically now the responsibility for collection, etc., goes to the center and moves away from the state. Najir.
Yeah, that's right. But as Rakesh Arora as well, when he joined us, he said, mining they'll not charge, but they'll say there'll be some kind of way when you're transporting the limestone, then maybe you'll have to pay some duty. So for the time being, it'll come as a relief that the 160 rupees is stopped. All the control is with the center. But will the state impose something else that results in them paying something out of the pocket? So we'll have to keep that for the time being, as we know. That's a positive, that giving the center the control, because this tax actually came in only around 18 to 24 months ago. So that's why Ramco would be best benefited, and Dalmia as well, as we know, because they have a large proportion of their limestone that they're taking from the state of Tamil Nadu. So a bit of a pop, but this is more or less in the price. What happens from here on is what we have to see. For the time being, we slip into a short break, come back, continue our chat with Amrish Baliga. Stay with us. Welcome back. Well, the markets are still down close to 70 points, but the advanced decline ratio is almost even Stevens, which is telling you select stocks are doing pretty well. Well, let's continue our chat with Amrish Balega. Amrish, I wanted to ask you about the real estate space. There are some reports that are suggesting sales are slowing down, inventory is going up, but stocks seem to have factored in some part of the bad news. Lodha is up in today's trading session. What is the stock that you all like from the real estate basket?
In fact, I mean, I like Godrej to a certain extent, Oberoi Realty to some extent. Again, I mean, at this point of time, we are seeing that the premium housing is doing much better than the affordable or the middle class housing. So the ones which have a larger portfolio of luxury housing, I think they are the ones which should do better, at least in the foreseeable 3 to 4 quarters more.
Okay, got it. So Godrej, DLF and Oberoi are the ones that you like, right?
Right.
Okay, got it. All right, let's focus on a couple of other names then. Dixon Technologies, pause for breath, good for more, because the stock has had a good run, 10,000 to around 15,000 rupees. So you compare it to the peak of 18,000, it still stays down. What's your view now? Are they getting the pieces together?
I mean, if you if you see the last 1 year, they're still down from those 18,000 plus levels. And again, we are seeing that the government is giving further SOPs for this sector. So the focus is clearly there on this space. So Dixon, in case it corrects a bit from here for whatever reason due to the market or possibly due to Trump, I think can be bought. I think the levels are closer to about 14,000, 13,750, 14,000. I think should be a good entry level.
Any thoughts on Shilpa Medicare, Amrish? Has it appeared on one of your lists? I mean, if you look at this closely.
No, in fact, I've not tracked that at all.
Wow, what a move, right? I mean, it's up. It's been turning out to be, the year where it's kind of made it, absolutely made it. About 170% this year so far, Shilpa Medicare. And just a one-way move is what we've seen on this one coming through.
Cash session is done, I think.
Yeah.
And the market actually has gone in favor of the bulls. Because we were down 70 points, now we're down 32 points. So it appears the cash session actually has gone, it's cut the losses at least for the Nifty.
Okay, well, if you have the graphic, right, which basically gives you the difference, we should put that up for both the Nifty Bank and there you go. No, not this one. The 315, 330 prices on one graphic, which tells you the difference between the Nifty spot prices at 315 and 330, if you're able to quickly do that. So for the Nifty, for the Sensex, for the Nifty Bank as well, that will give you a sense. Yeah. So the Nifty change between 315 and 330 is 36 points. Nifty Bank is 106 points. And the Sensex is about 42 odd points or so. So I guess acceptable, small changes. But that's the closing bell, which has gone on as well. So 24,219. This morning we started at 24,300, by the way, at the day's high, 24,300 plus. So from there's been a fair bit of a slip, which happened. But we were down 100 points at about 2 o'clock or so. So from there, the final closes come through with about a 33 point odd cut. The Nifty Bank on your screen, the Sensex on your screen, the small cap, mid cap indices, which did much better. Market breadth, though, overall was sort of in favor of declines. So 1,840 stocks were down, about 1,670, 1,680 stocks were higher. And the only one index which was up, in any fashion was the metals index, which was up 1% plus. The PSU Bank index was down and a bunch more as well. But nothing large in that sense, except maybe, a stock here and there, which we've been highlighting over the last 60 minutes or so.
Well, that's right. The new listing, Lalita Jewelry, that was beautiful. Look, it was glittering today, was up close to 25%. Shanti Gears that we have been covering over the last few days, Sudarshan and Vinny have been doing a deep dive into that one. That stock, in fact, was up close to 20%. Balu Forge as well was up close to 13% in today's trading session. And throw in there some fundamental news coming in for TVS Supply Chain. The stock was up close to 10%, while LT Foods as well, up 7.5%. I think KRBL as well did pretty well. On the flip side, a few stocks have got slammed. Balrampur Chini, not too sweet today. Stock was down 5%. BLS International, the stock was down 10%. And Ship Rocket, after taking off like a rocket, that's cooling off a little bit. That as well was lower in today's trading sessions. So to sum things up, the Nifty goes home with a bit of a cut. The advanced decline ratio is pretty much even Stevens, and the mid-cap index was the spot that had a good amount of grain. Well, on that note, we'll wrap up on this edition of Closing Bell. You stay with us. The team of Markets Forward comes up next.
Markets failed to hold early gains, ending marginally lower. Nifty holds above the 24,200 while the broader markets outperform.
HCLTech shares rally over 5% after the company unveils its AI-first strategy. The management claims over 50% revenue is already AI-infused and sees a $300 billion-plus opportunity.
Tata-owned Indian Hotels announces a merger with Oriental Hotels in an all-stock transaction. All eyes another acquisition worth nearly 2,000 crore rupees. CEO Puneet Chhatwal remains tight-lipped on any likely deals. Hello and welcome to Markets Forward on CNBC TV 18, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vinny and with me is my colleague Ritu as well. Ritu, hi, good evening. And today is a bit of a day where we started in the green and then we saw the markets go towards a day's lowest point, a bit of a recovery in the second half of the trading session. Managed to close about 24,200 levels as well for the markets. But in terms of sectors, what didn't do well today? Banking was clearly under pressure. And apart from that, you had financial services, autos, pharmas, that too were trading in the red. IT managed to hold on to some bit of a green. And what was leading the charts today in terms of a sectoral move, Ritu, was metals as well. Good evening and over to you.
Well, yes, good evening. Vinny, not such a good day for markets. It was pretty volatile, pretty choppy. Like you said, started in the green, but erased most of those gains through the day. So, not closing on a great note, but there were pockets that were doing slightly better that you pointed out. Metal, for instance, real estate, energy, IT, all of that was well. But on the flip side, apart from banks, you had autos, pharma, all of that added to the pressure. In fact, names like Bajaj, Finance, Reliance, SBI, these are the top drags on the Nifty, whereas on the other side, Hindalco, HDFC Bank, Infosys, JSW Steel, these were some of the names that helped, the markets chug along. But in terms of market breadth, it was pretty much even-stevened, although there were a tad more stocks that were on the decline. About 18 stocks on the decline versus about 1561 that advanced in trade today. But let's get you a lineup of what we have in store for you. We'll start with the top movers and shakers of the day with Vivek Iyer. We'll also decode Hexaware's AI push, get you the latest on BLS International Visa Probe and the block deals that were in focus today. And last but not the least, as always, we'll delve into the key market events to watch out for in tomorrow's trading session. So let's kick things off with our first segment of the day. Vivek Iyer joins us now from the big wall with the top movers and shakers. Vivek.
Well, thank you so much for that. Not too much action, especially in terms of the broader end of the market. Quite a volatile trading session and skewed more towards the declines, especially when you look at the second half of the trading session. Individual stocks that were in focus, have a look at Orient Hotels. Finally, the merger with Indian Hotels is something that came about. Stock saw a sharp uptick and post which cooled off a little bit, ended higher by over 2%. Hexaware Technologies clearly cheered the fact that the company held an analyst day where they spoke about all of the AI opportunities that was present in front of them. That particular stock higher by almost 6%. Vishal Megawatt, a clear standout performance in today's trading session. Overhang removed, especially given the fact that the MD and CEO tenure has been extended by another 5 years. The entire metal pack, most of those names did quite well in an otherwise very weak market. So names like SAIL, Hindustan Zinc, Welspun Corp, all of these names managed to end the day with large gains. And rice stocks, today after a while, you saw both LT Foods as well as KRBL doing very well, both of them higher by over 7% each. On the other hand, quite a few drags as well. BLS International clearly stood out given the fact that you actually saw a lot of negative news flow, a clarification coming about, but despite that, the stock ended the day low by 10%. Aegis Logistics, remember, was a clear outperformer in the week gone by. Today saw a bit of profit booking emerge after the strong outperformance in the week gone by. Baroda Bank, that particular name, again, one of the top banks as far as the Nifty Bank was concerned today. And both Biocon and Syngene under quite a bit of pressure after a series of good performance days, especially as far as Biocon is concerned.
Okay, Vivek, thank you so much for rounding up in terms of what happened in individual stock names, as well as which are the stocks that were falling in the trading session as well. On that note, let's keep it going with some individual names. We had the shares of Hexaware Technologies that rallied over 5%, and this came in after the company laid out an ambitious AI-first strategy plan. Let's go across to Rima to give us the key takeaways from a company's AI Day event. Rima, over to you.
Well, it was all about AI at the Hexaware AI Day held over the weekend in Chennai. One number that the CEO Sri Krishna shared with us that we didn't know earlier. He disclosed that more than 50% of Hexaware's revenues are now AI infused, which means linked to AI. There are some reports which talk about the company laying out an ambition of $3 billion by 2029. But here, let me clarify, the company did not say so in the AI analyst meet. But what they did talk about is the new AI-related work. He spoke about deflation, but he also spoke about the new AI-related opportunity which is emerging. And similar to what Infy had to say, the total addressable market opportunity is in excess of $300 billion. So just to share some examples. So one, he's saying the company is targeting replacement of SaaS-related workflows into client-owned AI-native solution. So that's one opportunity. Secondly, he spoke about many of the pilot projects linked to AI fail because the data is not ready. So data readiness is an important opportunity. Thirdly, he spoke about how autonomous AI agents are doing a lot of the work. They're actually executing, not just answering your queries. So there is work surrounding management of AI, onboarding them, monitoring them, governing all these AI agents. So there's a lot of AI-related work. The new TAM is there. It's opening up, and that's what the Hexaware CEO spoke about. The brokerage verdict is mixed. You've got a Jefferies with an underperform and a CLSA with an outperform.
All right, Rima, thanks very much for joining in with that. Let's bring in our guests to take the discussion forward. We're joined by Ambrish Paliga, an independent market expert, and Jay Thakkar from ICICI Securities. Gentlemen, thanks very much for your time here. Jay, let me start with your call on Hexaware itself. Underperforming the markets in the last 1 month or so. The stock has just gained about 1.2%. Year to date is down almost 26.5%. Your call on this, where you see it headed from here and what you make of that potential AI opportunity there.
Hi, very good afternoon to you, Ritu. And we'll see, as far as Hexaware is concerned, so far, yes, the stock has managed to bounce back significantly from its recent lows. And with that, I would say that, there is a good chance of, a retracement of the overall fall, Ritu, which we have seen recently. In that process, the stock can actually go and test the levels of 600 as well. See, what has happened is the overall IT pack since last couple of weeks have actually seen overall reversal from down to up, and in that process we have seen good short covering happening, within which the mid cap IT's performance overall has been relatively better as compared to the large cap names like Infy or TCS, although we have seen short covering happening there. But meaningful move has been seen in the stocks like Coforge or Persistent. I mean, these are the stocks which have really outperformed. And I think going forward, we will be seeing good up move continue in the mid-cap IT names. Hexaware, as far as that is concerned, I mean, you can see a bounce until 600.
Okay, point taken there. Thanks so much for that, Jay. But let's move on and go across to Vivek now, who is here to tell us some important block deals that are happening. We'll continue to see this coming in as well. Meesho as well as Lenskart. Vivek, over to you.
Well, that's right. Whole of last week, almost every day we were working with at least one block deal that was happening during the trading session, and today was no different. 2 large block deals is what we saw during the course of the day. In fact, most of the block deals actually took place in the pre-open window or the block deal window itself. First one, of course, was Meesho. We saw over 1% equity trade hands, or a little over 900 crores worth of equity, or was something that actually saw exchange hands, and this happened at 200 rupees a share was the deal at which it took place. Now, as for the term sheet we managed to access during the course of the weekend, one of the sellers here is Y Combinator, an early stage investor fund, and they were looking to sell over 1% stake. We understand that there is now a 30 days lock-in as far as further sale of shares are concerned. The other stock on the radar was, of course, Lenskart. A little over 2.5% equity changed hands, 4.5 crore, $300 million worth of equity traded hands. The likely seller as per the term sheet was SVF, also known as SoftBank Vision Fund. Again, an early investor. They held close to 10% stake at the end of the June quarter. Most likely they have made a part exit, or they've been trimming stake. Again, over here, before they can sell, once again, there is a 30-day lock-in period as far as further sale of shares are concerned. So both Meesho as well as Lenskart, large block deals happening. It'll be interesting to see what the disclosures indicate, especially in terms of the buyers for both of these blocks.
All right, Vivek, thanks very much for joining in with that. Speaking of deals, Ambrish, if you would come in on the IHCL Orient deal that was announced, at least for IHCL, the market didn't seem too enthused. What did you make of it, and what kind of upside do you see from this kind of inorganic growth?
Oh, no, in fact, I've not tracked that very closely, so it's a bit difficult for me to really comment on that.
All right, but overall hospitality space, Ambrish, anything you like there?
Hospitality space overall, I like it because really the the average room rents have moved up and they've stayed up, and this we have seen after close to a decade. If you see the last 3-4 years, the ARRs have been moving up, and that is clearly shown on the profitability of most of these hotel companies. And here, in fact, my pick would be Lemon Tree Hotels, where I see a price level of about 140, 145 or so.
Okay, Amrish, thanks so much for your view coming in on the hospitality space. But let's move on and talk about a stock that was down and out in today's trading session, and that was BLS International. It fell over 10% intraday, and this came in after the Spanish authorities had reportedly widened their investigation probe into an alleged visa problem that was going on in Spain. Now, the Spain's National Court had said that, there was some case that was going on in terms of Schengen visa residents as well as work permits that were allegedly cleared on questionable or forged paper. So this is actually BLS has and is handling a lot of Spanish missions as well. They do have some tie-ups for a very long time. Now, BLS International has given a clarification because what BLS International actually does is strictly administrative is what they're saying. They are just carrying out the prescribed requirements that are required from the competent authorities. The clearing process, the issuance process, the refusal of visa or any sort of that is obviously with the consulate or the diplomatic authorities. So they've categorically mentioned and rejected any involvement in these irregularities. No evidence has been established for any of the wrongdoing from the company as well. This was according to newspaper articles and news articles that came in as well that mentioned about this probe that has been widened. This probe was going on in Spain, but now it has just been widened and BLS's name was mentioned in the scope that yes, now it's extended to BLS as well. But as of now, this is the clarification that we have coming in. Not seeing any sort of a recovery through the day after this clarification as well, but that's on BLS International. Yes, Ritu, this is the concern that's come in here for BLS International, hoping that we'll see some recovery or more clarification or notes that come in here as well going forward.
Well, thanks very much, Vinny, for filling us in. As far as BLS is concerned, that stock fell over 10%, despite, as Vinny explained, that clarification coming in. Well, let's move on to the IPO show, which continues pretty strongly. You had Lalita Jewelry that made a stellar debut on the bourses today, listing at a premium of 32% over its IPO price. The company's market cap has crossed 11,500 crore rupees on day one itself. But in contrast, Blackstone-backed Horizon Industrial Parks had a flattish listing. The stock ended the day about 4% lower in trade today. Let's get back to our guests for more on this one. Jay, starting with you, a whole bunch of new listings, including some of the ones that have happened today. Anything you like, anything that stands out in this particular space?
Well, to be very honest, Ritu, for me to actually comment on the recent listed stocks, I would say that I have relatively quite less data to basically analyze and deduce something out of it. Probably, I would be recommending or rather comment on the stocks which actually listed in last 3 to 4 years, and within which, if I have to look. Then within the F&O space, if I check, then Paytm is one stock which has significantly bounced back after having corrected heavily, and that is one stock which continues to trade higher. So I think that is one stock which can be looked into from the medium to long term perspective. If at all there is some consolidation seen out there, then can be looked into by creating the long positions. Second, I would be seeing is that Swiggy, because we've already seen eternal bouncing back quite sharply to lower levels and have performed quite well within the F&O space. And Swiggy relatively has not been able to perform, although there are a lot of short positions which have been created on Swiggy as well. And going forward, if at all we are seeing any bounce back in the market on account of short covering, this could be a good short covering candidate. So Swiggy could see at least 10 to 15% kind of an up move on account of short covering.
You know, Amrish, coming to you also, a lot of names that have come in the recent time as well. Anything that you like from this recent lot as well? You have Lalita Jewellers that has come in. Then you had Horizon Industrial Park also that's set here. You have Skyways Air Services, Gaja Alternatives. Anything you are looking at? Anything you have seen so far?
Gaja, anyway, I think the allotment should come today, listing maybe in the next 2 days. And I think this is one of those few, IPOs which hasn't really got oversubscribed too many times. I think it was fairly priced, so I had suggested people to apply for it. Lalita Jewelry, I think the listing was good, but I think there can be still, further upside from here, thanks to the gold prices which are going up. Festive season is coming, and post that, again, the wedding season. So I think there'll be decent demand, at least over the next 1 or 2 quarters, if not more. So Lalita, I think, can still be bought from here. Like I see at least either 15 to 18% upside as far as this stock is concerned. Milky Mist is the other one where, although the valuations were decently high, but then, if you compare with the peers, clearly, I think the margins are much better. So this is one stock to be looked at on a correction.
All right. For all the investors that may have had FOMO, perhaps still an upside to go as far as Lalita Jewelry is concerned, and positive on Milky Mist as well. Ambrish, thanks very much for those views, and Jay as well for joining in today. Appreciate your time here on CNBC TV 18. And with that, we'll slip into a short break. But up next, we're going to get you the top corporate voices along with the key market events. So stay tuned. Welcome back. You're watching Markets Forward, and it's time to get you the top corporate voices of the day. Now, in an exclusive conversation with CNBC TV 18, the management of Indian Hotels said its acquisition of Oriental Hotels is part of a broader strategy to consolidate and simplify the business. Now, the company is going to continue to explore inorganic opportunities, and it is willing to deploy up to 2,000 crore rupees on potential acquisitions. Now, with about 4,500 crore rupees of cash on its book.
And Tega Industries management says the preferential issue is a strong vote of confidence from Apollo Global, its partner in a Molycorp acquisition. The fund infusion came at a premium, with promoter shareholding expected to rise to 67.2% post the issue.
And Travel Food Services expects growth to return to the 25 to 30% range in the second half of this year. Speaking to CNBC TV 18, the management said it expects passenger growth to recover following some hiccups in the first half, while profit after tax margins are likely to remain around 28%.
Okay, those were the top corporate voices. But before we wrap up this edition of Markets Forward, let's go across to Ananya, who is joining us to tell us the key events to watch out for in tomorrow's trading session. Ananya?
Well, yes, Vinny. Let me first start with global markets. The US will release its July new home sales data and consumer confidence data, giving investors fresh signals on the American economy and consumer sentiment. Now, in the Eurozone, Germany's Q2 GDP final numbers and IFO business climate data will be the key indicators of economic growth momentum here. Now, coming to India, Piyush Goyal is in Japan for discussions on trade and investment. keeping India-Japan economic ties in focus. Meanwhile, NSA, Ajit Doval will hold the 25th round of boundary talks with China's top diplomat here, with broader stability and de-escalation on the agenda. Now, Doval is also expected to meet Chinese vice president here. And finally, Sankesh Jewelers and Sunshine Pictures are set to list tomorrow, so making primary market activity another point to watch. So watch out for these events tomorrow.
Ananya, thanks very much for filling us in. And on that note, we'll wrap up this edition of Markets Forward. Vinny and I take your leave, and thanks very much for tuning in. But you don't go anywhere. We'll be back with more news and updates after this short break.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Crude oil prices remain elevated as investors await what the White House has touted as the single greatest financial offensive ever against Iran. Tehran warns it will halt all oil exports from the Gulf and treat any country's support for US sanctions as an act of war. The Sensex and the Nifty failed to hold on to the opening gains, ending with marginal losses. The rupee weakens marginally against the dollar as it moves closer to the 96 mark again. India's aviation ministry proposes to limit the number of airports an individual airport operator can win in the upcoming auction of 11 airports. This after the finance ministry flagged risks about the oligopolistic nature of the aviation sector. India's top NBFCs seek relaxations over the proposed ban on revolving credit. Representatives from the Finance Industry Development Council argue for allowing top and mid-tier NBFCs to issue flexi loans. RBI seeks more data. Tata-owned Indian Hotels announces a merger with Orient Hotels in an all-stock transaction. Also eyes another acquisition worth nearly 2,000 crore rupees. CEO Puneet Chhatwal remains tight-lipped on any likely deal. Chennai-headquartered Lalita Jewellery makes a strong debut, lists at a premium of 32% after its offer was subscribed 63 times during the IPO last week. US imposes 50% tariffs on Canadian exports worth $20 billion after talks collapse. Canada's Prime Minister Carney promises dollar-for-dollar retaliation. President Trump quips Canada wants the benefits of being a US state without being one. Chinese fast fashion retailer Shein files for a Hong Kong IPO, valuing the company at around $27 billion. The valuation is more than 70% lower compared to Shein's private fundraise in 2022, when the company was valued at $98 billion. Bajaj Auto launches revamped Pulsar bikes with new engines and more features. The 125cc variant starts at nearly 93,000 rupees and the 150cc variant starts at 1.15 lakh rupees. Well, straight to the top story this evening. Global markets are bracing for what the White House has touted an economic D-Day against Iran in order to isolate the country. Tehran, meanwhile, has doubled down and threatened that not a single drop of oil will be exported through the Persian Gulf if Washington does not stop its economic war. Now, let's bring you up to speed with the latest developments today. Treasury Secretary Scott Bessent has said that Washington is now entering, and I quote, the end game with Iran. Remember, both sides have failed to arrive at a consensus after the ceasefire pact that was brokered in middle of June expired last week. Now, in an interview to CNBC, Bessent had announced that the sanctions would be the greatest campaign of coordinated economic isolation in the history of the world. He's scheduled to host a press conference later this evening to lay out the contours. Tehran has hit back at the US, saying that the new economic pressure campaign will fail and has accused Washington of punishing ordinary Iranians. Addressing a press conference, Iran's foreign ministry spokesperson Bajaj said the campaign will not deliver a different outcome. He also said, and I quote, the decision will only show the extent of hostility the US holds towards every Iranian, end of quote. The Iranian currency rial hit a record low of over 2 million to the US dollar. Meanwhile, Brent crude prices remain elevated. According to data from Kepler, less than 20 vessels have passed through the Strait of Hormuz overnight. Iran's National Security Council, Mohsen Rezai, warned that Tehran would target economic interests of countries that help the US. Here are the Iranian officials speaking on the negotiations and the likely US sanctions.
Look at the provisions of the memorandum. You will not find a single clause in which we have backed down or surrendered. If we signed that memorandum, it was because we believe a war cannot go on indefinitely. At some point, we ultimately have to make a decision to save the country from the state of neither war nor peace.
This is a repetitive scenario, from the crippling sanctions imposed during the Obama administration to the maximum pressure campaign during Mr. Trump's first administration, and now to the latest sanctions. All of these measures have been introduced under different titles, but they represent the same kind of bullying that we have always seen in American policy. In other words, it is the same movie they keep playing over and over again. We know this movie, so we know how to confront and deal with it.
The U.S. Treasury Secretary has called Washington's latest sanctions against Iran as, and I quote, the single greatest financial offensive ever marshaled against an adversary. What measures this exactly entails will be unveiled later today at a press conference by Scott Bessent, but his latest op-ed piece gives us an idea. Washington is looking beyond Iran at companies and countries that continue to trade with it. Besant specifically identifies those buying and transporting Iranian oil, moving Iranian money through banks and exchange houses, facilitating flights, registering vessels, and enabling fuel transfers at sea. This has particularly put China under the spotlight because China is among Iran's largest trading partners, and as of last year, China bought 80% of Iran's seaborne oil. China has already called these sanctions unilateral and is pushing for conflict resolution through diplomacy and dialogue. Washington is also presenting its latest rounds of economic sanctions as an alternative to kinetic action. Besant said that as long as they are pursuing economic sanctions, the likelihood of a large-scale military action is unlikely. However, he said that could change at any point. Now, the pressure on the Iranian economy is very high. The Iranian rial has fallen to a record low of 2.2 million against the dollar. But the Iranian Foreign Ministry has said that the latest round of American sanctions is desperate and is bound to fail, as previous rounds have. The Iranian security chief has also warned neighboring countries against cooperating with the US on this latest round of sanctions. And he has warned that if economic warfare continues, not a single drop of oil will leave the Persian Gulf or the Strait of Hormuz. As this unfolds, Pakistan's Army Chief Field Marshal Asim Munir is in Tehran today, and Oman's foreign minister is likely to visit Tehran tomorrow.
Well, you can watch the live coverage of the U.S. Treasury Secretary Scott Bessent's press conference as he unveils the economic sanction measures against Iran only on CNBC TV 18 starting 11 p.m. tonight. The contours of the sanctions that the U.S. proposes to impose will be revealed. Now, all of this is impacting crude prices. Crude prices remain elevated. They are above $90 a barrel despite a 2% drop on Friday. Prices are up 5% in August so far. Manisha standing by with more on crude oil and what the market is now expecting. Manisha, as the sanctions threat starts to play itself out, what is the street expecting as far as crude oil prices are concerned, holding above 90?
We are holding around $85, $90 a barrel for the WTI and the Brent prices. That is because the US-Iran conflict still is unresolved. You have Strait of Hormuz traffic trickling down. Normal was 135 to 140. It is just about 13, 15, sometimes drops to 5 in a day as well. And that is where support comes in from. The global refinery runs also have been on the lower side, down by 8%, and that has led to margins for global refining product margins for diesel much at around record highs. The street is also looking at Venezuela output continuing to decline. Soon we would be looking at winter demand from Western world. That in turn also is expected to support the prices, and that's exactly what we are looking at in sense of banks and brokerages, which believe that the current year could be slightly on the higher side, but the forecast for 2027 clearly are on the lower side. US IEA believes 85 is okay for this year. $69 is what they're putting for next year. JP Morgan puts 78 for this year, 60s for next year. That's exactly what is coming in from Citi as well. $80 this year, $60 an ounce of an average in 2027. HSBC has put $80 for this year as an average, 65 for next year. So as you can see, sub 70 is what Max and brokerage are talking about for 2027 in sense of crude oil prices.
All right, Manisha, many thanks for joining us. That's the outlook as far as crude is concerned. Let's talk about gold and silver. Prices there rising once again. In fact, gold prices are now at a 3-month high. Silver at a 2-month high. Gold prices up 14% so far in August. Silver has gained over 22% as concerns rise over U.S. debt and geopolitical uncertainties. All of that has sparked safe haven buying. Base metal prices also, by the way, have been moving up, but they have eased. They've come off their record highs. Higher inventory and a slump in China's property market have taken prices off both copper and aluminum, so they are now trading lower across the world. However, supply disruptions in the Gulf continue to have an impact on aluminum prices. From metals to the stock markets, the Sensex and the Nifty failing to hold on to their opening gains ended the day with marginal cuts. The Sensex lost about 170 points and the Nifty lost about 30 points today. Mid-caps closing in the green, Nifty Bank down by about 0.5% or so. So that's the story as far as the stock markets go. Over in the currency market, the RBI's forex swap window has seen a strong response, attracting nearly $73 billion so far. FCA and RB deposits make up the bulk of the inflows, but the massive dollar inflows so far have done little to bolster the rupee. Now, with the window set to close soon, the big question is how much more money could come in and why hasn't the rupee strengthened on account of the dollar deluge as well as the other measures taken. Ritu standing by to explain. Ritu.
Well, foreign currency inflows have touched nearly $73 billion under RBI's special forex swap facility as on the 21st of August, and 90% of these flows have actually come in from the FCNRB deposit window, which is at around $65.4 billion. Now, the mobilization has already surpassed the scale of RBI's 2013 window, and the pace has also picked up quite a bit. So the first $20 billion, for instance, that took 38 days to mobilize. The next $20 billion took 14 days, and the last $16 billion took barely 8 days, especially with the FCNRB deposit scheme in its final week now. So how much more money can still come in? Well, we had polled a bunch of economists, and the expectation is up to $80 billion in FCNR flows and a total of anywhere between $80 to $100 billion overall under the scheme. Now, interestingly, despite these record dollar inflows, you see the rupee has barely moved. I mean, it was at 95.71 to the dollar on the 8th of June when the scheme was announced, and then it was at 95.69 on 21st of August when already $73 billion had flown in, and it hasn't moved much since. So the question is, why has the rupee not rallied? And the key is to understand what is happening to the dollars. Now, under RBI's swap facility, what happens is banks mobilize these dollars and then hand it over to the RBI and receive rupees in return. And the RBI holds on to those dollars, so they boost our foreign exchange reserves rather than flooding the spot market with dollars. Now, since this $73 billion is not directly in the spot market, there is no direct impact on rupee levels. At the same time, higher oil prices means India's demand for dollars also remains very high, and corporates and importers are continuing to buy dollars, and that is pressuring the rupee. So in simple terms, we have a huge amount of dollars coming in the system, yes, but we also have strong dollar outflows thanks to the higher oil prices, and these inflows are not directly coming in the spot markets, and as a result, these inflows have strengthened the forex buffers, but they have not translated into a sharp rally in the rupee.
Ritu, many thanks. Now, an umbrella body representing 9 bank unions have threatened to go on a nationwide strike starting the 11th of September over pending demands. The unions, among others, have sought a 5-day working week, which has long been pending. They are also opposed to the government's revised PLI scheme for senior bank officers. The unions have also warned of a 3-day strike in the last week of September, an indefinite strike from October 26th if their demands are not addressed. So that is bank unions threatening to go on a strike. India's aviation ministry is proposing to limit the number of airports an individual airport operator can win in the upcoming auction of 11 airports. Now, this after the finance ministry flagged risks about the, and I quote, oligopolistic nature of the aviation sector. Madiha is standing by with more details. Madiha, interesting comments ahead of the proposed auction of 11 airports. What are the concerns that the finance ministry is raising?
Well, the government is now getting ready to put 11 more AI airports on the privatization block. But this time, as you said, it is also looking at a big question. How many airports should one private player be allowed to win? And that concern is coming from the finance ministry. The PPP appraisal committee met on August 4 to consider the civil aviation ministry's proposal to lease out 11 airports clubbed into 5 bundles. So Amritsar with Kangra Gaggal is one bundle. Second is Varanasi with Gaya and Kushinagar. Third is Bhubaneswar with Hubli. Fourth is Raipur with Aurangabad. And fifth bundle is Tiruchirappalli with Tirupati. Now, each bundle would go to a single concessionaire with a 50-year concession period. But here's where it gets interesting. The finance ministry has flagged that oligopolistic nature of the aviation sector and raised concerns about the market concentration and over-leveraging. Now, addressing those concerns, the civil aviation ministry said that the number of airport bundles of the 5 bundles that can be awarded to a single bidder will be capped. The important bit the government has not yet decided is what that cap will be. The modalities are still being worked out and will come back to PPPAC by the ministry. And why is the concentration such a big issue here? Look at what happened in the previous major round of AI airport privatization. In 2019, 6 airports were put up for bidding: Ahmedabad, Lucknow, Jaipur, Bengaluru, Guwahati and Thiruvananthapuram. And Adani Group emerged as the highest bidder for all 6. Since then, Adani Airport portfolio has expanded further to 8 airports, including Mumbai and Navi Mumbai. The other private operator is GMR that operates Delhi, Hyderabad, Mopa Airport in Goa, Nagpur Airport and the newly inaugurated Bhogapuram Airport in Andhra Pradesh. So today, Two private players control a significant part of India's airport infrastructure, and hence the government appears to be trying to avoid a repeat of the previous concentration by deciding not just who can bid, but potentially how many airport bundles one bidder can actually win. There's another angle here on employees. Under the proposed framework, existing AI employees would be covered by a one-year joint management period, with the concessionaire required to retain 60% of AI employees of those particular airports for up to 3 years.
All right, Madhya, many thanks for joining us. So, concerns being raised by the Finance Ministry ahead of the next round of airport privatization. On to the IPO corner. Lalita Jewellery made a strong debut on the Lal Street, listing at a 32% premium to its IPO price. The stock opened at 265 rupees against an issue price of 201 rupees, taking its market cap to over 11,500 crores. On listing day, the 1,700 crore rupee IPO had seen a strong investor demand, with the issue oversubscribed over 60 times. Oriental Hotels and Indian Hotels have announced a merger under the proposed scheme. Oriental Hotels shareholders will receive 25 shares of Indian Hotels for every 117 shares held. The swap ratio values Oriental Hotels at an 8.5% premium to its previous closing price. Speaking to CNBC TV 18, Indian Hotels MD and CEO Puneet Chhatwal said the company could deploy up to 2,000 crore rupees for inorganic opportunities from its 4,500 crore rupee cash balance. Take a look.
If any other inorganic opportunity comes up, it would really be a meaningful deployment of the cash that we have. We have 4,500 crores of cash. So we want to keep a watch list for any kind of bad times, unforeseen bad times that may come. And that could be 50% of that money. Another 50% goes into routine capex as well as new projects. But we keep accumulating cash in the quarter by quarter and years by years. So I think anything up to 2,000 crores is for us today not a big amount to think about. Anything which is closer to Indian Hotels, 35% or 30% plus. So a bandwidth of 30 to 35 is what we'll aim for.
Well, that's Indian Hotels. Bajaj Auto has launched new variants of its Pulsar, its flagship two-wheeler brand. The launch today was part of the company's plan to bring in 10 new or updated models to market before the festive season. The 125cc variant starts at nearly 93,000 rupees. The 150cc variant starts at 1.15 lakh rupees.
Every Pulsar stands for that feeling of adrenaline and thrill that no other bike can give customers. So that positioning has stayed consistent right from its launch in 2001. And then, of course, there are creative articulations, which would kind of keep happening along. We have a lot of women riders, for that matter, and the brand certainly doesn't have any kind of a gender bias. Our tagline, if one was to go by, is definitely daring. I think, and the brand really salutes a sentiment of daring the ordinary. And that's what defines any Pulsar.
Well, time for us to head to a break. But up next, the U.S. imposes 50% tariffs on Canadian exports worth $20 billion after talks collapse. Canada's Prime Minister promises dollar-for-dollar retaliation. That and more when we return. Shein is set to make its long-awaited stock market debut, but with a sharp valuation cut. The fast fashion retailer will begin trading in Hong Kong on September 1st at a valuation of about $27 billion. That's less than a third of the nearly $98 billion valuation it enjoyed in 2022 following a private fundraise. Shein will offer nearly 280 million shares with an aim to raise $1.77 billion through its IPO process. The US has imposed 50% tariffs on Canadian exports worth $20 billion after talks between the two countries collapsed shortly before the tariff deadline. Canada's Prime Minister Mark Carney has denounced America's last-minute move as unfair and uneconomic. He's also announced dollar-for-dollar retaliatory tariffs on imports of US steel, electronics and other products starting the 8th of September. Trump claimed that Canada wants the benefits of being a state without being one.
We cannot accept what they've offered, and we will not give what they've asked. Canada will match Washington's new tariffs dollar for dollar in order to protect Canadian workers, farmers, families, and businesses.
Well, that's Mark Carney on the dollar-for-dollar threat being held out by Canada in response to the US asking for what Canada believes it cannot offer. National Security Advisor Ajit Doval is in Beijing for the 25th round of the India-China talks on the boundary issue. Doval, India's special representative for border negotiations, will hold talks with Chinese Foreign Minister Wang Yi tomorrow. The meeting comes as both sides work to stabilize ties. China's President Xi Jinping is expected to visit India for the BRICS summit next month. Doval's meeting could also pave the way for a possible Modi-Xi interaction on the sidelines of the summit. Commerce Minister Piyush Goyal is on a 4-day visit to Japan. He's leading a nearly 200-member business delegation to strengthen the economic partnership between New Delhi and Tokyo. The visit comes as India and Japan mark 75 years of diplomatic relations. Goyal kicked off his visit with Tokyo and has already met top executives of many leading Japanese companies. Abhimanyu Sharma is here with more.
Several outcomes expected from India's Commerce and Industry Minister Piyush Goyal's visit to Japan, in which a review of the 2011 India-Japan trade deal is also on the cards. The deficit in bilateral trade for India is rising with Japan. Primarily, it's driven by specialized manufacturing and tech imports. Now, both the sides are looking to deepen their bilateral cooperation in several areas like semiconductors, critical minerals and pharmaceuticals. Japan aims to invest $62 billion in India over the next decade. Over $1.2 billion worth of investments have already been made by Japan into India. It remains to be seen what further outcomes are going to emerge from the deliberations between the Indian leadership as well as the Japanese leadership. Now, industries from both the sides, industry chambers from both the sides are also taking part in deliberations. Piyush Goyal is slated to take part in a roundtable with industry chambers. He has already held meetings with the Japanese leadership and he's going to chair a roundtable on capital goods and automobiles. He met the leadership of several Japanese as well as Indian companies, and the Indian delegation is also going to meet the FinTech Association of Japan as well as the delegates from the Japan Aerospace Exploration Agency. It remains to be seen what further outcomes are going to emerge from the minister's visit and from the industry deliberations which are currently taking place.
Abhimanyu, many thanks there, reporting from Tokyo. At least 13 people have died and 3 remain hospitalized after consuming spurious liquor in Gujarat's Bhavnagar district. Officials said 67 people consumed methanol-laced liquor, which was sold in bottles carrying the name of a popular brand. The manufacturing, sale and consumption of alcohol are banned in Gujarat. Delhi remains under a red alert as heavy rain and thunderstorms have lashed the capital. The severe weather has disrupted flight operations, affecting arrivals and departures at the Delhi airport and causing delays on connected routes. The Met Department has issued district-wise nowcast warnings as adverse weather continues. Tamil Nadu government has scrapped a proposed greenfield airport on the outskirts of Chennai, citing continued opposition from farmers and the impact on agri-land. The project was announced by former Chief Minister and DMK Chief M.K. Stalin in August of 2022. An alternative site will now be identified. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Well, the chemicals industry is one of the most critical pillars underpinning global economic activity. While China has long dominated the global chemicals landscape, India is steadily making its mark, supported by new areas of growth and expanding opportunities across the sector. Which phase are we in for the India's chemical industry, and which companies are best placed to stand out? Hello and welcome to Finding Alpha. I'm Nigel D'Souza, joining in from the Mumbai News Center. And to help us decode the opportunities and the outlook for the chemical sector, we're now joined by Ranjit Chirumala, the Senior Vice President, Research, Agri-Chemicals and Mid-Caps at IIFL Capital Services. Well, Ranjit, we appreciate you coming down to the studio. It's not a very, very easy subject, but over the years, I've seen that you're very, very passionate about this subject. So we thought we'll invite you and we'll explain all of this to our viewers. So thanks a lot for coming down.
Thank you, Nigel. Thank you for having me.
All right. Ranjit, let's get a few basic details first, before you take us a little bit deeper into the sector. Tell us what's the size of the global chemical industry. And obviously, from our viewer standpoint, we would like to know, where does India place? What's India's chemicals industry size? What kind of growth are we looking at? And where are we headed in terms of the global contribution?
Sure. Thank you, Nigel. It would be interesting to you to understand chemicals, and you would be positively surprised to learn that you actually use chemicals on a daily basis. Right from the day you get up in the morning, you have your oral care, those are chemicals. So chemicals is an industry which sits behind each and every industry. While we may not recognize it, but over the last couple of decades, or at least a decade, the market has recognized that. So give a few examples. You take home paints, that is chemicals. Coatings, cleanings, that is chemical. You take food, that requires agrochemicals, which is again a chemical. Fertilizer is a chemical. You talk about mobility, electrical vehicles, that again there is a chemicals that is involved. You take about electronics, so clearly there is a lot to do in the chemical space. So while it may look surprising to you that we actually use chemicals, but we have never recognized the potential of the chemical industry. Now there is a paper of Nifty Sensex, which puts or pegs the Indian chemical industry at $220 billion. And the thing that it marks is that we are a sub 3% when we compare it to the global chemical industry. Global chemical industry would be around $4 trillion kind of a market. So India has been growing at a double the rate of global agrochemicals. So if you look at global chemicals industry is growing at a 2 to 4%. India is expected to grow at a 6 to 8%. Okay. So that is where we are at. Probably 220 billions will go up to 300 odd billions by FY30. Nifty Sensex and the government of India is doing a lot of push to drive this.
All right. So from around 200 or $220 billion, we are headed to around $300 billion. So at $300 billion, how much will India be as a percentage of the globe?
The aspiration is that from a sub 3%, the expectation is that we should go up to at least 5 to 6% of the global chemical industry.
And as you mentioned that we are going to be outpacing the global growth as well. But let's focus on China, because that's the big daddy in there. Over the last 20 years, I think so, the way they have scaled their sales as well as capacity has been phenomenal. So let's get China out of the way. How much do they contribute to this global pie that you spoke about this $4 trillion chemical industry?
So China is both a major producer and major consumption. So if you look at their production, almost 40% is what they contribute to the global production. But again, what we have seen is that they set up a massive scale in the chemicals. When you talk about China chemical industries, you talk about in million tons. You never talk about in few thousand tons. So that has been the scale of the China chemical industry that we have seen over the last few decades. The entire Easternization story that if you kind of recollect a couple of decades back, where Europe was a major producing nation for chemicals, then they started taking care of the environment and they started carving out certain chemicals, and that is where China stepped in and they took that significant opportunity. And as a result, what we see now, they are almost 40% of the global chemical industry now.
All right, so China is the big daddy in there. But India would have some sectors, some spaces where we stand out, right? So if we are to highlight, where does India stand out? And then we'll get to where India is lacking. So if you want to put down a few pointers, or where is India holding on to its own?
So if you talk about what are the strengths of India, I will classify into 6 different parts. The one is the niche chemistry. India, if you look at what we are good at, is cracking the multi-stage, multi-step reaction. So you give us anything, we are very good at backward integrating. Though we will not develop new product, But once we know the products, we have that capability to make it in India and crack that process. And that is what even we have seen during the COVID times. We were also the ones to make vaccines for the world. So that is a key point that we see as far as the Indian chemical industry is concerned. And if you talk about the pockets, as I said, it's easier to understand when you compare it from the user industries. Agrochemical will become the one segment, pharmaceutical will become the other segment. The dyes, the clothes that we wear, it requires dyes, and dyes are nothing but chemicals.
Correct.
So if you take that particular thing, as far as the agrochemical is concerned, we are the net exporter. So there are very few industries which India is a net exporter, and agrochemicals is a one such thing. The second, if you look at dyes, colorants, intermediates, and that is where India has become a net exporter. And we have done a significant technological changes, or you call it process changes. That is what has led to these things.
Okay.
The third is that a select niche chemicals. So wherever there is a value addition, while China is concentrated on bulk, volumes, India carved out its niche that, okay, this is the value addition that we can bring to the table. We will cut down the number of steps. If it is a 25-stage step, we will cut down it to 15, and that is where we will give the value.
Right.
The fourth is the competitiveness. As I said, we always look about the process, how to improve the process, cut the throughput or improve the yields, and that is what made us the low-cost producer. The last and the final thing, if you look at the talent pool, given the size of our populations, given the number of students graduating, and BSc chemistry is the core. So we have the right talent pool. We also have a very port infrastructure, strong port infrastructure. When you talk about chemicals, it is always about import and exports. Having a good port infrastructure, having a seamless trade is also important. So all these things, when you look at in totality, that is what places India ahead of the other nations.
Lovely. All right. So agrochemicals is where we are exporters. You're seeing pigments and dyes as well when we stand out. The talent pool is good. And you give Indians a job, you know, they'll put things together, they'll cut down the processes, and in fact, they'll give you the best possible output. So we got that. What about where India is lacking? There'll be a few instances, right? I mean, I've heard forever that the R&D as a percentage is actually relatively lower. So put down a few points where India is lacking, because that could be where the potential opportunity as well is.
Again, if you look at different parts to it where India is lacking, hydrocarbons, that is the basic raw material for any chemical industry, and we don't have access to hydrocarbons. When I say hydrocarbons, it is largely the natural gas. And that is where India continues to lag, and unfortunately, we can't do much on that. This is a natural resource. Beyond that, if you look at the scale and the backward integration, that is what I highlighted. China thinks about scale. Whereas India thinks about the niche value addition thing. So that is what is missing. You rightly pointed out on the R&D. So this is the one thing which I used to tell all my clients in my initial marketing story, that don't go by the word specialty chemicals. That has kind of become a misnomer. By specialty, what you need is you have to invest a lot into R&D. You need to create a new products, develop new products. Are we doing that? No. What we are good at is that process chemistries. You give us a product, we will give it at the low cost manufacturing. That is, and another thing, if you look at the commodity kind of a scale, so India has a very high production of propylene, high production of ethylene. But what it is going into is a polymers. Propylene is converted into polypropylene, ethylene is converted into polyethylene. Look at globally, 90-95% is converted to polymers. Ethylene, 60-65% is converted to polymers. But when you do globally, a sizable part is diverted to the chemical industry. And that is where a lot of value addition, be it propylene or ethylene, can be done. And that is what is lacking. And lastly, if you look at the infrastructure, Gujarat is a best example. Dahej, we have created almost a mini China out there. But except that, where have we? In the rest of the India, we have seen some initiatives coming from the Odisha government, some initiatives coming from the Vizag. So hopefully over the next 5 to 10 years, we will be able to create these mini clusters. This is important because, as I said, chemicals is more about the import and export. We need to have that seamless. We have the ingredients in place. It's now us for put up the capex and then scale it up.
Okay, interesting. So there are some, areas where India can improve on. We get that. You know, you have put down a list of all the chemicals that we import, right? So if you could tell us, where is maximum import dependence? And also, which are the companies that are looking to actually fill in this gap? Because there could be a potential, right? Please go ahead.
So if you look at, as I said, we are dependent on hydrocarbons, and that is what has been limiting our ability to scale things up. So the good part India is that we have very strong demand. So there is a demand that is available. While the rest of the world is struggling with the demand, you take India, India is a growing nation and the demand has been very strong. But there are pockets where, a few examples that I would like to give is that ammonium nitrate. We are still 30-35% import dependent. And there are capacities that are coming up. Deepak Fertilizer is setting up that capacity. Chambal has set up that capacity. And there are a few other capacities that are coming up. So what has done over the last 1 decade, if you look at it as kind of a incentivized or make promoters aware that this is the way to go forward, we need to tap these opportunities. The case study that I would like to highlight here is a Deepak nitrite. A decade back, entire phenol or almost phenol was imported. Here was a promoter who kind of had this vision, we have to tap this opportunity. It was a big risk at that point of time. They're probably making 100 crores of a profit back then, but they had a vision of setting up a 1,500 crore capex. So that was the kind of a risk that they took. In the hindsight, if you look at, that was a very good decision. They were able to reap benefits. So India, if you look at that, import dependence has been cut down by, I think, less than 20%. They have increased their capacity from 2 lakhs to almost now 3 lakh tons through debottlenecking and other things too. What they are doing next, they are now have their target set on polycarbonate. In India, almost 3 lakh tons of polycarbonate is imported.
Everything is imported, right?
100% is imported. There is no manufacturer. But what it makes to make polycarbonate, polycarbonate is just the glass. It's a transparent glass. And the growing real estate is what is driving the demand. PC need bisphenol A. Bisphenol A needs phenol. They already have phenol. They are setting up another plant of phenol. This will take 3-4 years. But again, the intent is strong to tap the import substitution thing. But we can't do this for everything because, as I said, hydrocarbons is the weakest link for us. If you talk about methanol, almost 100% is kind of imported. We don't see anybody setting up methanol capacities in India. You talk about acetic acid, again, there are challenges because these are the capacities which require scale. And that is where the intent is lacking at this point of time, but visibly because of the weakness in the hydrocarbon chain.
So you told us about phenol, the Deepak nitrite, they went ahead and they put on that capex. So currently, how much of phenol is imported?
Currently, to my understanding, it should be less than 15-20%.
And at one point of time, it was...
They have a market share on 55% odd thing.
And at one point of time, almost all the phenol was imported.
Right.
And now
there were companies, but not to a scale that we can talk about.
Correct. And now polycarbonate is the other one that they're looking at. They're trying to help India in terms of the 100% import dependence, reduce that a little bit. Right? Okay, all right. Now, India's chemical industry, Ranjit, has gone through various phases. From the bulk producer, then gradually moving towards specialty chemicals as well. Then we went through a phase of euphoria because the China plus one theme was up and kicking. And then from 2022 onwards, suddenly, these companies came under pressure, margins came under pressure, China started dumping more, destocking did take place. Currently, which stage are we at?
So I would like to take you back a little bit if you talk about pre-2010 era. So 2020, what was the industry looking like? So as I said, chemicals is what we use on a daily basis. So this is an industry which has been there since decades, even without we realizing it.
Correct.
But pre-2010 era was all about commodity, low cost of production. And that is what it was into. So we were good in caustic soda, the soda ash. So all the bulk commodities is what we are good at. From 2010 to 2020, if you look at the series of events that has happened in China, we have seen a huge clampdown due to the environment. There was significant clampdown. There was regulation that was changed. So suddenly China started cutting production. And the world, which was heavily dependent on China, started realizing, hey, there is an alternative. So from 2010 to 2020, what we saw is a euphoric trend in all the chemicals. You just need to have a name of chemical in your company name and the stock kind of did very well.
Correct.
So that was a euphoria that we see. But what happened after 2020? COVID struck. Initial 2 years again just inflated because China was virtually set. They had a zero COVID policy. They didn't open up until 2022. Correct. So those 2 years, everybody wanted to stock. And what we saw, like I would like to give an example of agrochemicals. A $70 billion market globally went up to $85-90 billion because everybody was fearing for supplies. If they want 2 months, they were keeping 4 months of supply.
Correct.
That in a way led market believing that this is a structural growth and all stocks did well. But what happened 2022 to 2025? Reality check was there. China started, hey, we are here to do the business. They started slashing prices. In the US, interest rates were going up. So there was a just-in-time inventory concept that almost every company started. The supply chain decisions were started being taken by a finance guy. So that is where we saw a probably the steepest destocking cycle. And we have on record from the earnings call commentary from the best of the world's BSFs, BF, that the destocking cycle that they have seen the last 3 years were the worst in their lifetime. That was followed by the deflationary period. So that is what kind of a segregated, and the market started believing not everything is specialty chemicals. And that is where what we now see 2026, there is an easy way that has been set up. Here on the market is what they are looking forward is a sustainable growth, customer stickiness, long-term contracts, what value. So margin, EBITDA margin is a slightly different thing. They are largely EBITDA per metric ton. What is that you are going to protect and what is the moat of your business? So that is where the focus has shifted.
So now from 2026 onwards, the men will stand apart from the boys, you know, and after the painful period, probably things are on the mend and they could also look up for select chemical companies.
Yes.
Okay, let's focus on a couple of big themes then. The semiconductor space, that is red hot. Everyone wants to know which is the chemical that will be used in the semiconductor space, point number one, and battery chemicals. That's the other big area of interest. So from both these two themes, which are the chemicals that will be used and which are the companies that could potentially benefit from it?
So firstly, if you look at the semiconductor space, so India as a nation is putting a lot of emphasis on making semiconductors in India. And we have seen capital subsidy up to the 70-80% being given to the companies. So one company that I would like to highlight here is the Archean Chemicals.
Archean Chemicals,
yeah, okay. They are making a silicon carbide. They will import wafers. They will do the fabrication work there. And that is a theme which you will directly fit into the semiconductor theme. In addition, it would be interesting to know that semiconductors is a chemical intensive industry. You need basic chemicals like hydrofluoric acid, hydrochloric acid, sulfuric acid, ammonia, but the level of purity is completely different. Okay. We would have spoken about 1 or 2% impurity. There the things have moved to ppm levels. Now semiconductor will require ppt, parts per trillion kind of an impurity profile.
Okay.
So even though company may be making that, but it will be very difficult and complex to achieve that PPT level kind of a profile. Whichever company is able to do that is what will be able to supply. To begin with, I will say that this is still early days for the Indian chemical companies to tap semiconductor opportunity. But as the capacities develop, there will be a localization theme that will have to play out, and the companies which have the right product with the right purity profile will be the ones to tap this opportunity.
So we've got that. Archean Chemicals could be one of the potential beneficiaries as India focuses on the semiconductor play. Very quickly, if you could tell us about the battery chemicals as well, because there will be mobility over there and there'll be renewable energy as well, right? Please go on.
So to cut the battery into different parts, there is a cathode, there is an anode, and there is an electrolyte, and there is a separator.
Okay.
Each of these by nature are chemicals, while the extent will be different. So anode is a much simpler thing, it's a graphite. So ones who have the exposure to graphite and you are able to purify that, they will be the suppliers. The cathode is what is typically made up of NMC, nickel, magnesium, cobalt, copper, or it could be LFP. The way we are seeing is that LFP chemistry is kind of a catching up now. To make LFP, you also require FP, ferrous phosphorus. So there are quite a few chemical companies who have kind of an announced capex and they have serious intent. So if you look at the LFP way, Gujarat Fluorochemicals is the one that has kind of a clearly announced their serious intent to tap all these opportunities. In the peripheries, you look, the management's talking about SRF, Navin, and there are quite a few other managements as well.
This is battery chemicals.
This is battery chemicals, pure battery chemicals. As I said, cathode is LFP, and then you have FP. Sudhir Pharma is one such thing who is talking about setting up an FP, which you will eventually will go to make an LFP, and that is what would go into making a cathode active material or a battery. Electrolyte is what is there, which would be a customized thing, electrolyte salt, and these are again the chemicals.
So let's break it down then. Battery chemicals, when we're looking at that, the stocks that will be in focus will be SRF, will be Gujarat Fluoro, I think so, is what you mentioned. Which are the ones?
Gujarat Fluoro is what has announced.
Himadri Chemicals as well?
Himadri has announced. So these are the companies. So the one which I have direct coverage is Gujarat, which has a clear focus on these things.
Gujarat Fluoro.
On the peripherals is what you will have SRF and Navin talking about it, but we yet don't do any meaningful capex committed to this space.
All right, Ranjit, you're giving us a lot of data. For the timing, I'll tell you what, we'll slow things down a little bit. We'll take a short break, come back, and we'll focus on the other gases as well that we would like to know. R32 is something that we'd like to chat about. Stay with us.
Hello and welcome to News Center. I am Ashmit Kumar. Now, global markets are bracing for what the White House has dubbed as an economic D-Day against Iran as Washington looks to isolate Tehran further. Iran, meanwhile, has doubled down, warning that not a single drop of oil will be exported through the Persian Gulf if the U.S. does not stop its economic war. The U.S. Treasury Secretary Scott Bessent has said that Washington is now entering the end game with Iran. Remember, both sides failed to reach a consensus after the ceasefire pact brokered in mid-June expired just last week. In an interview with CNBC, earlier, Bessent described the sanctions push as the greatest campaign of coordinated economic isolation in the history of the world. He's scheduled to hold a press conference later this evening to lay out the contours of this new set of economic measures. Now, Tehran has hit back saying that the new U.S. economic pressure campaign will fail while accusing Washington of punishing ordinary Iranians. Addressing a press conference, Iranian Foreign Ministry spokesperson Bajaj said that the campaign would not deliver a different outcome. He also said, and I quote, "The decision will only show the extent of hostility the U.S. holds towards every Iranian," end of quote. Now, to understand the implications of these measures, we have with us a distinguished panel. With us is Professor Adam Dixon. He's the Adam Smith Chair and the Director at Panmure House. We have with us Pramitpal Chaudhary, the Practice Head for South Asia at the Eurasia Group. And also with us is Ambassador D.P. Srivastava, former Indian ambassador to Iran. To all of our panelists, thank you so much for joining us. Ambassador, let me come to you first. The U.S. says that it's entering into an end game. That's what Scott Bessent is calling it. Help us understand what has not been achieved through a very intensive military campaign stretching across 6 months with a naval blockade, with all sorts of restrictions. What can such an economic program do against a country that is unwilling to negotiate, that is unwilling to surrender?
Very little, because the Americans have already exhausted their ammunition. Iran is under such intensive sanctions that there's very little else which US can do except two things. And that is, if US sanctions manage to stop China's purchase of Iranian crude oil, China, I think, is the only, or certainly the biggest purchaser of Iranian crude oil, accounting for something like 90% of Iranian crude goes to China. Now, these are purchased by so-called tin pot refineries. They are not really tin pot refineries, but yes, they are the ones which do not have much American exposure. In theory. So if US sanctions manage to break this lien and stop Chinese purchase of Iranian crude oil, that will be a major step forward. The second step is, and this perhaps has escaped most people, that today Pakistan is a major conduit of Iran's trade with outside world. And this started at the height of the trouble when America had first imposed blockade, and Iran decided to bring in some of its containers through Karachi port. And that traffic is continuing. It is in public domain. And if US sanctions manage to stop that, that will again have some impact. Otherwise, I do not think US sanctions can achieve what they have not been able to achieve through war. In my own opinion, I think the only way out is negotiation between the two sides.
Well, that's an interesting perspective. Let me take that across to Professor Adam Dixon. Professor Dixon, thank you for joining us. We've seen all forms of sanctions being slapped on Iran from 1979. It's been more than 40 years since that sanction cycle began. We've seen freeze of assets, we've seen embargoes, we've seen restrictions on oil imports, exports. none of that seems to have worked, all of it leading up towards 2026. What is it that Scott Bessent may have in mind to execute what he calls is an end game as far as this Iran conflict is concerned?
You're absolutely correct, Ashmit, that Iran is the most heavily sanctioned country and has been for more than a generation now. And so what we will see from Bessent in his later press conference is not more sanctions on Iran. What we'll see Bessent do is look for parts of the global economy, and in particular Chinese actors, who the U.S. can put pressure on. Now, this will be a very delicate balancing act for the U.S. because, of course, it does not want to risk conflict, not hot conflict with China, but does not want to, especially with Xi Jinping coming to Washington in September, doesn't want to flame the tensions with China. So I think what we'll see later this evening from Bessent is that the U.S. will look strategically and surgically to put pressure on certain firms. And again, as the ambassador mentioned, you have the teapot refiners that pressure is difficult to put on because they're outside of the dollar system. But there's still different actors. There's port operators, there are insurance companies, there's different actors within the supply chain, let's say, that the U.S. could try to put pressure on, including Chinese banks. But again, it will be a delicate balancing act for the U.S. to try to do that without causing systemic concerns within China. So this is ultimately a balancing act between the U.S. and China because, as I've mentioned, Iran is already heavily sanctioned.
Sure. Let's also bring in Pramit-Pal Chaudhary. Mr. Chaudhary, your thoughts on that? Again, this is boiling down to a situation where it's positioned as a face-off between the U.S. on one hand, China on the other. As the ambassador was pointing out, there's a U.S. Congress Commission fact sheet, and as per that fact sheet, China is responsible for purchase of 90% of Iranian oil. That fact sheet terms this partnership as the axis of autocracy. Mr. Chaudhary, I want to get your thoughts. Do you see any meaningful action being taken by Washington in terms of addressing what they call an axis of autocracy, or is this perhaps more lip service for constituents back home in the U.S.? We seem to have lost Mr. Chaudhary's feed. We have him on Apache line, but let's come back to Professor Dixon. Professor Dixon, same question to you. You mentioned that there have been previous actions against smaller entities, Chinese entities, but all of them continue to operate with the blessings of Beijing, with the blessings of Xi Jinping. Do you see Donald Trump taking any form of meaningful action against China, especially since Xi Jinping is scheduled to visit Washington the very next month in just a few days?
Well, I think we'll have to see what Bessent says. So I think the U.S. will look for those avenues to surgically, let's say, go after certain Chinese entities that won't draw systemic concern from the Chinese government. So the large state banks will not be touched in this, but they'll look for other actors such that, and again, non-Chinese actors that face potential scrutiny from the U.S. Treasury. And with the act such that actors themselves, unless the economic incentives are so high, will refrain from trading and supporting this flow of Iranian oil to China.
Sure. Let's get back to Mr. Chaudhary. We have him back with us. Mr. Chaudhary, again, the question that I was meaning to ask is that what kind of pressure can U.S. meaningfully apply on China? We've seen the U.S. test the limits of its influence, especially when it comes to Beijing, when it comes to Xi Jinping. Do you see any meaningful action against this axis of autocracy, especially since we're only a few days away now from Xi Jinping actually flying to Washington?
Yeah, there's a limit, I think, what America can do to China, because as you've mentioned, diplomatically, you're going to be seeing Xi Jinping coming. So that's one element of it. Second, China has its own ability to sanction America, as we've done before. Rare earths, critical minerals, various intermediary products, which they have used before. Many of them which are strategically important to the United States, for example, permanent magnets, which are used for drones and missiles at a time in America's own stockpiles are quite depleted on that front. And third, which we'll have to keep in mind to see how that plays out, is that the price of certain oil products, notably diesel, which India and China both are major producers of, could be affected at a time when Trump is heading for midterm elections. So there are a number of things that the U.S. government has to juggle as it considers secondary sanctions against China. And I'm guessing you're going to see a little bit of kabuki shadow boxing on both sides of this for the first few weeks. It means that Iran seems to be reasonably clear in its mind that it will continue to absorb a fair amount of economic damage, even more than it already has, and it's considered a considerable amount of damage already, before it's prepared to consider making the type of concessions that Trump wants on the Straits of Hormuz.
Sure. Coming back to you, Ambassador Srivastava, I want to get your thoughts. If this plan were to materialize, where the U.S. was able to break the back of this axis of autocracy, ensure that there are no Chinese shipments going out of the Persian Gulf, do you see Tehran responding by completely blockading the Strait of Hormuz? Those are words that have fallen from the Iranian leadership. Do you see them being able to actually execute that to ensure a complete blockade of the Strait of Hormuz, of Bab al-Mandeb? Is that something that you see that as a likely outcome?
I think it's possible. Iranians have the capacity, and they have demonstrated it in the past, both in Hormuz as well as Bab al-Mandeb. Hormuz traffic has already come to a standstill. It's not a question of what they'll do in future. Despite the American claims, there are very few ships going through. I think the figure I read in Wall Street, there was something like 16 or 10 ships a day, as against 136 ships a day before the war broke out. So Hormuz is already closed. And Bab al-Mandeb, there have been two attacks on Saudi ships. The rest of the traffic is going through. But in case there is Americans ratchet up the pressure,
sure,
I do not doubt that the Iranians will carry through their threat. And this will have major impact on all the countries in the region and their customers outside the region.
Sure.
Let me add one more point.
Yes, go ahead, Ambassador.
Let's not jump to a conclusion that what the Secretary has said will actually be carried out. The reason is, and there's the other thing brewing in the background, and that is the sanctions on Russian oil. You carry them out, and the oil prices, which are already $93 a barrel, there's Brent. The Indian crude oil basket has reached 95, and WTI is just $5 behind Brent, 88 or so, which is very, very high. Those prices will go up, and they will be going up on the eve of elections in America. So it's a very, very difficult choice. And I hope neither side goes to that point.
Well, that's an interesting thought. Let me take that up with Professor Dixon. Professor Dixon, again, this is a concern that is being echoed across various markets as well, including India. There's a Lindsey Graham bill that's currently under consideration. It's before the House of Representatives. 100% levies for buying of Russian oil. Now we are seeing action to take the Iranian oil supply off the markets as well. What kind of pressure do you see that putting on oil prices? And is that something that will work against Donald Trump, especially as he heads into the midterm elections?
So I think one thing we have to keep in mind is, yes, there's elections coming up in the U.S. Now, Donald Trump is not standing for election, but there's congressional elections. And Donald Trump wants the Republican Party to retain control. Now, of course, gas prices, petrol prices in the U.S. have gone up about $1 a gallon and Americans are feeling the pinch. But let's remember that America is still a rich country, and the question becomes is how much economic pain can Iran withstand versus that of the United States? So, of course, Americans are being hit in their pocketbooks, but the election will be determined by much, much more than just the price at the pump. Of course, it will have some ramifications, but I think it would be wrong, and India understands this as another democracy, that elections aren't just decided by the pocketbook. Of course, Trump would like to have gas prices go down, and if Russian oil comes off the market, as Iranian oil is already off the market, then that will have upward pressure on oil prices. But what we've actually seen in the last months, though, is that a lot of other suppliers have come online and increased production, right? I mean, Brazil is a major producer. Saudi has used other routes. Now they're being put under pressure in the Red Sea through Iranian proxies, which is yet another issue. So I think it's what we've seen is a certain resilience in the oil market, such that yes, there's pain, but speaking from Western Europe, where I am now, Iran is not in the news at the moment, nor is it very much in the news in the United States, right? So this is not a huge issue that I think the Iranians would like to think it is, right? I think, sadly, I mean, the Iran issue has gone outside of the media interest. Now, obviously, this afternoon or this evening in Washington, there will be some interest to it, but it's not dictating the everyday lives of Americans. So I think what happens, of course, will have some impact, but I don't think it's the main variable that the Trump administration is looking at. And I think the thing going back on what pain Iran can handle, I think what we've not discussed is how dire the economic situation is in Iran right now. I mean, its inflation has gone up, the rial has collapsed. I mean, this is an economy and hence a population that is suffering, and that will put pressure on the regime. Now, the outcome could be that you have an even more dictatorial regime, as we're seeing, and Iranians are staying indoors and inside. But this can't last forever. And so I think this is what the administration is hoping for, is to be able to put increasing economic pressure on the regime such that they capitulate and stop funding their proxies in the region, that they open the Strait of Hormuz, and that we move back to some kind of situation where there's a promise, and a legitimate promise, to not produce nuclear weapons, but also not fund proxies in the region.
Right, Professor. On that note, let's slip into a very short break, but we'll continue this discussion. We'll focus on what the implications of this economic D-Day could be for India. We take up the India question on the other side of this short break. Welcome back to News Center. I have with me Professor Adam Dixon, Mr. Pramit Pal Chaudhary, and Ambassador D.P. Srivastav. We're, of course, discussing Scott Bessent announced economic D-Day for Iran, an economic campaign that the U.S. believes will cause the end of this conflict to be brought about. Let's take that question up on the India impact of this. Mr. Chaudhary, let me come to you first. Let me get your thoughts. India has been fairly resilient when it comes to sourcing of energy, even when we had the initial restrictions on Russian oil. The data suggested that we were continuing to buy more and more of Russian oil, which continued through this conflict. Do you see India yielding to this kind of pressure from Washington, especially at a time when the ties between the two countries are not at their best at this stage?
So a couple of points to be made here. One is that India has never defied Western sanctions. What India has done is negotiated a carve-out for its products. It said that, look, there is a case for example, diesel in particular, as I mentioned. It's not so much the supply of crude overall that is a problem. It is a supply of diesel. That if you cut out our diesel, which basically the bulk of the Russian oil that we import is converted to diesel because it's a medium heavy crude. And the bulk of that is often, a large portion of that is exported to Europe. That if you cut out our Russian oil imports, Europe is the economy that suffers because they do not have another source of diesel of that scale. Because Europe has not built a new refinery for something like 40 or 50 years. And the Americans have said, yeah, that makes sense to us and exempted us, given us a carve out. So what we're already seeing on diesel right now, yes, Brent is going, or oil is going at about $90, $95 a barrel. The crack, which is the difference between the crude and the distillates, and within diesel, is over $100 now. The markets are looking at diesel and saying, wait, where is this diesel coming from? And it's not so much American sanctions that is the problem. It's the fact that Ukraine has knocked out about 40 to 50% of Russia's refining capacity. India is now importing crude from Russia and re-exporting it as diesel to Russia itself. So the result, though, is India is making a lot of money out of diesel and distillates, even as oil prices are rising. So that's one part of that story. India has also now got a degree of leverage in the sense that almost 2/3 of our LPG imports are now from the United States, and we're heading for about 1/3 of our LNG imports are from the United States. We're also importing about 5% of our crude from Venezuela, which is basically now treated as a colony of the United States as far as resources are concerned. So you're now looking at America and India and say, well, actually, we make a lot of money out of you. And so there's been a bit of, should we say, reluctance on the part of the American side to necessarily impose sanctions or on India, or at least to negotiate a carve-out for some elements of what India buys from Russia. So we are much better placed than we are before because global supplies of a lot of these products have readjusted to the Persian Gulf problems. And in America in particular, we're developing a new energy relationship, which is now in America's interest to preserve.
Well, that's an interesting perspective. Will India be able to negotiate a carve-out as a part of this economic D-Day plan against Iran? But Ambassador Srivastav, let me get your thoughts. Diplomatically, India has had historical ties with the country of Iran. We hosted their foreign minister very recently for the BRICS conference here in New Delhi. Tell us, diplomatically, does it complicate or restrict India's options, especially when dealing with countries in the region? And I'm not just talking about Iran, but I'm talking about Gulf countries as well.
Two things. The American sanctions against Iran have already affected India. And I should say they have deeply affected India. In terms of crude oil purchase, we don't buy any from Iran. We have stopped work on Chabahar port and so on. So what is it new that or additional that will impact us? I see very little. But the second part is that US sanctions, the new US sanctions, as Mr. Adams said, are not so much against Iran, but against third countries cooperating with Iran. Now, let's take it as he says. If that triggers an Iranian retaliation against Gulf countries, that will affect India because we do have a lot of business with India, with Gulf countries, and that is going on. So, yes, there will be impact of the new US sanctions, not in the way perhaps the US policymakers envisage, but in terms of collateral damage. Just like in the war, the Gulf countries became the collateral damage. And this time again, something similar could happen, which will affect us and which will affect the Gulf countries.
Sure. Let me take that concern across to Professor Dixon. Professor Dixon, you mentioned that this entire developments that you're seeing in West Asia not being reported very heavily out of Washington, not really affecting the American population. It's causing more pain for the Iranian population and the Iranian people as well. But at the same time, like our panelists are pointing out, it's also causing pain for innocent bystanders like India that's hoping to negotiate, to partner, to work with different countries of different regions. The question I want to ask is that where are we between the US-India relations at this stage? Do you think there's an appetite in Washington, in New Delhi, to negotiate some kind of carve-out, some kind of exception as far as India is concerned for securing its energy need, whether it's through Russia or whether it's through Iran?
So, I mean, I think that's the key question, right? Is that we've seen India replace one supplier with another one, and that other one is also subject to sanctions. Now, will the U.S. retaliate against India? I don't think it will. But I mean, that's my view. I think pressure will be put on India to look for other suppliers rather than the Russian Federation. So instead of going after India in an explicit way, I think it will be an effort to try to force India or push India to try to find alternative sources. Because there are alternative sources. Of course, the price will go up, but it's a global price that goes up, but it doesn't mean that there are no other supply options for India. I think, though, again, this is where the balancing act between the US is really between China, whereas India, I don't think there's appetite to retaliate and to force the Indian economy, let's say, to suffer unnecessarily through this particular action. Of course, as the ambassador said, there's collateral damage across the region, and that's to be expected. But it's the degree of that collateral damage. So even if you look at places in the Gulf, I mean, I've spoken with lots of people in Dubai, where there's a huge Indian population and there's huge amounts of remittances still to India, and the word I get is that it's fairly calm and life goes on. So of course, yes, if tensions rise, that will have a negative economic consequence on the region, and there still is an economic consequence from the conflict, even if there's not a kinetic war at the moment. But again, it's the degree of pain that countries from the US to India to the region can withstand. And I think it's Iran whose economy is under the most threat.
Sure, Professor Dixon. I'd like to thank all three of our panelists, but we're completely out of time. Professor Dixon, Mr. Pramit Pal Chaudhary, Ambassador Srivastav, thank you so much for sharing your thoughts with us. Clearly, all eyes now on Scott Bessent on getting a better understanding of what constitutes this economic D-Day. Those details, of course, are only a few moments away now. We're yet to hear from Scott Bessent, but that's all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here. Hello and welcome to this very special broadcast right here on CNBC TV 18. The world of the future is shaped by trade. That is the big defining characteristic of how countries, how nation states, how companies plan their future. And a key part of this matrix is, of course, DP World, one of the largest players in the world. And to help us understand what this will entail, what the next era of growth of trade will look like, is with us Mr. Narayan, the Group CEO of the DP World. Mr. Narayan, thank you so much for joining us. A pleasure that you could take out time for us. Let me begin by asking you a big, broad question. The trade of the future, many say, will be defined by geopolitics, by technology, and importantly, tariffs. We're seeing a lot of back and forth when it comes to tariff pressures from various sides of the world. Some say that the era of globalization, the way it was imagined at least, is over. Do you agree with that, or are we in only for a new phase of perhaps globalization?
The latter. I mean, I think trade is going to continue. Manufacturing will happen in where the best facilities for manufacturing are available, and consumption will happen wherever there is purchasing power. So I am more inclined to go with the view that the patterns of globalization will change. In the past, nobody weaponized what they had. There was a degree of reasonableness attached to sovereign behavior. Regrettably, that has been busted. Which is what is going to cause all the real alignments that you're going to see in the world. So everyone was very dependent on China. Now, if you're a corporate risk manager, you don't want so much dependency on single sources.
Sure.
So some diversification of manufacturing away from China, it's just sensible for that to happen. And so it will. Move to the next best place, whether it's Vietnam, whether it's Malaysia, whether it's India, whether it's LATAM, whether it's places in Africa. It became globalization where there were no barriers to capital flows and flow of goods.
Sure.
Right? Now these barriers have been created.
Okay.
So the financial system was weaponized. The trade barriers started coming up. Sometimes through tariffs, sometimes through sanctions, sometimes through something or the other. All this has basically vitiated that full free environment to something which is now going to be more negotiated, more bilateral, less multilateral. The latest thing you're seeing now is, airspace is no longer free. Marine waterways are no longer free. Everybody is claiming sovereignty over what belonged to the world and humanity. The fact is, the world will find a way. It's a river. If a boulder comes in the middle, it goes around.
We're in the midst of the West Asia crisis. You made references, of course, to waterways, the Strait of Hormuz, the Bab al-Mandeb. Big concerns there as to what that means for trade, what that means for global supply chains. Before we get to that, just want to ask you a question. In terms of the sheer military risks that such a conflict poses, Jebel Ali port, your flagship, has suffered damage as well. How do you account for these risks?
Suffered no damage.
There's no damage?
No. There's no damage to Jebel Ali port.
But is there an overhang that tomorrow, if this situation were to escalate, that perhaps raises some concerns? How do you account for these risks?
Well, right now the issue is that vessels are not being able to come through to Jebel Ali. So, Jebel Ali was the nerve center of the connectivity of trade between East and West. If you look at the map, it's actually somewhere in the middle of the world. Right? Now, If you take that kind of capacity away, it chokes everything before Jebel Ali and everything after Jebel Ali. If you shut the Straits of Hormuz, or they are not freely navigable, or they are not safely navigable, and do the same to the Bab el-Mandab and the Red Sea, the costs of goods manufactured on the other side, by the time they get to the consumption centers, is going to go up. So who pays for it? The consumer, ultimately. Now, to the extent that demand is elastic, consumption will reduce. To the extent it is inelastic, people will just have to pay more for everything. So inflation is written all over a situation like this. Consumption pattern, the growth of consumption is going to get stunted because some people will not be able to afford to pay the higher costs associated with this. The fact is there are alternates will come if this lasts for too long, but they will be expensive. Everything will have an additional cost. But broadly speaking, the world will respond. I am convinced that this is not a problem that will last in terms of time for a very long period. I'm hoping that better sense prevails. And you cannot have, so free airspace and free waterways. 90% of the world is water for the use of all. Everybody starts claiming sovereignty, and then you can imagine where this all ends up. And so I hope no bad, unhealthy precedents are set, and the world finds the right leadership to resolve the issues today.
Speaking of precedents being set, you're in conversation with a lot of vessel owners, of course, that navigate through the two critical straits, Bab el-Mandeb, Strait of Hormuz as well. Is there a growing understanding, acknowledgement that perhaps the only way forward is to agree to some kind of, for lack of a better word, some kind of tariff mechanism, a fee mechanism for passing through the strait? I mean, is that something that is the new status quo, the new normal that companies will have to make peace with?
I just think that where does it end? How many countries have, allow these kinds of passages? What will happen in Asia? What happens here will set a precedent, right? That you can do this. So, like, the Suez Canal was an investment. Something new was created, was built, was not natural. Same with the Panama Canal.
Okay.
But the Strait of Hormuz is natural. So what will happen to costs of energy? 20% of global energy flows through that. And then who will determine what the charge should be? What's good, what's bad? So either people will, if it becomes too much, people will just find a better way. You cannot, I don't believe that. So today, we have a situation where the impact is being felt all over the world.
Right.
And therefore, there must be a lot of pressure, which must come to bear to the warring parties. Losing access to those two straits for global trade will cripple it.
Let me actually get your thoughts on the near-term impact. You mentioned the Strait of Hormuz, Bab el-Mandeb, as to how it lies at the heart of global trade. In the near term, we're seeing shipping routes being changed. We're seeing container costs go up as much as some reports say 70% on a year-on-year basis. Will things get a lot worse before they get better when it comes to global trade? In the near term.
Definitely. See, capacities today aren't available anywhere. Every port in the world is choked. Because suddenly you've taken away 20 million TEUs of capacity right from the middle. It's no longer accessible. So where all the shipping networks, typically because the trade is globally so imbalanced, you have large ships that start Far East. They lighten loads once in Asia, once in Colombo, Salalah, Jebel Ali, once in Port Said after the Suez Canal. And that is how the east to west trade route works. And then there is a Pacific route, which is straight Far East, China to Europe, and to the US, West Coast. Now, that is not impacted. But this entire route, which serves the whole world, is choked. Plus the impact of energy on energy. So I just think that a resolution will be found. These are very fundamental things. Either it will change the world forever. So some change will happen. Old status quo, in my view, is just not going to happen again. We have a situation today where the world has lost trust in the far west, but no one else has yet won the trust. So you're operating in a vacuum. You're seeing the one common thing that you see across the world, doesn't matter what stage of development you're in. You could be a very advanced country, you could be a developing country, or you could be a undeveloped country. Is that you're seeing, from a political perspective, you're seeing a move to everybody becoming more conservative. So the liberals have lost out major globally. It doesn't matter whether it's the most developed or the most underdeveloped. This is a reflection of not whether globalization was good or not. There's no doubt about it. It was fantastic. A lot of wealth was generated.
Right.
But the problem was in the distribution of that wealth. The exclusion of the benefits of globalization have created these new geopolitical forces, which will play their part.
So you're saying it's a cycle?
It is. It's all a reflection of that.
Sure.
You know, immigration, trade barriers, weaponization of financial systems is a reflection of that.
That's an interesting perspective. How this
But
is
you
all
see it across. So this is not difference.
right.
It doesn't matter what stage of development you're in. So whatever happened post World War II is fallen apart. Something new will emerge.
Many are talking about the China plus one strategy, at least many here in India are talking about it. They talk about how companies want to move their manufacturing out of China, look at geographies such as India, such as Vietnam, which can provide that healthy alternative. What does that do to global trade in terms of perhaps having more centers of manufacturing, more centers of export? Does this bring the conversation forward on the need for having strong supply chains, having solid trade paths, of course?
Absolutely. I mean, you need to first examine why it went to China. Because China took advantage of a situation where traditional places of manufacturing were becoming too costly, and there was a massive cost advantage to move to China. And somebody didn't believe that China could ever become a threat. So get which capital went? Where do you think capital went from to enable China to become the manufacturing power of the world? It was all US capital. And then you came to a situation where there was over-dependency. But before anything, let me tell you that it was the Chinese who 10 years ago, a decade ago, told every China Inc. manufacturing outfit to produce for the rest of the world outside of China. So as global participants in development of supply chain infrastructure across the world, for a decade we only saw Chinese competition. Everywhere we saw opportunities to develop supply chain related infrastructure, we had only one competitor. That was Chinese.
That's an interesting thought.
So it's not, you can move it, and they did. They moved into Vietnam, big time, Malaysia, Africa, and again it was a question of wherever they saw the opportunity, or whoever saw the opportunity. Now obviously but two things are happening. People want nearshoring. They want to reduce the length of the supply chain to manage risk. People want diversification in their procurement strategy. They don't want to be over-dependent in one geography or in one area. They want many places, many suppliers rather than one. And this is normal. There's no rocket science behind this. This is normal risk management. You want that kind of diversification. Then you will be superimposed on issues around climate, etc., etc., etc.
You talked about how there is a call for nearshoring. India is hoping to be a part of that journey. It is in anyways a very large consumption hub. It is also looking to become a manufacturing and export hub. In trying to be a part of this new global supply chain, what are some of the issues that India will have to resolve to get a bigger share of GVCs?
I think, India is so uniquely positioned right now. So this is a moment in time in history where I think there's a massive opportunity. As these decisions are being made across the world, that where do we go if we want to diversify our basis for procurement? So I do the analogies like of a hub in shipping.
Okay.
If you're just a hub with no market, in everybody's book you're a cost center, network cost, because there's no revenue generated from a hub.
Right.
But if there is a market close to a hub, then that is where you want to make the hub. So if I look at the world today and I see India, it is the fastest growing market amongst the large markets of the world, amongst the large economies of the world. So to create scale, plus if you look at the demographics of India, look at the availability of human resources, talent, you this has to be the natural choice for everyone. Where you have a large market, you can scale to produce for the rest of the world. So again, these are moment in time opportunities. I think we have a very friendly and good environment in India today. But this is a window of opportunity. People will determine and make these decisions in the next few years.
How long would you give it? Next 5 years?
That's it. This is the opportunity for India. I think everybody recognizes India is the place to be. All the economic indicators in India are in the right direction. We have political stability, we have had major reforms, we are a digitized economy. I think I can't think of anything negative except us being able to absorb and move at the pace that is necessary to take advantage of this opportunity. The opportunity is staring us in the face.
To profit from this opportunity, you've given India 5 years. What are some of the immediate challenges that you feel the government of India should need to resolve? Is it entering into more bilateral trade agreements? Is it perhaps fiscal support to the industry to make up for any cost disadvantages of doing business here? What would you rate the highest on perhaps the priority list over the next 5 years?
Assist everybody to get the job done. Everybody is looking at India. What might be the challenges they are facing? Just this attitude of what can I do for you?
That will turn the coin. Let me then also ask you, if India is this a big attractive opportunity, we've seen the DP world invest significantly into India. Are there other opportunities that you're keen on exploring? Are you looking at further capex here in India?
We've been exceedingly bullish about India for a long time. And we already have, I think, $2 to $3 billion invested in India. And over the next 5 to 7 years, we have another $5 billion dollars to invest in India. We are looking at some major opportunities across the supply chain. Just so you know, we are big in coastal shipping. We have almost 60% of the coastal shipping market share. We're looking to register more and more ships under the Indian flag. And we are using the Gift City opportunity to do that. We have invested heavily in our container rail infrastructure in the last many years. We have 6 port concessions. We are bidding with one which is under construction right now in Kandla, Tuna Tekra. I believe we will have some opportunity to look at a big port coming in Maharashtra as well, to which we are keenly awaiting. We're going to be there as participants as and when it gets bid. As you know, we have some concessions which are now ending their concession life. So we are looking forward to what the government policy would be in respect of those concessions. We would love to see those concessions being extended. There's been so much change in the way container terminals are built today, their size, the nature of equipment, the technology that is being used. And these are all 30 years old. So they all need to be better in terms of quality. I think the plan for the new port in Maharashtra, which is significant size, is something that India has required for a long, long time. and someone is hoping to participate there as well. So across the supply chain, DP World has one policy, which is whenever we operate in any country, the first thing we try and do is to connect the country from within across a multimodal supply chain infrastructure, and then connect the country with the rest of the world. So we operate in 80 different countries around the world. So for every Indian business, we can open 80 new markets for them. And that's the kind of proposition we take to owners of cargo and manufacturers for all countries where we operate in. So we participate in the entire trade ecosystem, both within a country and then connect that country to everywhere else in the world.
Great. We're nearing the end of this question, conversation, Mr. Narayan. So a large part of our conversation has been about looking forward. What is the new reality? What is the new status quo? What is the new normal? So let me then by asking you again a forward-looking question. Technology. Everyone is talking about AI. No industry is isolated from this conversation. Tell us, to your mind, when you look ahead at the logistics provider of the future, what changes with the advent of this new emerging technology? Do you see AI applications being confined to the area where you're doing data analysis? Do you see physical AI, automated machinery operating? What is the future of this new emerging technology when it comes to logistics?
All of what you just said. I think, AI, I can tell you about our thought process at DP World. We don't believe AI is to problem solve. We think AI is so huge in terms of impact. We have to reimagine how we do our business, assuming that AI exists.
Mr. Narayan, I'd like to thank you for taking our time and for sharing these insights on a wide array of issues, everything from the West Asia crisis to what it means to have resilient supply chains to pressures that logistic infrastructure often faces and what the future will look like. Mr. Narayan, appreciate this conversation, appreciate the indulgence. Thank you so much for joining us.
Thank you for having me. It's a pleasure.
Always a pleasure.
Thank you.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Crude oil prices remain elevated as investors await what the White House has touted as the single greatest financial offensive ever against Iran. Tehran warns it will halt all oil exports from the Gulf and treat any country's support for U.S. sanctions as an act of war. The Sensex and the Nifty failed to hold on to the opening gains, ending with marginal losses. The rupee weakens marginally against the dollar as it moves closer to the 96 mark again. India's aviation ministry proposes to limit the number of airports an individual airport operator can win in the upcoming auction of 11 airports. This after the finance ministry flagged risks about the oligopolistic nature of the aviation sector. India's top NBFCs seek relaxations over the proposed ban on revolving credit. Representatives from the Finance Industry Development Council argue for allowing top and mid-tier NBFCs to issue flexi loans. RBI seeks more data. Tata-owned Indian Hotels announces a merger with Orient Hotels in an all-stock transaction. Also eyes another acquisition worth nearly 2,000 crore rupees. CEO Puneet Chhatwal remains tight-lipped on any likely deal. Chennai-headquartered Lalita Jewellery makes a strong debut, lists at a premium of 32% after its offer was subscribed 63 times during the IPO last week. US imposes 50% tariffs on Canadian exports worth $20 billion after talks collapse. Canada's Prime Minister Carney promises dollar-for-dollar retaliation. President Trump quips Canada wants the benefits of being a US state without being one. Chinese fast fashion retailer Shein files for a Hong Kong IPO, valuing the company at around $27 billion. The valuation is more than 70% lower compared to Shein's private fundraise in 2022, when the company was valued at $98 billion. Bajaj Auto launches revamped Pulsar bikes with new engines and more features. The 125cc variant starts at nearly 93,000 rupees and the 150cc variant starts at 1.15 lakh rupees. Well, straight to the top story this evening. Global markets are bracing for what the White House has touted an economic D-Day against Iran in order to isolate the country. Tehran, meanwhile, has doubled down and threatened that not a single drop of oil will be exported through the Persian Gulf if Washington does not stop its economic war. Now, let's bring you up to speed with the latest developments today. Treasury Secretary Scott Bessent has said that Washington is now entering, and I quote, the end game with Iran. Remember, both sides have failed to arrive at a consensus after the ceasefire pact that was brokered in middle of June expired last week. Now, in an interview to CNBC, Bessent had announced that the sanctions would be the greatest campaign of coordinated economic isolation in the history of the world. He's scheduled to host a press conference later this evening to lay out the contours. Tehran has hit back at the US, saying that the new economic pressure campaign will fail and has accused Washington of punishing ordinary Iranians. Addressing a press conference, Iran's foreign ministry spokesperson Bajaj said the campaign will not deliver a different outcome. He also said, and I quote, the decision will only show the extent of hostility the US holds towards every Iranian, end of quote. The Iranian currency rial hit a record low of over 2 million to the US dollar. Meanwhile, Brent crude prices remain elevated. According to data from Kepler, less than 20 vessels have passed through the Strait of Hormuz overnight. Iran's National Security Council, Mohsen Rezai, warned that Tehran would target economic interests of countries that help the US. Here are the Iranian officials speaking on the negotiations and the likely US sanctions.
Look at the provisions of the memorandum. You will not find a single clause in which we have backed down or surrendered. If we signed that memorandum, it was because we believe a war cannot go on indefinitely. At some point, we ultimately have to make a decision to save the country from the state of neither war nor peace.
This is a repetitive scenario, from the crippling sanctions imposed during the Obama administration to the maximum pressure campaign during Mr. Trump's first administration, and now to the latest sanctions. All of these measures have been introduced under different titles, but they represent the same kind of bullying that we have always seen in American policy. In other words, it is the same movie they keep playing over and over again. We know this movie, so we know how to confront and deal with it.
The US Treasury Secretary has called Washington's latest sanctions against Iran as, and I quote, the single greatest financial offensive ever marshaled against an adversary. What measures this exactly entails will be unveiled later today at a press conference by Scott Bessent, but his latest op-ed piece gives us an idea. Washington is looking beyond Iran at companies and countries that continue to trade with it. Bessent specifically identifies those buying and transporting Iranian oil, moving Iranian money through banks and exchange houses, facilitating flights, registering vessels, and enabling fuel transfers at sea. This has particularly put China under the spotlight because China is among Iran's largest trading partners, and as of last year, China bought 80% of Iran's seaborne oil. China has already called these sanctions unilateral and is pushing for conflict resolution through diplomacy and dialogue. Washington is also presenting its latest rounds of economic sanctions as an alternative to kinetic action. Bessent said that as long as they are pursuing economic sanctions, the likelihood of a large-scale military action is unlikely. However, he said that could change at any point. Now, the pressure on the Iranian economy is very high. The Iranian rial has fallen to a record low of 2.2 million against the dollar. But the Iranian foreign ministry has said that the latest round of American sanctions is desperate and is bound to fail, as previous rounds have. The Iranian security chief has also warned neighboring countries against cooperating with the US on this latest round of sanctions. And he has warned that if economic warfare continues, not a single drop of oil will leave the Persian Gulf or the Strait of Hormuz. As this unfolds, Pakistan's Army Chief Field Marshal Asim Munir is in Tehran today, and Oman's foreign minister is likely to visit Tehran tomorrow.
Well, you can watch the live coverage of the U.S. Treasury Secretary Scott Bessent's press conference as he unveils the economic sanction measures against Iran only on CNBC TV 18 starting 11 p.m. tonight. The contours of the sanctions that the U.S. proposes to impose will be revealed. Now, all of this is impacting crude prices. Crude prices remain elevated. They are above $90 a barrel despite a 2% drop on Friday. Prices are up 5% in August so far. Manisha standing by with more on crude oil and what the market is now expecting. Manisha, as the sanctions threat starts to play itself out, what is the street expecting as far as crude oil prices are concerned, holding above 90?
We are holding around $85, $90 a barrel for the WTI and the Brent prices. That is because the US-Iran conflict still is unresolved. You have Strait of Hormuz traffic trickling down. Normal was 135 to 140. It is just about 13, 15, sometimes drops to 5 in a day as well. And that is where support comes in from. The global refinery runs also have been on the lower side, down by 8%, and that has led to margins for global refining product margins for diesel much at around record highs. The street is also looking at Venezuela output continuing to decline. Soon we would be looking at winter demand from Western world. That in turn also is expected to support the prices, and that's exactly what we are looking at in sense of banks and brokerages, which believe that the current year could be slightly on the higher side, but the forecast for 2027 clearly are on the lower side. US IEA believes 85 is okay for this year. $69 is what they're putting for next year. JP Morgan puts 78 for this year, 60s for next year. That's exactly what is coming in from Citi as well. $80 this year, $60 an ounce of an average in 2027. HSBC has put $80 for this year as an average, 65 for next year. So as you can see, sub 70 is what Max and brokerage are talking about for 2027 in sense of crude oil prices.
All right, Manisha, many thanks for joining us. That's the outlook as far as crude is concerned. Let's talk about gold and silver. Prices there rising once again. In fact, gold prices are now at a 3-month high. Silver at a 2-month high. Gold prices up 14% so far in August. Silver has gained over 22% as concerns rise over U.S. debt and geopolitical uncertainties. All of that has sparked safe haven buying. Base metal prices also, by the way, have been moving up, but they have eased. They've come off their record highs. Higher inventory and a slump in China's property market have taken prices off both copper and aluminum, so they are now trading lower across the world. However, supply disruptions in the Gulf continue to have an impact on aluminum prices. From metals to the stock markets, the Sensex and the Nifty failing to hold on to their opening gains ended the day with marginal cuts. The Sensex lost about 170 points and the Nifty lost about 30 points today. Mid-caps closing in the green, Nifty Bank down by about 0.5% or so. So that's the story as far as the stock markets go. Over in the currency market, the RBI's forex swap window has seen a strong response, attracting nearly $73 billion so far. FCA and RB deposits make up the bulk of the inflows, but the massive dollar inflows so far have done little to bolster the rupee. Now, with the window set to close soon, the big question is how much more money could come in and why hasn't the rupee strengthened on account of the dollar deluge as well as the other measures taken. Ritu standing by to explain. Ritu.
Well, foreign currency inflows have touched nearly $73 billion under RBI's special forex swap facility as on the 21st of August, and 90% of these flows have actually come in from the FCNRB deposit window, which is at around $65.4 billion. Now, the mobilization has already surpassed the scale of RBI's 2013 window, and the pace has also picked up quite a bit. So the first $20 billion, for instance, that took 38 days to mobilize. The next $20 billion took 14 days, and the last $16 billion took barely 8 days, especially with the FCNRB deposit scheme in its final week now. So how much more money can still come in? Well, we had polled a bunch of economists, and the expectation is up to $80 billion in FCNR flows and a total of anywhere between $80 to $100 billion overall under the scheme. Now, interestingly, despite these record record dollar inflows, you see the rupee has barely moved. I mean, it was at 95.71 to the dollar on the 8th of June when the scheme was announced, and then it was at 95.69 on 21st of August when already $73 billion had flown in, and it hasn't moved much since. So the question is, why has the rupee not rallied? And the key is to understand what is happening to the dollars. Now, under RBI's swap facility, what happens is banks mobilize these dollars and then hand it over to the RBI and receive rupees in return. And the RBI holds on to those dollars, so they boost our foreign exchange reserves rather than flooding the spot market with dollars. Now, since this $73 billion is not directly in the spot market, there is no direct impact on rupee levels. At the same time, higher oil prices means India's demand for dollars also remains very high, and corporates and importers are continuing to buy dollars, and that is pressuring the rupee. So in simple terms, we have a huge amount of dollars coming in the system, yes, but we also have strong dollar outflows thanks to the higher oil prices, and these inflows are not directly coming in the spot markets, and as a result, these inflows have strengthened the forex buffers, but they have not translated into a sharp rally in the rupee.
Ritu, many thanks. Now, an umbrella body representing 9 bank unions have threatened to go on a nationwide strike starting the 11th of September over pending demands. The unions, among others, have sought a 5-day working week, which has long been pending. They are also opposed to the government's revised PLI scheme for senior bank officers. The unions have also warned of a 3-day strike in the last week of September, an indefinite strike from October 26th if their demands are not addressed. So that is bank unions threatening to go on a strike. India's aviation ministry is proposing to limit the number of airports an individual airport operator can win in the upcoming auction of 11 airports. Now, this after the finance ministry flagged risks about the, and I quote, oligopolistic nature of the aviation sector. Madiha is standing by with more details. Madiha, interesting comments ahead of the proposed auction of 11 airports. What are the concerns that the finance ministry is raising?
Well, the government is now getting ready to put 11 more AI airports on the privatization block. But this time, as you said, it is also looking at a big question. How many airports should one private player be allowed to win? And that concern is coming from the finance ministry. The PPP appraisal committee met on August 4 to consider the civil aviation ministry's proposal to lease out 11 airports clubbed into 5 bundles. So Amritsar with Kangra Gaggal is one bundle. Second is Varanasi with Gaya and Kushinagar. Third is Bhubaneswar with Hubli. Fourth is Raipur with Aurangabad. And fifth bundle is Tiruchirappalli with Tirupati. Now, each bundle would go to a single concessionaire with a 50-year concession period. But here's where it gets interesting. The finance ministry has flagged that oligopolistic nature of the aviation sector and raised concerns about the market concentration and over-leveraging. Now, addressing those concerns, the civil aviation ministry said that the number of airport bundles of the 5 bundles that can be awarded to a single bidder will be capped. The important bid the government has not yet decided is what that cap will be. The modalities are still being worked out and will come back to PPPAC by the ministry. And why is the concentration such a big issue here? Look at what happened in the previous major round of AI airport privatization. In 2019, 6 airports were put up for bidding: Ahmedabad, Lucknow, Jaipur, Mangaluru, Guwahati and Thiruvananthapuram. And Adani Group emerged as the highest bidder for all 6. Since then, Adani Airport portfolio has expanded further to 8 airports, including Mumbai and Navi Mumbai. The other private operator is GMR that operates Delhi, Hyderabad, Mopa Airport in Goa, Nagpur Airport, and the newly inaugurated Bhogapuram Airport in Andhra Pradesh. So today, 2 private players control a significant part of India's airport infrastructure, and hence the government appears to be trying to avoid a repeat of the previous concentration by deciding not just who can bid, but potentially how many airport bundles one bidder can actually win. There's another angle here on employees. Under the proposed framework, existing AI employees would be covered by a 1-year joint management period, with the concessionaire required to retain 60% of AI employees of those particular airports for up to 3 years.
All right, Madhya, many thanks for joining us. So, concerns being raised by the finance ministry ahead of the next round of airport privatization. On to the IPO corner. Lalitha Jewellery made a strong debut on the Lal Street, listing at a 32% premium to its IPO price. The stock opened at 265 rupees against an issue price of 201 rupees, taking its market cap to over 11,500 crores. on listing day. The 1,700 crore rupee IPO had seen a strong investor demand, with the issue oversubscribed over 60 times. Oriental Hotels and Indian Hotels have announced a merger under the proposed scheme. Oriental Hotels shareholders will receive 25 shares of Indian Hotels for every 117 shares held. The swap ratio values Oriental Hotels at an 8.5% premium to its previous closing price. Speaking to CNBC TV 18, Indian Hotels MD and CEO Puneet Chhatwal said the company could deploy up to 2,000 crore rupees for inorganic opportunities from its 4,500 crore rupee cash balance. Take a look.
If any other inorganic opportunity comes up, it would really be a meaningful deployment of the cash that we have. We have 4,500 crores of cash. So we want to keep a watch list for any kind of bad times, unforeseen bad times that may come. And that could be 50% of that money. Another 50% goes into routine capex as well as new projects. But we keep accumulating cash in the quarter by quarter and years by years. So I think anything up to 2,000 crores is for us today not a big amount to think about. Anything which is closer to Indian Hotels, 35% or 30% plus. So a bandwidth of 30 to 35 is what we'll aim for.
Well, that's Indian Hotels. Bajaj Auto has launched new variants of its Pulsar, its flagship two-wheeler brand. The launch today was part of the company's plan to bring in 10 new or updated models to market before the festive season. The 125cc variant starts at nearly 93,000 rupees. The 150cc variant starts at 1.15 lakh rupees.
Every Pulsar stands for that feeling of adrenaline and thrill that no other bike can give customers. So that positioning has stayed consistent right from its launch in 2001. And then, of course, there are creative articulations, which would kind of keep happening along. We have a lot of women riders, for that matter, and the brand certainly doesn't have any kind of a gender bias. Our tagline, if one was to go by, is definitely daring. I think, and the brand really salutes a sentiment of daring the ordinary. And that's what defines any Pulsar.
Well, time for us to head to a break. But up next, the US imposes 50% tariffs on Canadian exports worth $20 billion after talks collapse. Canada's Prime Minister promises dollar-for-dollar retaliation. That and more when we return. Shein is set to make its long-awaited stock market debut, but with a sharp valuation cut. The fast fashion retailer will begin trading in Hong Kong on September 1st at a valuation of about $27 billion. That's less than a third of the nearly $98 billion valuation it enjoyed in 2022 following a private fundraise. Shein will offer nearly 280 million shares with an aim to raise $1.77 billion through its IPO process. The U.S. has imposed 50% tariffs on Canadian exports worth $20 billion after talks between the two countries collapsed shortly before the tariff deadline. Canada's Prime Minister Mark Carney has denounced America's last-minute move as unfair and uneconomic. He's also announced dollar-for-dollar retaliatory tariffs on imports of U.S. steel, electronics and other products starting the 8th of September. Trump claimed that Canada wants the benefits of being a state without being one.
We cannot accept what they've offered, and we will not give what they've asked. Canada will match Washington's new tariffs dollar for dollar in order to protect Canadian workers, farmers, families, and businesses.
Well, that's Mark Carney on the dollar-for-dollar threat being held out by Canada in response to the U.S. asking for what Canada believes it cannot offer. National Security Advisor Ajit Doval is in Beijing for the 25th round of the India-China talks on the boundary issue. Doval, India's special representative for border negotiations, will hold talks with Chinese Foreign Minister Wang Yi tomorrow. The meeting comes as both sides work to stabilize ties. China's President Xi Jinping is expected to visit India for the BRICS summit next month. Doval's meeting could also pave the way for a possible Modi-Xi interaction on the sidelines of the summit. Commerce Minister Piyush Goyal is on a 4-day visit to Japan. He is leading a nearly 200-member business delegation to strengthen the economic partnership between New Delhi and Tokyo. The visit comes as India and Japan mark 75 years of diplomatic relations. Goyal kicked off his visit with Tokyo and has already met top executives of many leading Japanese companies. Abhimanyu Sharma is here with more.
Several outcomes expected from India's Commerce and Industry Minister Piyush Goyal's visit to Japan, in which a review of the 2011 India-Japan trade deal is also on the cards. The deficit in bilateral trade for India is rising with Japan. Primarily, it's driven by specialized manufacturing and tech imports. Now, both the sides are looking to deepen their bilateral cooperation in several areas like semiconductors, critical minerals, and pharmaceuticals. Japan aims to invest $62 billion in India over the next decade. Over $1.2 billion worth of investments have already been made by Japan into India. It remains to be seen what further outcomes are going to emerge from the deliberations between the Indian leadership as well as the Japanese leadership. Now, industries from both the sides, industry chambers from both the sides are also taking part in deliberations. Piyush Goyal is slated to take part in a roundtable with industry chambers. He has already held meetings with the Japanese leadership and he's going to chair a roundtable on capital goods and automobiles. He met the leadership of several Japanese as well as Indian companies, and the Indian delegation is also going to meet the FinTech Association of Japan as well as the delegates from the Japan Aerospace Exploration Agency. It remains to be seen what further outcomes are going to emerge from the minister's visit and from the industry deliberations which are currently taking place.
Abhimanyu, many thanks there, reporting from Tokyo. At least 13 people have died and 3 remain hospitalized after consuming spurious liquor in Gujarat's Bhavnagar district. Officials said 67 people consumed methanol-laced liquor, which was sold in bottles carrying the name of a popular brand. The manufacturing, sale and consumption of alcohol are banned in Gujarat. Delhi remains under a red alert as heavy rain and thunderstorms have lashed the capital. The severe weather has disrupted flight operations, affecting arrivals and departures at the Delhi airport and causing delays on connected routes. The Met Department has issued district-wise nowcast warnings as adverse weather continues. Tamil Nadu government has scrapped a proposed greenfield airport on the outskirts of Chennai, citing continued opposition from farmers and the impact on agri-land. The project was announced by former Chief Minister and DMK Chief M.K. Stalin in August of 2022. An alternative site will now be identified. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Ritu Singh and joining me shortly will be Arundhati Ramanan. Here are the key headlines from the startup world. Omega Sehi Mobility has raised 50 crore rupees in fresh funding, its second fundraise in 2 months, as it scales production, R&D and its dealer network. The company, which reported 333 crore rupees of revenue in FY26 and turned PAT positive, is also evaluating its path towards a public listing.
Asaya secures 88 crore rupees in Series A at 400 crore rupee valuation, 3x its previous valuation. The science-first skincare brand has grown revenue 16x and is now at 100 crore ARR run rate. Asaya plans to deploy the fresh capital towards R&D, product expansion and scaling its geographic and distribution footprint.
B Clinical raises 21 crore rupees in seed funding led by Source VC. The skincare startup clocks 1.2 lakh orders. The company is going to use this money to scale R&D, manufacturing, product expansion and enter new markets.
Netflix and IICT joined forces to support India's next generation of storytellers, announcing scholarships for 100 students across 6 programs with up to 80% financial support. The scholarships cover courses in animation, VFX, gaming, comics and media technology as part of Netflix's India Storytelling Initiative.
Chinese fast fashion retailer Shein files for a Hong Kong IPO, valuing the company at $27 billion. The valuation is more than 70% lower when compared to its private fundraise in 2022, when the company was valued at $98 billion. Well, those are the headlines we're tracking for you today on Startup Street. Now, Resolve is betting that AI can fundamentally change how lenders operate and not just make existing processes faster. The startup, which was founded by former Kisht executives, has now raised $12.5 million in a Series A round, with more than 22 banks and NBFCs already on its platform. It started with debt collections, but it is now expanding into scales, risk and underwriting, with larger ambition of becoming an AI platform for the entire lending life cycle. So let's bring in the founder for more on this and what lies ahead. Karan Mehta joins us now. Karan, thanks very much for your time here on CNBC TV 18. You know, you've gone from zero to working with more than 22 banks and NBFCs in just 2 years. Start by telling us what's driving this rapid adoption and what are lenders seeing that they were not getting from traditional collection agencies before?
No, I think it's been an incredible journey for us. 22 clients in a short span of time for a very early age startup. And also, you're not talking about, the smaller lenders. We're talking about the big marquee names like Poonawalla Fincorp, AU Small Finance Bank. It's been a dream run for us, but it's also been a big validation of what we had seen and what we had bet upon. What we had bet upon was the fact that lending so far was being done in an era that was defined 10, 15 years ago. Most lenders had traditionally done secured loans, and they had not done very large quantity of digital loans spread all across India on thin file customers. And because over the last 4 or 5 years, a lot of them have expanded into digital, unsecured loans to a very, very wide range of customer bases, they had to find digital solutions for the debt collections problem as well. And debt collections traditionally was very fragmented. There were individual verticals for calling, for field, for digital collections. And people have kept adding layers on top of aging technology. So you had technology that was built 10 years ago, then someone put on a layer of digital, now someone was trying to put on a layer of AI. Because Resolve was built in a chat GPT era, we've built it from the foundation up for this modern day and architecture. And the largest focus is automation. You want that your process should run in an automated fashion. You don't want droves of people taking a decision every morning, uploading Excel files and things like that. And that is essentially what we've bet upon, a combination of the core platform combined with automation and AI driving as many decision-making steps of the process as possible. And this has resonated very, very strongly with our clients, existing clients.
Well, interesting there. You talk about measurable outcomes from AI. If you could just give our viewers some hard numbers. I mean, how much can Resolve actually improve recovery rates or reduce collection costs or increase the productivity of a collections team?
Right. Let me talk about very specific examples of things that we do, right? The first, and you have to think of collections as generally a 3-step process. There's digital collections, then there's telecalling, and then there's field. When we talk about digital collections, Resolve builds models which are called as channel prediction models. Instead of bombarding all of your customers with the WhatsApp, SMS, and email, what we do is we intelligently identify, looking at the trend of the customer interaction over the last 6 months, what is the best channel to reach out to the customer? What is the best template to use for the customer? What is the best language? What is the best time of the day? By simply optimizing this, and this is your traditional ML models, it's not even the GenAI aspect yet, you are able to reach and engage with customers, without frustrating them, doing it at a lower cost, and improving your bounce. The biggest measurable outcome, and this is where we feel that we do it very differently. When we talk to our client, we don't talk about in terms of what we do. We talk about what we drive as business outcomes. The single most important business outcome that we are able to drive across every single customer is that the bounce rates have gone down in a measurable fashion. Now, this bounce rate, for any person who's done lending, understands that this is the driver for eventually what ends up becoming your GNPA numbers. Arresting the flow early pays off very, very rich dividends in the long run. And this is what we focus on when we talk about digital collections. And this is where we are using our channel prediction model along with the strategy builder and the digital communication orchestrator. The second leg, what is that calling? This is where our GenAI call center comes in, where we are able to have the exact same outcomes that were being achieved from a traditional call center, or even better in most cases, at a cost that is 1/3 the cost. And this is what we are also sorry.
Well, I guess you're handling 6.5 million minutes of borrower conversations every month as well across your 12 million loan accounts. How much of that is now actually handled by AI? And where do you think you'll still continue to need humans in the loop?
Fantastic. So we are a purely AI company. Resolve does not have a single telecaller in its offices. All of these 6.5 million minutes are purely done by our in-house voice stack. And that is what we are very, very proud of. We are driving, outcomes measurable to what a traditional call center was doing, with a 100-member engineering team sitting out of one office in Mumbai itself.
Got it. Let's quickly get to that fundraising as well, the $12.5 million check you've got. Where will the bulk of that capital go? Will it be more to build technology, to expand your team, to acquire more lenders, or, expanding overseas?
Right. So I think I will put it out. We have two large agenda items. The first agenda item is we built a very sharp edge by our engineering platform capabilities and our AI capabilities. The intention is the large part of what you see as the $12.5 million is just going to keep going into making this better. AI requires a lot of good engineering talent. So we're going to invest in hiring the best talent possible, have a sharper, larger AI team. Also, AI requires a lot of R&D money, because all of the time you have to keep experimenting. You attempt 10 different approaches, only one of them ends up leading to success. So the bulk of it is going to be on enhancing our AI edge across all of our AI products. The second bulk of it is on product expansion. So Resolve has a goal to move away from debt collections, focus on the sales and the origination piece, focus on the customer support piece, and also focus on the AI use cases for the larger financial services ecosystem outside of just lending itself. And of course, we are already talking about, taking Resolve's debt collections platform and AI platform international. We are already meeting clients in Southeast Asia. We are meeting clients in Middle East. So that is also where a significant amount of the investment is going to go into.
Well, I just wanted to understand, you have lending relationships in India as well. But what is the global opportunity you see and the markets that you think will be immediately most attractive for an AI native lending platform like you?
See, the most important thing to realize is, by volume, India is the largest lending market in the world. India has more number of loans than any other country in the world. More importantly, it has a lot more diversity, a lot more complexity, geographical spread is throughout. Any lender, any platform that has perfected debt collections in India is bound to do well across the globe. And that is what we are betting on. We are expanding. We are talking to clients in Hong Kong. We are talking to clients in Vietnam, in Indonesia, in Singapore. And on the Middle East side, we are talking to Kingdom of Saudi Arabia. We're talking to United Arab Emirates. We are already in talks with the leading banks and lenders in these spaces to take the Resolve debt collections platform international. The fact that we built a productized platform is working out in our advantage, where when we're talking to these international clients, 80-90% of the product is a shoe-in fit for what their requirements are.
All right. And we wish you the best with that opportunity and your growth plans. Karan, thanks very much for joining us here on CNBC TV 18.
Thank you so much.
And moving on the hot seat, from mapping cities and infrastructure to managing natural resources and disaster response, geospatial technology is fast becoming critical digital infrastructure. Now, Gurugram-based NeoGeo is looking to scale that opportunity, raising $20 million in its Series A round, led by Neve 2 Fund and Avishkar Capital. The startup will use the capital to deepen its AI-powered platforms, invest in R&D, and expand into the Middle East and the Americas. Joining us now to discuss this further is Brahmam GVS, the co-founder of NeoGeo, and Anurag Agarwal, the partner at Avishkar Capital. Gentlemen, thank you so much for taking time out and being here with us on Startup Street. You know, Brahmam, let's start with you, right? You operate across satellite imagery, drones, ground surveys, and AI and ML. Can you sort of take us through what you have on offer and the use cases?
Yeah. See, number one is that when we talk about geospatial, it is not just the maps. You are actually talking about how do we understand the locational intelligence. Because whatever, use case that you think of, because majority of the governance, let us look at what is happening with respect to the governance on urban local bodies. So they are having complex challenges, like you have urbanization, utility modernization happening directly, climatic resilience is an important thing, infrastructure expansion is happening, resource optimization is happening. All these things, when you combine them, each of them requires a strong spatial dimension. And unless you have the location-based knowledge, you will not be able to take the correct decisions. So we are starting from the data acquisition, like what you have said, the satellite maps and LiDAR and the drones and everything. From that data that we have, how do we collect the intelligence out of the data? And how do we make this intelligence going to the right person at the right time, to the right place, by providing the right solutions or platforms? That is what we call it as actionable intelligence.
Absolutely.
So
and
from data to intelligence to actionable intelligence is what we do.
Sure.
End to end.
Absolutely. And if you could quickly tell us, we're running out of time. You've raised nearly $20 million in this Series A round, right? So if you could take us through how you plan to use the funds quickly.
Yeah, there are primarily three things that we are doing, like you have already mentioned. Number one is to accelerate the development of our proprietary platforms. These are in the areas of infrastructure lifecycle management, natural resources intelligence, and urban governance. Second is to strengthen our AI and data engineering and product teams to consolidate our leadership position in India. And the third is to expand to the international market, starting from Middle East and US and UK.
All right, so big expansion plans also put in there. Anurag, let me bring you into the conversation. What did you sort of see in NeoGeo that convinced you to write this $20 million Series A check? And how do you sort of see the company's moat evolving as the geospatial market becomes more competitive?
So the way we looked at this was, this is the geospatial intelligence foundational public infrastructure for India, right? This is not just a services shop. It's a full stack IP-led platform, where they are able to acquire data through proprietary platforms. They build proprietary platforms using AI ML layer on top of it, right? And the value really sits in that intelligence layer. The founders of NeoGeo, Brahmam and Sriramam, these people have been there for over a decade, building this, right? And they've built it in a bootstrap manner. They have started off with services, but what they are now trying to build is a platform play. And what we are also seeing is that, there is also a lot of structural policy tailwinds behind this, right? With the launch of the NeoGeo spatial policy, National Geospatial Policy in 2022. So what we find in this business is, a perfect fit of commercial growth as well as impact built into the business.
Absolutely. And, NeoGeo has a mix of project-based revenue and proprietary platforms. How important is the shift towards recurring platform-led revenue to your investment thesis?
So, services platform will always be capped in terms of margin, right? You provide a service and the vendors will count the cost against that. But the moment you move into platforms, this moves into a recurring revenue stream, right? Once you build the platform, the costs are already incurred. So the incremental cost on providing those additional services to different players is marginal. And therefore, the profitability and the value of the enterprise moves up quite drastically the moment you have the platforms.
Absolutely. And Braham, coming back to you, NeoGeo has worked on 200 plus projects and mapped over 5 lakh square kilometers, right? What are the biggest use cases driving demand, which you've outlined? But is demand coming from urban governance, infrastructure, natural resources, or disaster management? Where's the biggest and strongest demand coming from?
Strongest demand comes from both infrastructure and urban governance. Unfortunately, disaster management also has become part of the urban governance because urban disasters have become a norm now. As we are speaking, the entire Gurgaon is flooded and, people are struggling to reach home. So, any climatic situation or any kind of a change in the movement of a traffic, including the speed of the traffic, etc., can have a huge repercussion in terms of the outcomes. So these kind of solutions, whether it is urban governance or the infrastructure, are big time revenue generators. But there is enough focus on the natural resources management also, because everybody is now talking about carbon credits and also the forest management, sustainable living and all that. So I would say all three areas where we are playing are equally revenue focused. But infra and urban definitely are the fast moving in terms of the revenue generation.
Absolutely. And what is that revenue opportunity that you're targeting, and what kind of growth do you expect over the next 3 to 5 years?
See, like everybody is talking about, and there are multiple reports which are, saying around 30% CAGR, in terms of the growth all across the world that I'm talking about in geospatial. Because, like I said, there is an increasing need for location-based decision making. The context, even when you talk about the AI-based solution, the context is provided by the location. See, something happening in Delhi versus something happening in Lucknow will have a huge difference in terms of the impact. So the context is provided continuously, and luckily, geospatial comes naturally with the primary key, which is the lat long. So your ability to rely on the data and then analyze the data to provide right kind of decision-making solutions is, many-fold when it comes to geospatial.
Absolutely. And Anurag, if you could quickly tell us, Avishkar has built a strong track record of investing in impact-led businesses across emerging markets. What sectors and themes are you most bullish on right now, and where do you see the next big investment opportunities?
So I think climate and energy are clear areas where we see a lot of our capital going in. In fact, our next fund, which is called the Avishkar Next Gen Fund, will have a outsized allocation towards that. We are also seeing deep tech and space tech as emerging areas, and NeoGeo kind of fits into that space as well. We'll continue to look at social infrastructure, which has been core area like affordable health, affordable education, access to finance. So these are some of the areas that we are looking at deploying capital, and we continue to believe that these are large market opportunities, and if executed well, will generate not only outsized return but also great impact on the country.
Absolutely. All right, Anurag and Brahmam, thank you so much for taking time out and being here with us on Startup Street.
All right, we have to take a short break on that note, but don't go anywhere. Up next, we'll get you India's quantum push, which gets a big boost as QPI AI opens a new chip foundry with a roadmap to 1,000 qubits. A special report when we return.
Welcome back. You're still with us on Startup Street. Bangalore-based QPI AI is stepping up India's quantum push with its new chip foundry now capable of fabricating processors with up to 128 qubits and a roadmap to scale that to 10,000. Meghna Sen gets you the inside track from QPI AI founder and CEO Nagendra Nagaraja on India's quantum ambitions and the company's manufacturing roadmap and what's next for the technology. Take a look.
What we manufacture here is today's foundry, what we inaugurated, we can go until 128 qubits. Okay, that's almost like same as what IBM has or other people have. So then we are expanding this foundry to actually manufacture 10,000 qubits. Okay, we have a process setting up for some kind of a innovation where we can stack the chips in 3 dimension. So that will take us to a 10,000 physical qubits. When we take these chips and connect in a data center, quantum data center, and interconnect them, so we can go until 10,000 logical qubits. Although there are a lot of challenges, it's not without challenges. There are a lot of engineering challenges. But once we execute this, what will results out of this will be magnificent. We can solve problems which are very hard to solve today. And this can be a leading compute technology of the world once we cross this hurdle of manufacturing.
Why do you think, quantum technology is important for the future, and where do you see India in the global quantum race right now?
Yeah. See, there are only, you see there is a 64 qubit processor. Only 5 countries in the world who have made it. We are one of them. Okay. And in the future, what happens is you do get a problem which cannot be solved by GPUs. That's the first thing. The second thing is today what is happening is whether GPUs, the power consumption is too high, and it is creating a sustainability problem. And in fact, the quantum is when you combine this quantum plus the GPU and CPU stack, what will result is a very smart data center which consumes less power and does more. Order of magnitude of maybe 5 or 6x. So we are betting on quantum computing technology, superconducting, and the photonics. Photonics is for interconnects and then AI chips. So when we combine all these things, I think we get a very smart data center, and that would solve a certain problem in, like for example, today in materials, there is a precision material. That's not possible easily with GPUs. It consumes a lot of power. And then there's a precision medicine, and then there is a sustainability. Like we do require a lot of materials which can be more sustainable. So quantum computing will accelerate that. The bigger part is the quantum data. So the secrets of universe is encoded in quantum data. What we're using today for AI is classical data digitized, and the intelligence is extracted out of it already. Okay, there's no new information you're going to get. But when we access the secrets of the universe in the world, in the entire universe, where the materials or physics or chemistry, you're going to actually uncover the real intelligence that is required for us as a humanity. So that's very important. That can happen only through quantum computer. It cannot happen with the GPUs, and that's a big impact on our society. So one is the sustainability, smart compute, and then quantum data.
Who are your first customer who will buy these chips? Are you in discussion with any companies, and what does your roadmap look like from here on?
Yeah, so roadmap for enterprises is most of them will access on the QCAS basis, and that's the reason we are setting up massive data center, quantum data center in Bangalore, Devnali. And those are the customers. We have already customers like Lilly or partners like Deloitte who are working with us. And then we also have an overseas partner who are already taking the space, and they're taking the capacity, and they're also working with us for the joint labs. See, unlike AI, what happens with quantum is the data is very important, quantum data. And the labs has to be very near to the compute. You cannot offer it on the cloud easily, okay? So that's what we're doing. And that will open up for us. See, we have already partnered with all the big four, right? And then we have partnered with the governments. And then we have established center in Singapore. And then we are going to establish centers in Middle East. All these governments are also somebody who's our customers. The first customers of ours will be enterprise using quantum computer as a service. That is like more like quantum cloud. And then they will partner with us in the labs. And the second tiers of customers are the big customer who want entire data center. So those are sovereigns.
You said that you have partnered with government. So there were officials today here from the National Quantum Mission as well. So did you receive any kind of support or funding from the government?
They are our investors. we are the first company they invested in. Okay, yeah. Right. We are working closely with them.
And how much have you invested in this Jaipur facility, and what further capex is also planned, if you could tell us that?
Yeah, we invested close to $50 million. Okay, further capex of almost like another $30-40 million will be invested here, and we're going to invest $200 million in the other ones.
All right, and with that, completely out of time here on Startup Street, Arundhati and I take your leave, but stay with us. More news and updates will continue right here on CNBC TV 18.
Very few of the NTLFs that have always been virtually a permanent fixture there. So it's great to be back here in partnership with NASSCOM to address an issue that is causing significant anxiety at this point in time. But as Naushir was pointing out, it is also an era of opportunity. The question, though, is will Indian IT services make the pivot that is necessary as of today? You know, there's been a lot of talk around the market cap erosion that we've seen from the 2024 peak. We're down 15 lakh crore rupees for the IT services industry in terms of market cap. And the question that's being asked is the market mispricing the anxiety at this point in time? Is there something that Indian IT knows that the market doesn't seem to know? Because when you talk to these guys, they're all basically telling you there is that $300-400 billion opportunity, and that's the kind of value creation that we hope to accrue. So where is the dissonance is the question that we want to talk about. The other aspect that we do want to address is that if there is this $300-400 billion opportunity that opens up by 2030, which is estimated, where does the value creation lie for the Indian IT services sector, and what changes will they need to make structurally in order for them to be able to leverage and gain momentum of that market opportunity that presents itself? There is, of course, the issue